0.5%, up by a single basis point currently on a 30-year at about 4.93. Outside of that move in foreign exchange, the euro trying to make a comeback here and show some strength, facing the potential of a 12th week of euro weakness against dollar strength after 11 weeks of it closing out last week. 105.010, or rather 105.10, 105.10 on the euro against the dollar. That currency pair positive by 0.4%. And maybe the stress in the bond market starting to get people to think about the end of the cycle. Credit spreads wider, discretionary stocks struggling, bank stocks struggling, crude lower. 88, Tom. We're down about 1% on crude.
You can imagine if crude goes the other way. Of course, Edward Morris has made a real splash here on crude coming back. But really, other than the calming influence of crude, 97 down to Brent crude, just under 90, 89 at 92. I mean, I'm looking at the screen this morning, John, and you got to wonder what meetings are being quote-unquote taken.
Between who?
In Washington, among institutions responsible for supervision and to an extent regulation, but also at these banks. I mean, what's the year-end plan? There's no year-end plan. There's an October plan, and you better get to it.
Add some extra spice to earnings season and those earning calls. The start next week with JP Morgan 2 Fridays away. We've said a few times on this program, trying to frame what this bond market move really is. Is it a reflection of the extension of the cycle or a recipe to end it? I'd have to say, if you asked that question maybe a couple of months ago, it was the former. It starts to feel like over the last couple of days it might be the latter, just in terms of where this market is leaning. I'm looking at high yield spreads, not the level, but the way we've moved. I'm looking at discretionary stocks. Once again, great year, but struggling recently. And looking at bank stocks, Tom, to see the likes of Citi and Bank of America trading below where they were at the spring lows, post the tension of the financial sector earlier this year, Tom. That's quite something going into earnings season.
Yeah, the fancy bow tie word convexity means you're in control. Lisa, were we in control yesterday?
It depends who you mean as we. Maybe the bond vigilantes were. So. That's a good question.
I don't know. I think it's going to be sport. We're going to turn to Washington right now. And, of course, with the leadership of Joe Matthew and Anne-Marie Horton, Balance of Power has become must-watch in Washington at 5 p.m. Look for that tonight. A gentleman from Florida by the name of Gates is scheduled to show up. This is really special, and we thank Invesco for letting us speak this morning to their head of U.S. government affairs, because yesterday afternoon, in that history-making moment, the bow-tied one got up at the House and said, "We will continue forward." His name is McHenry. He's from the Carolinas. He's a really interesting guy working in the trenches of political operation for George Bush the Younger and on through Carolina politics. Jennifer Flitton is with Invesco, head of U.S. government affairs, but has worked for Congressman McHenry over the number of years in chief of staff positions. Jennifer, thank you so much. Who is this guy? It was like Butch Cassidy last night. We know these faces, and to be honest, most of our audience, particularly our international audience, who is the Southerner McHenry?
Yeah, well, he's the chairman of the Financial Services Committee, and he has been in Congress for almost 2 decades now. He is an institutionalist, and he is a policy wonk, and he's politically savvy. And it's not shocking that Speaker McCarthy chose him on that short list of members to succeed in time of emergency.
Jennifer, in the Washington Post this morning, Mariana Sotomayor, they lead with the word rebellion. That has a heritage, a tenor, a tone south of the Mason-Dixon line. Parse the distinction of Southern Republicans like French Hill of Little Rock or Mr. McHenry of the Carolinas. Parse their distinction from 8 or 9 people that have rebelled.
Yeah, these are fairly new members, right? I mean, you look at these 8, and these are members who mostly came in after 2018, and they really represent a different thinking within the Republican Party that was made very clear after the election of Donald Trump. And it really is a small number, right? I mean, the vast majority of the Republican conference stood behind Kevin McCarthy. But due to such small margins in the House, a vote of basically 5, 8 members were able to unseat the speaker for the first time in history.
Jennifer, I was reading a story interviewing some of the supporters of Congressman Gates in Florida, and they were very supportive of what he was doing. And they were saying, basically, the system hasn't worked for us. Throw it all down. Basically, take it apart. Why are there so many voters who essentially want to disrupt the whole system? What's the galvanizing force behind that?
There's a frustration, right? And Washington is but a reflection of a lot of that frustration. These are 435 members of Congress of the House who come to Washington to reflect their constituencies. And there is a frustration. There is sort of a distrust in Washington. And yes, Matt Gaetz has decided to come in front of that and in his expression to try to lead that. But it does actually reflect a concern over a $33 trillion debt, a $1 billion of interest being paid every year, right? I mean, so that frustration is real. Whether Matt Gaetz is necessarily the best to be the voice and the leader of that, I think is an open question.
But the irony of this, Jennifer, is that the longer the government doesn't make a resolution, the more bond yields are going up and the greater the interest expense and the debt profile of this country. So at what point, from a political standpoint, can you bridge that gap to try to communicate that sometimes dealing with the frustrations and the inefficiencies of the system are maybe a more efficient way of getting to the same end? I mean, how do you communicate that politically?
Well, and I think we're going to see exactly that as they negotiate this appropriations process over the next 42 days, right? Because they have until November 17th to either pass another stopgap resolution or to come to an agreement with the Senate on appropriations. And right now, they're still very divided. Whoever is the next speaker is going to have to, as you say, bridge that divide. And I think it's an open question. And over the next week, these Republican members of this conference, from the center to the far right, are going to have to grapple with that question.
Jennifer, do you have a base case on where we'll be November 17th?
I'm concerned, right? I mean, last night was very concerning. And I think there's an understanding within the conference that there needs to be unity among the Republicans if they're going to move forward and have any leeway with the Senate going forward. But it is clearly going to be difficult for any new speaker to work with the Senate, which quite frankly has a bipartisan position on appropriations. So at this point, at this date, I'm rather concerned how we're going to move forward. And I think a government shutdown is probable in the near term.
Jennifer, thank you for your insight, your opinion. Jennifer Flynn there of Invesco. November 17th, Bramo, base case, just to read between the lines there, basically said it at the end, shutdown.
And we heard that from Jim Jordan as well. We heard that from others, that it doesn't seem like there is some sort of resolution. The problem is, and this goes to the frustration that a lot of people have, both in Washington and outside, people are not happy with the way the system is working. But if you just throw it out, you get further away from a solution to the very same problem, which is bigger deficits and bigger interest payments.
Remember the Fitch downgrade?
Yes.
And all the criticism that Fitch got?
Yeah, here's S&P, right?
Even the administration was coming out and saying, what dysfunction?
Exactly.
I mean, come on. Look at the way it's playing out. The way it's playing out now. Coming up on the bond market, Gene Tenuzzo of Columbia Threadneedle on fixed income and this global bond market sell-off. Yields this morning, I have to say at the moment, quite well behaved. Your 10-year, 480 from New York. This is Bloomberg.
obviously we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Yields pop, stocks drop. That's the story of the last 24 hours or so. Your equity market pulling back on the S&P 500. Futures just about unchanged this morning, up by 0.03% on the S&P 500. The S&P, Tom, down almost 8% from the highs of July.
Yeah, I got a drawdown. I mean, the drawdown here is not all that bad. We're not even to correction status here in the equity market. As you let off, John, equity's doing better than bonds as a general statement. I got a negative 7%, negative 8%. Dow doing a little better than SPX. But what's surprising is NASDAQ. I expect negative 8%. I expect NASDAQ to be negative 10, 11, 12. No. NASDAQ's holding up because of those profit machines, which aren't going down like the others.
I'm with you. Given the moves we've seen in the bond market, back-to-back double-digit gains on a 10-year yield, a move of more than 20 basis points Monday, Tuesday. Thank the manufacturing ISM on Monday. On Tuesday, you can maybe thank job openings or thank everything, all of the above. Yields are higher by 2 basis points this morning. Let's call it 482. Came very close to having a little look at 490. But let's frame this move as follows, Lisa. This is a 150 basis point move from the post-SVB failure lows. That's how big this move has been. And remember going back to spring when we had conversations day after day, again and again repeatedly, about the potential for the end of the cycle. Here we are with yields 150 basis points above those lows.
It's defied all expectations, including those who said something would break at this point, and we've heard that again and again. Maybe things are starting to break, but doesn't seem like it, really. I just was laughing when you said, here we are. A tame move, 482. Yesterday at the same time, you said, bumping up against 470. I mean, it just gives you a sense of how fast we're moving here.
Exactly. The speed of movement. And fast is a really important word. It's a famous David Malpass word. The bank, I looked it up. The bank rate 30-year, I was shocked, 7.88%. It's like jump condition towards 8%. And what's amazing to me is the 30-year bond, John, you mentioned correctly, at 2-something a.m. this morning, it popped to 5.00, take it out to, we do 3 digits here at Bloomberg, 5.009%. The world changes.
It feels like 5 minutes ago, Lisa, to your point, we were literally discussing how historic it was to get yields back in the 440s on a 30-year, that we hadn't seen this in something like 10 years, and we're just taking out each and every level so quickly at the moment.
Which is the reason why it was interesting to me that Margie Patel, her argument for stocks is that we don't know whether this yield rise is over. It could rise that much more. And we could actually see more material losses because of the supply issues, because of the dysfunction in Washington, D.C., because of what we're seeing with robust economic data, and that could still allow stocks and riskier securities in the bond market to keep advancing. Is that the case? Really, this is, to me, the key debate heading into the fourth quarter.
Let's wrap it up with foreign exchange. The euro against the dollar against the yen. The euro showing a bit of strength, the dollar a touch of weakness. The euro 105.07, that currency pair positive 0.4%. The dollar was stronger against everything in G10 yesterday, with the exception of the Japanese yen. We can have a conversation about why. Dollar yen's 149.15. It breached 150 briefly. The why. There's a lot of suspicion that the Japanese authorities stepped in. They won't confirm or deny. dollar yen. The chart speaks for itself, Bramo,
100%.
doesn't it?
Confirm and deny is basically also confirming it.
The chart, I think, confirms something happened once we breached 150.
I think that would be true. I looked at two oddities, John. I looked at South African Rand, and it didn't get out to a 20, which is a round number. But what I really looked at was loonie. Canadian dollar is extremely well behaved, where it weakens from a 135 out to 1.42. It gets pointy and stochastic, where Trudeau dials 1-800-BIDEN and says, oops.
And no one picks up.
We're now at a 137 on loonie. Amy, it's USD, CAD is loonie. That's different from CAD USD, which is the tourist dollar. That's a long story. But the answer is we're not out to panic yet on some of these pairs.
You missed the joke there, Tom. Never mind. Under surveillance this morning, the underappreciated, unprecedented removal of Kevin McCarthy as House Speaker, raising fears of a government shutdown with the next deadline a little over a month away. McCarthy losing his post after Republican hardliners revolted against his decision to compromise with Democrats to avert a shutdown last weekend. The House expected to host Speaker elections next week, with the next shutdown deadline looming on November 17th. AMH just around the corner to weigh in on some of this. But the bond market moves, some might argue, are connected to what we're seeing down in Washington. Treasury Secretary Janet Yellen casting doubt on a higher for longer rates environment, saying this: people are trying to figure out exactly what it's going to take to keep inflation moving down. And the economic resilience that they see maybe suggests higher for longer, but we'll see. I think it's by no means a given. Lisa, when I heard this yesterday, I just thought, is that a wish, a prayer, a hope?
It's a put.
Or is that actually a reaction?
Well, it's not a put because she doesn't have that power to make it a put anymore. She has to keep borrowing. She maybe has to go over and plead over at the Fed to maybe buy a little bit more, but they're not going to listen unless they want to be accused of some sort of political interference. Right. There's a question here, though. At what point is there a real problem that Washington recognizes as they watch bond yields climb higher?
There's a feeling it might be right now. More data a little bit later going into payrolls, more key jobs data out this morning. ADP report, 8:15 Eastern Time. The median estimate in our survey calling for payrolls to rise by 150,000. Comes on the heels of that JOLTS report. The JOLTS report, Tom, really, really strong, much higher than expected. Speaking to resilience in the labor market ahead of payrolls on Friday.
Some people suggesting there's some variability, some instability in JOLTS, and of course ADP we all know is a soap opera, but all of a sudden with everything circling here, including the speaker battle, the jobs report, you should tune in, folks. It's like the Super Bowl. We'll be there. It's like,
It's a Treasury sell-off looking for a reason. I'm with you. There's lots of flaws in the job openings data. The way they survey that data, responses to it, the fact that it's much easier to post a job opening. Maybe you should put more weight on the quits rate. The quits rate has come all the way back in.
Right.
But you put it together with the ISM manufacturing, we'll get services a little bit later, and the data's been better than anticipated.
Over the night, just quickly here, I did some analysis, and there's a new voting member at the Fed, Michael Barr. Michael Barr is a new voting member as of yesterday, and how we went from control to the beginning of a free fall. The policeman at the Fed, Michael Barr, is the one. He's a new voting member. He's going to call up Powell. He's going to say, you got to be kidding me. Let me show you the evidence that we see out there.
Looking at the banks?
The banks, absolutely. Okay. They always, Bernanke 101, look at the banks. That's his research at Princeton years ago. When in doubt, how'd we screw it up in the 30s? We didn't look at the banks. Bernanke 101. Michael Barr's a voting member as of today. Gene Tenuzo could be a voting member someday, or a governor. Global head of fixed income at Columbia Threadneedle. He's surviving the wars. Gene, there's a point where it switches from yield analysis to price analysis. Are we there?
It does feel like we're there, Tom, certainly. You're talking about it earlier. The sell-off we've seen in the long end of the yield curve is equal to the amount of work that the Fed's done at the front end of the curve all year. They've only raised interest rates by 1% through the course of this year, and maybe 25 basis points more. But the risk premium that we've put into the long end of the curve is really what has taken investors by surprise, I think, here, because it doesn't seem to be driven by the fundamental data. We would argue that the most important fundamental data of the last couple of weeks for the bond market is the fact that core PCE inflation, the Fed's preferred gauge, came in below expectations and is trending towards that 2% target. And yet we see this steepening, and I think that should give investors pause and think that really there is a fiscal risk premium coming back into the Treasury market.
Gene, have you changed your mind on that in the last couple of months?
Well, I think what we've been doing, John, is really trying to focus more on what we call the belly of the curve, or that 5-year point, where we think we've priced in more than a fair path for the Fed funds rate and more than a fair higher for longer situation. And you have yields basically from the 3-year point all the way out to the 30-year point sitting right around or just below 5%. And for that same yield, we'd rather put our money in the 5-year point where you're more looking at what the Fed might do and less worried about that term premium or that risk premium, which we learned last year in the UK gilt crisis that can get away from you pretty quickly.
Gene, you think we've got the ingredients for that kind of outcome?
I really don't. I think it's a very different market. The depth in the U.S. Treasury market is significantly greater than what we see in gilts. But, it's that time of year, and it was just a year ago we were looking at what was going on in the UK, and that budget dynamic really did create scare across the market, and international investors drove yields higher quite rapidly. There are some similarities, but I do think the depth in the Treasury market is very different.
Gene, when we talk about the rest of the markets, aside from treasuries, you can look at stocks, which have been remarkably resilient in light of some of the recent moves. You can look at credit starting to maybe show a little concern, but largely holding in. Does this indicate to you that the rest of the risk complex can actually sustain yields that are rising at this pace to these levels? Or do you think that there is yet to be a wake-up call that is coming?
No, I think the wake-up call is coming, Lisa, quite honestly. And we're starting to see that in liquidity of credit. It's starting to deteriorate and spreads are widening and bid offers are widening. So it's a little bit of that unfavorable dynamic we saw for a lot of 2022. And this week that started to reemerge. So I think that credit investors are getting nervous. And frankly, they realize that lags of monetary policy may be long or variable, but they do exist. And at the end of the day, companies and consumers are borrowing at much higher rates, and that's going to cause cracks throughout the system.
Are you saying things actually break or force selling or anything that seems like a catalyst, or just a little bit more fear that causes a little bit more caution in investments?
I think it's more fear overall. Fundamentally, investment-grade companies, for example, are very cash-rich, and their cash flow profile is stronger than it was in 2019 before the pandemic. So I don't think there's anything that's going to disrupt that, from yields going up 1/4 to 0.5% in a short period of time. But when we think about highly levered companies, and for example, look at the fact that CCC, those highly levered companies that have returned over 12% through the course of this year to date, well, they're going to be really susceptible to higher borrowing costs. And as we go forward, I think that rally is going to be hard to sustain.
Gene, let's go back to Minnesota finance just a few years ago. There's a chapter there when it gets like this, look at the banks. You've got the advantage of Columbia Threadneedle that you're not representing a major bank directly in that, which is our advantage this morning. Are you stressed about the banks? Are they too big to fail? Those regionals below them, and critically, the commercial real estate block below them?
I think most importantly, we feel really comfortable with the global systemically important banks, the sort of the big issuers here in the U.S. And we've actually been adding exposure since March through now to that complex. And we think that they're exceptionally cheap relative to their industrial peers. As you get down into the regionals and some of the tier below that do have more of that commercial real estate exposure, I think you do have to be a bit nervous. I think there's a degree of capital raising that's going on in that next tier of bank, but that's frankly, it's been orderly in terms of investors being able to lend that capital. But I don't think we should be so confident as to say we'll never revisit any of the volatility that we saw with SVB.
Gene, when you say you're adding, how are you doing that?
Yeah, I mean, we're adding in the new issue market and in the secondary. I think looking at the big JP Morgan and Bank of America type capital structures where the capital profile is already been fortified post financial crisis, unlike the super regionals that are having to add that capital now. So these are names that over the last 6 months we've been adding to portfolios, and frankly I think that they're good alternative relative to potentially more cyclical corporate exposures.
Gene Tenuso. Gene, thank you for the insight. Gene Tenuso there of Columbia Threadneedle. On credit at the end, the banking stress we saw earlier this year, the financials really struggling, some of those big names, those bank stocks. KBW Bank Index cannot get off the mat. It's rolling over again towards the lows of spring after the failure of SVB. My big takeaway from that conversation though, Bramo, that fiscal risk premium that you've got to start thinking about. Now, from people like Columbia Threadneedle, this is not something we talk about with Gene Tanuzzo. Gene would say, yeah, we've talked about that for years. It's not a problem right now. Now it's starting to be something that really resonates with people in fixed income.
Which to me raises the specter of when does Washington start to watch the Treasury market more aggressively? I mean, seriously, because there's actual practical costs. Goldman Sachs did a survey. They actually increased, just from their survey in July, they increased their expectation for the federal deficit in the U.S., the fiscal deficit, $100 billion just simply by the move in yields by 2025.
Yeah.
So it gives you a sense of the real hard cash behind some of these moves.
I said it yesterday. How close are we to politicians just waking up in D.C. with a chart of the 10-year yield?
I mean,
after the moves we've seen.
I feel like they should be, because right now they should be.
Than John. They
right,
will.
but at some
Congressman
point,
French Hill is.
yeah, and maybe others will start to join.
We'll see. Coming up very shortly on the financials on the banks, just a really sensible, sober voice through the financial stress earlier this year. Chris Marinac of Jenny Montgomery Scott on the financials. Chris is going to join us next. From New York, this is Bloomberg.
The top names in climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority. industry. There's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Are you planning on endorsing a successor to you? And then
I might. I might.
you might.
Yeah.
Who would that be?
I don't know who's running that.
Okay.
I'll talk to people.
And when you look back, is there anything you could have done differently to for those 8 members?
Yeah, a lot of them I helped get elected, so I probably should have picked somebody else.
Congressman Kevin McCarthy speaking to the press after his historic ouster as House Speaker. Live from New York, welcome to the program. Equities turning positive, a real turnaround in this market this morning. Equities were lower, bond yields were much higher. Turn that upside down. Equities are positive by 0.2%. Yields are now down by 3 basis points, Tom. 476.84 on a US 10-year this morning.
There was history made yesterday in Washington, and we're not going to turn this into a history lesson, but to give you some perspective, and I thought the Washington Post captured it brilliantly this morning with the word rebellion. There are different kinds of Southerners. Newt Gingrich with Sean Hannity last night was heated and on fire, the former speaker with the revolution of 1994. And now we have the immense honor of speaking with French Hill. He's been a good friend of the program. And far more important, folks, French Hill is linked to American finance through his banking in Little Rock. French Hill, how do you link this moment to confidence in our banking system?
Well, Tom, it's good to be with you, and I don't like the dysfunction in the House. Of course, I was very opposed to what happened yesterday, because if we want to continue to build confidence in the U.S. and the U.S. in global capital markets, we've got to show leadership on the fiscal side of the House. And right here in the midst of an appropriations fight and a fight over federal funding, and less than now 40 days to a government shutdown, to be shut down in the House without a speaker for the next week is not contributing to that vote of confidence. So I think they are linked, and I really hate to say that, but this rebellion has come at a very poor time.
The rebellion has a tinge of geography. We had votes from Montana and the rest. And John, I'm sorry. I look at this as a political context of the nation. It's not just about what we're doing at surveillance or the cable TV theater that we're seeing in Washington.
There's a real feeling that the Republican Party shot itself in the foot. Congressman, the question I'd have to ask of you this morning is, how can the American public have any confidence in your party's ability to govern?
Well, I think under Kevin McCarthy the past 9 months, we demonstrated that quite successfully, and that's why I'm so disappointed in 8 people, which represent about 4% of Republicans in Congress. Let me repeat that, about 4% of Republicans in Congress. They voted with all the Democrats yesterday to take down Kevin McCarthy's speakership, but under his speakership, we passed an all-of-the-above energy strategy to make America energy independent once again. We passed border security that both reforms the immigration system that's failed and do border security. And it was Kevin McCarthy, after waiting 90 days for President Biden to provide any kind of leadership, that crafted a historic debt ceiling deal, which resulted in $2 trillion of spending reductions and a 1% cap on discretionary spending. And then just last week, offered a good stopgap spending measure so that we could finish our appropriations work, which also included a debt commission, which I think is so critically important if we want to get a handle on what really drives our deficit, which are our mandatory spending programs.
Congressman, as yields do continue to rise, and I do know that every day you do come in and you look at that 10-year yield and watch it climb in tandem with the interest payments of the U.S. government, Goldman Sachs is estimating that yields climbing where they are at about $100 billion to the deficit come 2025 versus expectations just in July alone. Do you think right now that other members of your party realize that the longer this dysfunction goes on, the more they contribute to that deficit?
Lisa, it's such an important question, but I want to really turn it around and say yes. I think every day in the last few weeks we've talked about the impact on fiscal finance and rising interest rates with our House members. But this is a fundamental issue that goes back to both pre-pandemic and certainly during the pandemic, when the Democratic House Budget Committee chairman at the time said there's no limit to what America can borrow from the world and spend at home, and deficits don't matter. And that went on steroids during the pandemic, ostensibly to help offset the output loss during the pandemic. But we did 5 or 6 times what that output loss was, and we didn't take our foot off the accelerator. And President Biden's compounded that. So it's a bipartisan
hold on a second.
to do this.
But Congressman, I mean, to be fair, the deficit did rise by about $8 trillion during Trump's time in office, and it actually accelerated during that period, and a lot of the aid was accelerated during that point. So isn't this both parties, and the fact that there's complete dysfunction now just exacerbates the inability to really address any of these issues, which is a bipartisan issue?
No, I just said that. I said during the pandemic. Well, that's the Trump administration. Absolutely. We had spending out of control there with an eye towards trying to offset the output losses during the pandemic. The globe did that, but we overshot, plus too lax monetary policy for too long. We've lost our way. I want to go back to when both parties said that zero deficits were the objective, not $2 trillion, which is Joe Biden is projecting. So sure, both parties bear full responsibility for this, but what I've seen in my 40 years of being in private business and in and out of government is there is no consensus that large deficits are bad in the Democratic Party and some in the Republican Party, and that's what's got to change.
I would suggest, Congressman Hill, that you and former Speaker Gingrich are sort of on the same page. Well, this is embarrassing. Let's fix it. The way to fix it is an anointed Speaker of the House. How long is this going to take?
Well, I hope, Tom, I would have hoped that we could have started that process before we left this week, but we didn't. And so we're going to meet either Monday night or Tuesday morning early and start the process of selecting a new speaker. And I want to have that concluded next week. It's very important that we get on with our work in this midst of this appropriations fight that we have on our hands with the government shutdown looking us in the eye for November 17th.
Congressman, this is a difficult question. It might be somewhat emotional for you. Has your party left you behind? Do you get the feeling that this is not the Republican Party that you joined and it's moved away from you?
I think the Republican principles of balanced budgets, a strong defense, international leadership, the largest open market in the world that attracts people all over the world. These are core principles, loyalty to the Bill of Rights and the Constitution. These are still fundamental tenets in the Republican Party, but I think we've lost our way tactically. We're throwing overboard a successful speaker that shares those views, absolutely shares those views, and was guiding us through the stormy waters of a dysfunctional presidency led by Joe Biden and a Democratic-controlled Senate. Not easy to do with no plan. Those 8 people who voted to throw Kevin McCarthy out yesterday, incorrectly in my view, don't have a plan except they're complaining about the fiscal conditions of the country. Well, that's shared by all Republicans. So tactically, I think they failed. Strategically, I think the individual principles and governance that's guided the Republican Party are still intact. We've just got to move forward and regroup and find a leader that we can get behind.
It's certainly shared by the Republicans, the majority of Republicans in Congress. But Congressman, is it consistent with the views and the beliefs of the dominant leader in the presidential race for your party going into next year? And I think overwhelmingly the answer to that is no, isn't it?
Well, I think President Trump believes certainly in a lot of those principles, and I've seen him do good work when he was president, but we need him to help rebuild this and not run counter to it. We need to have the Republican Party on the same page when it regards our role in the world and our role at home on how to do that. And, you know, President Trump had challenges on the spending side too, and yet he was good on some other things. So we've got to get together and focus on the House in the next few days and get a House leader that Republicans can back so that we're back in this game of countering the Biden's failed agenda on the border, internationally and fiscally.
Congressman, just finally in 30 seconds, is he helping you or hurting you now?
Who?
The former president.
I don't think he comes into play in this issue in the House. What we've seen is these 8 people are not doing Trump's bidding. They're concerned about the fiscal affairs of the United States. I get that. They did not trust Kevin McCarthy. I don't agree with that, but I understand where they're coming from. This is an internal matter that we need to solve in the House, and we need to get a leader that we can get behind, as I say, in order to counter the mistakes in the direction of the Biden administration.
Congressman, thank you for your opinion, your view this morning. We appreciate it, as always, French. Congressman French Hill there on the latest in Washington. Live from New York City, your equity market just about positive on the S&P 500. It's a bit of a turnaround this morning. This is Bloomberg.
From the world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join host Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
Well, I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If we don't know where the top rates will be, we don't know where the bottom of the equity market is going to be.
Spreads will gradually move wider into the end of the year, but we are forecasting a more narrow range.
I think the potential for an accident is there, but
these higher rates ultimately are going to bite.
There's a lot of risk going forward here, and the market's only now starting to price it in.
You could definitely end up between 5 and 6 on the 10-year. I think it's more likely we're going to head up towards 5.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on radio, on television. An historic morning for America. Yes, the politics of Washington, but far more in 14 minutes, John. Once again, we're data dependent as bonds are priced lower.
Can we make it 3 for 3? ISM manufacturing, better than expected. Job openings higher than expected. ADP report just around the corner. Tom, going into payrolls on Friday.
It's a trend of hard data, soft data, all the other stuff Michael McKee talks about. He'll be with us. We're going to come to you commercials free through this hour. Keith Lerner in moments, and then a guy named Hollenhorst is scheduled to show up to tell us about Powell in the put. Secretary Yellen yesterday, very chairman-like. I believe we had a Yellen put tossed into the landscape.
I believe that was a hope, not a forecast. Yeah. That higher for longer is not a given. Given the backdrop, Tom, we've got to talk about the context. Those comments are coming at a time that you've got a bond market selling off pretty aggressively, up 150 basis points from the post-SVB failure lows. TK, back-to-back double-digit gains, and a real concern that this is not just about the Federal Reserve. This is not just about the economic data, not just about Japan and exiting yield curve control, not just about China and the difficulties they've got, who perhaps are selling treasuries, but also about the dysfunction in Washington and the budget deficit and the inability, not just the willingness, the inability to get a hold of it.
And what everybody's doing, folks, and within the financial ballet, it's about yield. We've tried to give you in crisis the price analysis. Lisa Abramowitz is expert at this. What is the price analysis of the two movable parts of a spread this morning?
Well, of the bond yield. It's price down, yield up, and you can see that with credit spread as well. It's basically when you have the risky aspect of the company go up, you see credit spreads go up, and you are seeing that because right now people are looking out there and saying, if borrowing costs go up this quickly, you start to have a fundamental concern about what kind of price you're going to have to pay to refinance. This is the issue. If prices of borrowing go up, if rates of borrowing go up enough, it becomes a credit risk just because it doesn't make sense to borrow money and refinance at some of these rates, Tom.
Farrow this weekend out looking at real estate across the island of Manhattan. How about that?
Not so much.
John, how about that 7.88% 30-year mortgage? Are you kidding me?
I haven't seen numbers like this in more than 20 years. Manus Cranny's moved over to New York. Welcome, Manus. He's doing a great show at the moment with Danny Berger at 5 a.m. in the morning. Good for him. I'm looking forward to catching up with him a little bit later. We've been talking about mortgages in America, Tom. Real estate in the United States. He's looking at buying in New York. I was like, good luck. I said, Manus, the problem is not just that rates are high, it's that prices haven't come down. That's the issue right now in real estate. So sure, I mean, you'd pay like 8% mortgage rates, whatever. I wouldn't be too bothered about that if prices had come down 20, 30%. That's not what's happened because a lot of people are sitting on mortgages that have got a two-handle on them, Tom. Suppliers, we know, is an issue in a lot of places, including in New York City. And this is the thing about long and variable lags. In the housing market, super long. It's like 30 years. The high yield, which is what Bramo's talking about, that's on the horizon, near term, next 12 months. There's a lot of companies that need to come back into this market and refinance. And they're going to refinance at rates that look nothing like the rates they financed at a couple of years ago.
When you take Manus out, I mean, is the Dead Rabbit enough of an Irish bar downtown, or is that's like American Irish? It's like it's really not.
That's a bit of a stereotype. I
wouldn't take
stereotype. I wouldn't take Cranny to an Irish bar.
You're not going to take Cranny to
New York. Took him to a diner. We had breakfast. You were there.
Yeah. Well, that was he wasn't really here yet. Now he's more here.
No, he was here.
But it wasn't
very
offensive enough.
Physically present.
Lisa, this redounds to speaking of Ireland. I looked at Irish prices. Manus says I should live next door to Bono, however you pronounce it. The real estate prices in Ireland are insane, and this is a global moment. We've really been focused on America, but the German 30-year or UK gilts, et cetera, they're all in the same disarray.
There's a tension right now because there is a lack of supply of homes and there is an increased demand as people come of age to actually make families and move out of their parents' basement. And so you do wonder at a certain point where it breaks. And there is a theory out there that when rates start going lower, you start to see supply come into the market, and that's when you see
Well,
housing prices fall, because you actually get price discovery. You actually have a market.
2-10 spread, John, to get the data going here. It's been a little better in the last hour. We had continued disinversion early morning, early surveillance morning. Now negative 37 basis points is still stunning.
Massive turnaround, but let's talk about where that disinversion, is that what we're calling it?
Disinversion is
It's coming
what
from.
Priya Misra told me.
It's coming from the long end selling off. It's coming from 10-year yields going aggressively higher, 30-year yields going aggressively higher. And that is not the steepness we expected, the nature, the character of it. What people were looking for this year was economic downturn and yields falling at the front end. So the front end rallying off the back of bad economic data. Haven't seen much of that this week, Tom, going into payrolls on Friday.
Yeah.
Your price action looks like this in the equity market on the S&P 500, turning just a little bit higher by 0.2%. In the bond market, yields are lower now by a couple of basis points. Tom, let's call this 477.
Vixen under 20. Crisis over 19.76. Expert at crisis measurement is Keith Lerner, co-CIO, Chief Market Strategist of Truist Advisory Services. He will get us to ADP this morning. Keith, you've got so many competencies, CFA, CMT. Which chart speaks volumes to you this morning?
Yeah, well, great to be with you guys. I appreciate the new title. I could use a new one. You know, as far as what speaks volumes, I mean, obviously we're focused on that 10-year, right? The 10-year needs to stabilize. Everyone's watching that as the first thing that they look at when they wake up. But, you know, believe it or not, Tom, you know, we have been more in the correction camp since late July. And believe it or not, I'm actually becoming more positive, given that we've had all these carousel of concerns, but we've had a pretty good correction. Right. We have now 8% of stocks above the 50-day moving average. That's down from where we were in July. We're about
p.m. Eastern. A 15 basis point trading range on a US 10-year yield.
Another day.
Much higher a little bit earlier. We were pushing 490, and now we're back down to 470 something. On a 30-year, yields were 3.5% earlier on this morning. They're back down to about 487, down about 6 basis points there. Off the back of that move, equities spiking higher. Near session highs, positive by about 0.3% on the S&P 500. And the dollar, which has been absolutely dominating the bulk of G10 with the exception of the Japanese yen in the last 24 hours, shown some weakness now against the euro. 105.17, that currency pair positive by, let's call it 0.5%. Tom, that currency pair near session highs.
Much more than normal, John. And folks, you just simply look at the blinky of the Bloomberg Launchpad, the red and the green, the amber on the screen. And John, there's a lot of action there. There's people adjusting.
Adjusting, adapting.
Yeah.
Downside surprise, 89,000 on ADP. The estimate 150. Looking ahead to payrolls, this is the number we're looking for. 170. The previous number 187. To McKee's point, after a number like that, are we going to see some upgrades to the forecast or some downgrades going into Friday? Andrew Hollenhorst of Citi with us around the table. Andrew, your reaction to that? What would you expect on Friday now based on this? Does it change anything for you?
It doesn't change anything. I think just look at the scatter plot of ADP versus NFP. There's not a high correlation between the two. So it's a big if we get this number. If we get this number, though, like Mike McKee said, it's a big if. But if we get this number for payrolls on Friday, this is Goldilocks. Right around 100,000 jobs per month. That's about what the population growth can sustain. That would be a very sustainable pace of job growth. So if we see this number, that would be a Goldilocks economy.
The heavyweight, Janet Yellen, was out yesterday with some select comments that I'm sure your team saw as well. There's another economist, Michael Tyson, who has a very famous quote about getting punched in the face. Everybody's got a plan here. How does the Fed, with the trauma that we've seen the last week in the bond market, I'm sorry, there's a point here where the Fed put comes back into place. Are we anywhere near where the Fed looks at the financial trauma and says, we got to adapt?
So remember what the Fed is trying to do here is to raise interest rates and slow the economy. They've raised policy rates, but really what controls the economy, mortgage rates, corporate borrowing rates, those are going to be dependent on the 10-year yield. So the fact that 10-year yields are higher, I think is probably consistent with what the Fed is trying to achieve. Now, like John was talking about earlier, being in a 15 basis point trading range over the course of an hour or so in the day is probably not the level of volatility that Fed officials would like to see. So they're watching this, as Fed officials, government officials always tell us, they're watching. And they'll be watching for, do we see signs of liquidity stress that are emerging? If you saw those type of things, then yes, I think you could think about, would the Fed actually react to this? And first it would be with their rhetoric saying that, maybe Treasury yields have moved too far, but I think we're still away from that point. Treasury yield curve is still inverted. We still have 10-year yields below 2-year yields. They've come up a lot. We're not as inverted as we were. If you're not imminently looking at a recession, you're not staring down a recession, it's not clear why that yield curve needs to be as inverted as it was.
A number of people who have come on this show have said that a lot of the move in yields has not been fundamentally justified. Do you disagree? Do you think that fundamentally where the yield is currently on the 10-year Treasury and the 30-year Treasury is completely justified and compensating you for inflation?
I think it depends on what you mean by fundamentals. But if you're including in those fundamentals the fact that we're running large deficits, there's more Treasury supply that's coming to the market. So some people would call that a technical, but I would say that is a fundamental structural part of the U.S. economic backdrop right now. And along with that, we're running higher inflation. And you were just talking about this earlier. If we're running inflation that's above 4% still by a lot of measures, it's not that surprising to see Treasury yields above 4%. You need that yield just to be compensated for the inflation that we're running.
Do you think dysfunction in Washington helps the Fed's cause?
I would not say that it helps the Fed's cause. I don't know if it helps anyone's cause right now. The developments, it does raise questions about whether we're going to be in another shutdown November 17th. And you saw markets that were trading that. You saw markets that priced out some of the probability of a Fed hike in November. I think what the Fed wants here is for the government to stay open, which would allow them to respond to the economic data and not what's going on in D.C.
That is a fantastic answer. Well played. Very diplomatic. You use my favorite phrase in the whole of global finance from policymakers. We're watching this.
That's right.
And we often ask on this program, what does that mean? What on earth does that mean if they say we're watching this?
It means they have a Bloomberg.
Seriously? Andrew, stick around. We're going to get a final word from you in a moment. Mike McKee, I know you're staying close as well. You've had a second look at the data going into Friday. What do you see?
Well, of course, we compare ADP to the private sector job creation numbers because ADP doesn't do government. And if you look at what is expected on Friday, the private payrolls is expected to come in at 155. Not a whole lot of strength. That's down from 179 the month before. So ADP has got maybe the direction economists are thinking right, but they are still significantly below that level. So it will be interesting to put those together with government, since government is now still open, and see what we get for a total. Market participants seem to be saying that if we get a real outlying number, that could have an effect on what's been going on with treasuries, and we haven't had an outlier in quite some time.
Andrew, just a final thought here. Is there an incoherence between the JOLTS data that we got yesterday, the ISM manufacturing read that we got, the fact that in general things have been coming in hotter than expected, and even just the direction of these ADP figures?
I think especially seeing that manufacturing was down in these ADP figures is surprising. We've seen those manufacturing PMI ISMs bottom, moving up. Looks like they're going to move up through 50, and we're going to be expanding in the manufacturing sector. So I don't think that negative payroll growth for manufacturing really makes sense with where we are in the economy.
I look, Andrew, you got to go back. You got to write an 8-page paper with your team, a guesstimate forward. And the heart of the matter is the vector of inflation. I mean, within the dual mandate. Do you agree that we've seen 3-month annualized disinflation? And can you state that we've got a generalized vector that is disinflation?
I can't state that. I wish I could state that, but I can't state that. I think what we've seen is a soft patch in inflation. You had a lot of special factors that came together. Auto prices moving down, airfares moving down. Some of those factors are going to go the other direction, and we have a tight labor market.
This is a key insight, John. This is the arch debate on surveillance right now.
240 on Friday still?
Still at 240 on Friday.
Unemployment at 3.6?
3.6 unemployment.
Where's wages?
Wages, we think 0.3%. That's the big question. Ultimately, it does come back to wages. Do we see wages that are slowing down? Or we have them 0.3% month on month? That's kind of holding steady.
How much weight would you put on job openings? Here's so many complaints about that data.
It is not the most high fidelity reading that we have on the job market at all. So, I'm watching the whole mosaic of jobs figures. And if you look at the mosaic, I think it's all telling you it's a tight labor market.
Sounds like an audition for the FOMC, that doesn't it? Andrew, stick around. Andrew Hollenhorst, the city, is going to stick with us. In the next hour on Bloomberg TV, Brian Levitt of Invesco is going to be joining us. Jim Bianco of Bianco Research to weigh in on what's developing in this bond market, and some reaction to the price action as well from Mandy Su. SIBO. Looking forward to all of those conversations in the next 60 minutes or so, next 90 minutes on Bloomberg TV and Bloomberg Radio. Bramo, big turnaround of the bond market then. Yields lower now by 3 basis points. They were much, much higher earlier on today.
Yeah, but they were much lower yesterday when we started the day, and it really depends on what we get from ISM services data that comes out at 10 a.m. It is interesting, though, this stability. Does it lead to more buying because it gives people some confidence that they're not catching a falling knife? There's sort of a psychological aspect to this that we heard from Ann Lingen, who called 10-year treasuries a screaming buy, now doesn't like them because of what's going on, just simply because he thinks that he has a better entry point.
Wasn't that a month ago?
Yeah, that was a month ago. Screaming buy.
I just did a great function, John, the trading envelope in the Bloomberg. We've had a dramatic pullback in yield in the 10-year yield. Guess what? We're still out at 1.9 standard deviations move. It's just a little bit
it's
of
quite
a move there.
It's quite a move.
It's just a non-move.
Downside surprise on the ADP report, 89,000, the estimate 150. From New York City this morning, good morning. Stocks are higher.
climate change are on Bloomberg.
I want everybody committed to the kind of action that we need. We have a global emergency now. You know, we're still putting 162 million tons of man-made global warming pollution into the sky every day, using the sky as an open sewer. That's trapping as much extra heat as would be released by 600,000 Hiroshima-class atomic bombs exploding every day. That's what the scientists tell us, and the data shows it. That's crazy. That's why we have a third of Pakistan underwater. That's why we have the historic heat wave in China. Nothing comparable to that ever. That's why the heat records are broken every year. And we're seeing an increase in the flows of climate refugees crossing international borders that are due to vastly expand unless we take action to solve the climate crisis.
Nobody covers climate change like Bloomberg, your global business authority.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I'm not data dependent. Bramo's data dependent. Welcome to Bloomberg Surveillance. John Farrow preparing for an eventful 9 o'clock hour. Futures up 10. They reverse VIX 20. Fear crisis 19.56. An improving VIX as well. I'm watching 2's10 spread, the vanilla spread, as Andrew Hollenhorst calls it. And the 2's10 spread is rapidly improved, negative 34 basis points as we await, in the 9:45 hour, the 10 o'clock hour, a Michael McKee wall of data. Michael McKee joins us right now to make sense of all this. Help me out at 10 a.m. Bramo will be watching. I won't. Like, what matters at 10 a.m. in this volatile bond market that we've seen?
Well, the ISM numbers are probably going to be the most important thing. Durable goods comes out, a very volatile series, of course, and a lot depends on Boeing. And so that won't get quite as much weight for people in the markets, I think, as the ISM services number. People will look at the headline, but they really want to see, as we did on Monday with the ISM manufacturing numbers, they want to see the prices paid number and the employment number. The employment numbers will help people kind of make sense of ADP here. And we'll see what prices paid tell us, because we had a big drop in prices paid for manufacturing. So is the story that the economy is relatively strong, the labor market is tight, and prices are still going down, which means the Fed doesn't have to do anything else? Or do we see a different story, the converse?
In the soup of employment data that we get this week.
Oh, I like that, soup.
I'm curious. You like soup. I like soup too. Well, yeah, exactly. I'm curious about this idea of the strikes and the labor movement that we've seen, not only in the auto sphere, not only when it comes to what we've seen in Hollywood, but also today, starting with the Kaiser nurses and 75,000 workers who are going out and strike for 3 days. At a certain point, how does that feature into some of this employment data, both not only with some of the jobless claims, but also with respect to wage increases?
Yeah, well, jobless claims are going to start to get distorted, and we're not going to be able to pay a whole lot of attention to them, because you'll have strikers in there. If you're on strike, you can't get claims. You can't claim benefits, but if you're laid off or can't work because other people are striking, you can. And so that's going to distort the jobless claims numbers, make it hard to read anything into that. We won't see really anything in Friday's report on strikes. We've already got the strike report from the BLS, 17,000 people on strike, and even that's overstated because they solved the writers' strike. So the UAW strike won't show up until this month. Now, the nurses' strike does start before the reference month. So if it goes through the week of the 12th in the pay period, including the week of the 12th, then we will see a big impact on the overall numbers. The Fed is going to look through all that. They'll pay more attention to what the settlement numbers are to an extent.
One more question to get you to 9:45 and 10 o'clock. As you know, the Richmond Fed always is written on the history of the country. John Mullen, brilliant on writing about the advent of the Greenspan put. Folks, this is just after the McKee put. And the McKee put was 1998, where they said, oops, there's a problem. And the Fed behaviorally, action-wise, stepped in and changed. Are we anywhere near the Yellen put or the Powell put as we observed yesterday?
Well,
from
that's
the Treasury
kind of the
Secretary?
open question that keeps coming back around in the markets is do people think that the Fed will have to do something? And the Fed is trying to tell everybody there is no Fed put left. We're not going to do that. We're not going to get involved. And anytime we get some market ructions, people start thinking, wow, the Fed will step in. So the only way they can prove themselves is to not step in. And so we'll have to see.
We're going to stagger here to the end of the half hour. We've got 3 guests lined up that are it's all of what surveillance is about. Ralph Ancampora will join us here in about 15 minutes. His brilliant call on a bull market coming out of October. He's truly legendary. Also legendary is Ira Jersey of Bloomberg Intelligence with his work on fixed income. And at our table in New York today, Andrew Hollenhorst of Citigroup. Ira, you're a bond guy. You're hauled into Hollenhorst's office, and he says, what is going on in your market? Talk economics, fixed income guy. What do you say to the economists about the price action in your space?
So a couple of things. First, I want to comment on your question about the Fed put, because I do think that there is still a Fed put. It's just it's way far out of the money, right? So the idea is that you'd really have to see some serious both market pain and economic pain for the Federal Reserve to seriously react. I think in the rates market, the link to the economy is still incredibly strong, and one of the big reasons, and even a bigger reason than has been espoused about is really the much better than expected economic data that we've received. So by our estimates, and we put out a note this morning about the relationship, about 70% of this move can be explained by the better than expected economic data. And I think that that's really important to realize that it's still the economy, stupid, right? That's still always going to be the biggest factor for the Treasury market.
Lisa, I did the work yesterday on DXY and the Mother Star going back to Plaza Accord, and as Ira brilliantly says here, you got to do the work about, okay, where would the stress click in? It's amazing on strong dollar, where all of a sudden the dollar becomes a put. We're distant from that. We really got to move up on dollar strength to get action.
I've been thinking a lot about this, right? And what Ira said there is both financial market stress, but also economic stress. And Andrew Hollenhorst with us here as well. And I'm curious from your vantage point, how constrained the Fed really is to step in and lower rates or to make any actions whatsoever in response to financial market distress. Because in the economy, it is the economy, stupid, and the economy is incredibly strong, and we're still seeing inflationary pressures.
Yeah, like Ira said, there's a bar at which the Fed would come in and do something to stabilize markets. That bar is higher because you have this backdrop of inflation. When you're in a situation where you've run above target inflation for multiple years, which is where the Fed is, and trying to get that back to the 2% target, it's an additional constraint on coming in with any kind of dovish policy movements, dovish policy actions, dovish policy rhetoric. And as you heard just yesterday, some Fed officials saying, Atlanta Fed President Bostic saying, we might just keep rates high for a very long period of time. And that was in the midst of a historic sell-off in treasuries.
So it seems like Fed officials are kind of leaning in almost to what we've seen in the longer end of the Treasury curve. Ira, from your perspective, we've heard one guest after another say they don't want to catch a falling knife. They're not going to want to step in here. They're going to wait for better levels. And they're viewing maybe 510, 525 on the 10-year yield as some sort of entry point. Do you see the same kind of technical signals right now in the market that that's where we're headed, all things being equal?
So 5.3-ish percent, 5.34% is the next really important technical level. And, you have to go way back, Lisa, because as you know, and as Bloomberg's pointed out quite a lot the last couple of days, is that we're at levels we haven't been at since before 2007, right? So when we think about where the 10-year yield becomes kind of a value play, it really becomes, a question as to what is the terminal floor, right? So the big thing that the market's now priced is not just that the Federal Reserve might leave rates at 5.5, 5.75 for the next year, 18 months, but more that when they cut, they might only cut to 4%. Now, I think that's wrong, and I think the market probably is being way too optimistic about that. But when these kind of moves start to gain momentum, they keep going until kind of you go the other way, right? So we haven't yet seen complete capitulation, I think, by long investors, by investors that really want to be long the market here. So the path of least resistance is still for higher yields near term. I think there will be a pretty interesting buying opportunity in the next month or so. But
Right.
it's hard to say that's where we are today.
Pro tip, most important conversation at Citigroup today. It's not Jane Fraser. It's Andrew Hollenhorst, and you're going to wander by crack security analyst Keith Horowitz. And it's going to be a Hollenhorst-Horowitz conversation. And it's going to be about how all of this mumbo-jumbo floats over to the banking system. How do you as an economist synthesize Keith and his team's worry across different capitalizations of the banking structure?
So Keith Horowitz is actually my neighbor in New Jersey, so I run by his house. He comes out the front door, and we talk about these things. So that will probably happen.
Dogs in the neighborhood run away.
Yeah, we're the only two people who want to be in that conversation. But no, I think that's exactly the question we should be asking. With a large upward movement in Treasury yields, fixed income investors are taking losses, and where are those losses showing up, and what does that mean for the different investor segments?
Right.
That is something to keep in mind.
This is gospel, folks, at UCLA, where Hollenhorst studied. Axel Leonowood and that. Forget about yield and all this financial media garbage. It's about price. When do people like you at the Eccles building, like Michael Barr, start worrying about price in bonds?
Yeah, so there's a price conversation, there's a yield conversation. If you look at the price...
And they're two separate.
And they're separate conversations. Yeah, that's right. And that matters. And look at what the Fed has done with the bank term funding facility, for instance, where you can now deliver a U.S. Treasury to the Federal Reserve, $50 Treasury, and you'll get $100 back from the Federal Reserve.
Yes.
Why did they put that in place? They put that in place because they recognize that these Treasury securities have taken losses. There needs to be some kind of backstop for those losses. So it goes back to Lisa's question. The Fed is standing ready to do something if something needs to be done. There's just no indication right now that something needs to be done.
What about quantitative tightening? How much of what we're seeing in the long end is because of that, Andrew?
It's hard to really ascribe this to quantitative tightening in terms of this move, because that's been going on for some time. It's been going on without a big effect on markets, in the sense that you've mainly been draining liquidity out of the reverse repo facility, which is just kind of excess liquidity. But, and it's an important but, as the Fed drains reserves from the system, as quantitative tightening goes down, it means deposits come down at banks. And when deposits come down at banks, it means banks don't have those liabilities to go out and buy assets. What are the assets they're buying on the other side of that liability? Treasuries, mortgages, long duration assets. So that is one natural buyer of treasuries that probably would have come in and backstopped this market. They can't, because quantitative tightening is going on.
Ira, from your perspective, do you think that that's a concern at all for the Fed, sort of the amount of liquidity that they're draining out of a system that has seen an incredible amount of volatility?
Well, I think that the Federal Reserve is concerned about, when will quantitative tightening have an effect on the overall financial system, right? I think there's some people who think that the Fed and want to actually continue runoff even well beyond when when we think that they'll ultimately have to start to ease up on the quantitative tightening. And ultimately it really comes down to how much liquidity does the banking sector need. So our work suggests that sometime in the second quarter of next year, we'll reach the lowest comfortable level of reserves, or what we call the reserve tipping point.
Right.
And once we get there, the Fed will probably just have to stop QT and just reinvest some of their balance sheet. And that goes down a lot. So things like the bank term lending program, when that runs off, that's an extra $100 billion of reserves that immediately go away. So, next spring will be an interesting time period for quantitative easing. But the fact that they stop not quantitative easing, quantitative tightening, but even if they stop runoff, that doesn't mean that they're going to immediately cut, right? And I think they have to then communicate this disconnect between balance sheet policy and monetary policy.
Stay with us. Futures up 12. The Standard & Poor's 500 up 0.3%.
And we are seeing a bit more stability right now in the bond market. 474 down about 5 basis points in the heels of worse than expected jobs numbers from ADP. Of course, that will all get discounted at 10 a.m. when we get the ISM services data, if that comes out potentially in an overwhelmingly positive light.
It's going to be interesting to see. We continue with Andrew Hollenhorst of Citigroup. I'm absolutely fascinated how you do a Q4 look-forward report. Have you taken it from 12 pages down to 7 pages so you don't harm yourself?
I mean, I think you're adding pages here as Treasury yields go higher. You have to start thinking about what is this going to do to the housing market, for instance. So we've seen mortgage rates.
There. Come on, Citigroup is knee-deep in this. I got a 7.88% 30-year mortgage. I've never seen anything like this, and it's all about first-second derivative of fixed income elitism by the Fed. I mean, how bad did they screw up our real estate market with a rate of change and rate of change of the rates?
Yeah, well, and it's very complicated now because we saw 7% mortgage rates. We came off of those 7% mortgage rates lower. Now we're going higher again, and we'll probably get above 8% mortgage rates depending on where 10-year Treasury yields settle down. It's been a strange housing market because that's also been constraining the supply of houses. So we actually have house prices that are rising pretty rapidly because nobody wants to lose their 3% mortgage rate. How that supply-demand works out, very uncertain, and that's making Q4 difficult.
Come back. Lisa, we got to talk about 8.25% Holland Horse mortgage rate.
And also what happens when we actually start to feel these rates because people actually start taking out mortgages. Because right now, how many people are actually paying that?
Generous time with Andrew Hollenhorst of Citigroup this morning. Thank you, Ira Jersey, Bloomberg Intelligence as well. Coming up for those in the equity markets, Ralph Ancampora.
Knife making is almost meditative for me. There's a lot of passion behind it. There's a lot of hard work behind it. And it's not just something that you kind of just brush off like, oh, this is just a knife. People's hands touch this knife. People pour their passion and their soul inside of these products.
The art of blacksmithing has a very long history. Our notion of what it means to be civilized is to have metallurgy, to have the ability to transform the natural world.
When somebody uses my knife, I want them to say, damn! Golly, this is a badass knife.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
We are seeing a bit of a reprieve in bond markets, a bit of calm, I should say, stability after getting a worse than expected ADP report, a better, at least, downside surprise when it comes to a cooling off. This is Bloomberg Surveillance. Tom Keene, Jonathan Ferrer, Lisa Abramowitz, John's off preparing for the 9. I am watching, though, as we watch 473.50 on the 10-year yield go out for decimal points. In decreasing by 6 basis points, Tom. This is just showing the incredible volatility that we've seen in the bond space.
It's been a bond, well, yeah, it's a bond space, but it's more than that. It's, for one day it correlates with foreign exchange, and the next day it correlates with the Red Sox need to improve, whatever. But even with BitDog, I'll leave that to Matt Miller. But the bottom line is we've done all today, folks. We've shifted from a yield analysis. We're forced to look at price. I thought Hollenhorst was brilliant about this. The media doesn't do this. We love the convenience of yield. And Andrew Hollenhorst said in the Bramo space, price analysis is different and discrete from yield analysis.
Because it really speaks to the holders of huge pools of these securities. Talking about price, I wanted to take a look at a couple names that caught my attention. There was a Wall Street Journal report yesterday that said that Netflix was planning to raise prices on some of its ad-free services in the next few months on the heels of the resolution from the Hollywood strike. Basically, some of these strikes are leading to higher costs down the line that consumers will get charged, which I find interesting. Those shares up 0.6%. We've seen similar types of moves from Amazon in terms of raising the fees, not only from subscribers, but also for the platform.
Fees, yeah.
Well, exactly, they can. And Meta, Facebook coming out and potentially charging $14 in Europe for Facebook and Instagram for people who do not agree to certain information sharing systems.
They raised Prime $10. What am I going to do? No,
well, exactly.
I'm going to cancel.
But this is exactly it. They've got a sticky base of customers. They have pricing power, and they have
we're addicted to it.
They have, costs that are going up. Can they pass them along? What we are seeing, at least with initial reports, is they are going to. And this, to me, is one of the underlying fears when it comes to an economic perspective of are we entering something more inflationary, even if we've seen disinflation so far this year?
We have two guests that we really want to speak to in this October. This is away from the bond crisis we see, although we'll get his opinion, all the rest that's going on out there. One of them is Edward Yardeni. He's been doing this a few years, the economist of Yale and C.J. Lawrence of decades ago. And Ed Yardeni, 12 months ago, said, load the boat. Get on board this equity market. With a different approach, co-founder truly of the Chartered Market Technicians and a legend within my world, no question about that. Ralph Ancapora joins right now. Ralph, your call last October was absolutely stunning. Are we still in the Ancapora-Yardeni bull market?
Yes, Tom. Thanks for bringing that up. Last October, it was almost a year ago, October 13th to be exact. From a technical point of view, that was a very, very important climatic day, which led to what we've experienced over the last 12 months, rotation. And I think that rally into June and July was a little bit overextended and was led by the technology stocks, as we know. So we've been going through a correction. But that's the good news. The bad news is that the market doesn't like uncertainty, and that's why we've had such difficulty in the last few weeks because of the rising interest rates, rising oil prices, this chaos in Washington, D.C. So that's what puts pressure on the market near term.
Ralph, Lawrence McDonald is one of the great essays of 2023. And basically, folks, it's a long-drawn Larry McDonald essay on the absolute wall of money that is out there within the global financial system. Ralph, this is different from decades ago. How do you analyze the wall of money that's out there within your technical analysis?
Yes, we watch that very, very carefully because that flow of funds is what moves markets. And if you recall, at the first leg of this bull market, up until I'll say June of last year, June of this year, excuse me, most of that money was sitting on the sidelines. It actually came in late and it was chasing stocks, and that's what caused that accelerated move in June and July, which we're unwinding now. And I think that's a good sign on one hand. On the other hand, we have a test right here as we speak.
There used to be a patience, Ralph Ancapora. When you were on with Lou Rukeyser, there was an understanding you had to have quiet times along the way. The modern financial media is addicted to the emotion and the moment. The great Louise Yamada, years at Citigroup, would talk about distribution. You got to have moments where it's distributed. Do we have that right now? Do we have a point where in the equity markets we're just churning, waiting to get new strength?
Oh, absolutely. I like that comment about distribution. That's exactly what we've gone through in the last month or so. And that's the bad news because it really did a lot of damage to individual stocks. The good news is that October historically has been a bottoming month. And for those who like to look at the S&P 500 and where its moving average is, it's right about here at 4,200. So I think on a very short-term basis, we'll probably get a pop, a little bit of a rally. But I need more evidence to suggest that we've seen the final low.
Ralph, from a technical perspective, are stocks and bonds moving in the same way?
Yes, in the fact that at least right now, with all of the distortion going on, we're having that bit of a camaraderie.
well, camaraderie, and there's a question of whether it's also a feedback loop, of whether that there is some reference in stocks valuations, at least to what we've seen in the bond market. We've heard a number of people come on the show and said, seems like stocks are ignoring the incredible moonshot that we're seeing in yields higher, highest levels going back to 2007. Would you agree, or would you push back and say, actually, most of the stocks have reflected that pretty broadly over the past couple of days?
Oh, yes, I agree with that. I think a lot of stocks have mirrored that, yes.
Do you think that there is sort of a technical level at around 510 to 530 on the 10-year yield? That seems to be what people are looking for the full catharsis that you see as the positive silver lining of this October.
Well, yes, they're saying that, and they're saying that the rates are getting overbought, which they are. And I think that would be the peak, if you will, short term.
Ralph, John Farrell emails in. He's getting ready for his show. And Ralph Ancampora, John wants to go back to 1995. And of course, back then we only quoted the Dow Jones Industrial Average. And you made one of the greatest calls in the history of the market. Take us back to the Dow in 1995, Dow 5000, when you said go long. Is it the same equivalency right now?
What we had then and what we have today, I think, is a little different. We had low inflation, low interest rates in those days. And that was the spur, if you will, of the late 90s. When I wrote the report, Dow 7,000, when the market was around 4,000. And then when it hit 7,000, I raised it to 10,000. And we look back now, we say, well, that was the dot-com bubble. But at that time, we didn't know anything about dot-coms.
Ralph, thank you so much. Congratulations on a great call, folks. We're scheduled to have Edward Yardeni with us here 12 months after the announcement of a bull market. Mr. Acampora on technical analysis this morning. Do you like that Dow analysis?
No, you really are trolling John, huh?
Yeah, well, John just said with Ralph, you got to do Dow analysis.
Oh, yeah.
That's all that existed
very
back
much
then.
in character.
Until the pension consultants showed up, and then we all went SPX, which is a much better index.
All right.
No question about
If you're
that.
going to talk about the Dow actually
33,000.
gave up its gains yesterday in response to some of the sell-offs.
It did.
That's some of the idea of how heavily weighted some of the gains have been to a select number of stocks. The idea of bonds and stocks moving together, I think, is relevant because so many people have been saying, well, actually, including we started the show with Margaret Patel, saying actually stocks can hang in there and continue doing well regardless of what bonds are doing because they can go even lower in price, higher in yields. And that's some of what we were hearing from other people too.
I mean, I'm looking at the Dow, back to the Ancampora call in 1995. Folks, you can do this on an HP 12C while Bramo's going on. Ready? 6.97% before any dividend reinvestment. Back to the Ancampora low of 4,005. I went to 5,000.
It's always fun when I'm talking and I see you looking at a calculator, just absolutely ignoring, and I'm just like, okay.
I can bring a conversation at a bar
to
a
know.
complete That was great. 6.97% on the Dow, back to Ralph's great call in 1995. And our team just fell asleep.
Sorry, I'm looking
Speaking
at my calculator.
of HP 12C, he's going to bring us Monroe trader Bill Gross, 2 p.m. Stay with us.
Breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What would be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird, called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Like, please, like, really actually tune in. I desperately need an audience.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Bad news is good news. Live from New York City this morning. Good morning, good morning. Your equity market just about positive. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York, coming up, the calm after a global bond market storm as a GOP power struggle highlights DC dysfunction and Secretary Yellen suggests higher for longer isn't a given. We begin with the big issue, attempting to catch a falling knife.
Everyone's concerned about catching a falling knife.
A bit of a falling knife right now.
Given the fact that we've seen this sort of precipitous rise in yields.
This huge rise in Treasury yields.
Bond volatility has been the bogeyman recently.
You want to be a little cautious as to adding exposure?
We should have been more surprised if we didn't get this back up in yield.
Bond yields had to reset to this collapse of the recession narrative.
You've had a much more resilient growth environment.
It's really hard to know where we go from here.
The trend in yield is up until the market suggests otherwise.
Something has to happen to make more people want to buy more bonds.
You've got to see something which evidences a material slowdown in the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
Watch really closely for the upcoming non-farm payrolls because that could be the source of downside surprise.
When we start to see the labor market come under pressure, that will turn the tide for sure.
Joining us now to discuss Invesco's Brian Levitt, Jim Bianco of Bianco Research. Gents, let's get straight to it. Treasury's rallying this morning, yields a little bit lower. Jim Bianco, is this a rally that you want to buy as well?
It's too early to say. I think it's more of a reaction that the 30-year hit 5% exactly overnight, and it probably dragged in some automatic buying. But I think that the fundamentals that caused this rally, meaning the end of the recession narrative and the strong data and the concern that we might be beyond the inflation story with the Fed talking about pausing, is still with us. So I would be more cautious on the bond market than thinking that we've hit some kind of peak.
It's super difficult, this one, Brian. How can you have any confidence the sell-off is over when there's so little conviction as to why yields are right up here?
I don't think you need to have absolute conviction that you're getting the top tick on the U.S. Treasury yield. I mean, what I see people doing right now is a lot of money in money markets, and they feel good about getting north of 5% in what they view as a risk-free asset. But I would say you do want to go out further in longer maturity Treasuries, into corporates, into municipal bonds, irrespective of whether you're, capturing the low, the reality is you own these things to generate income over time, and what's presenting itself is a very significant opportunity. I mean, a 2.5% real yield on a 10-year Treasury is a very attractive proposition. So, whether or not you're right on the next 10, 15, 20 basis points in the short term may feel painful, but if you're a intermediate or longer term investor, the ability to compound these yields to me looks quite attractive.
The problem is, Brian, the 2 year's still at 5, the curve's still inverted. I know we've done a lot of work there. It's not as inverted as it was, but given it's still inverted and the economic data's still okay, what's the real incentive to go out along the curve?
The real incentive is the reinvestment risk. And so no one's going to ring a bell. Everyone hears the Federal Reserve speakers saying we're going to stay high for longer. Well, the Federal Reserve doesn't want to ring a bell and have us all feeling like financial conditions are going to ease a lot. So they're never going to tell you they're done. But ultimately, after 550 basis points of rate hikes, by the way, 18 months ago, the Fed funds rate was 0, you're still going to see some of the lagged effects of all of this. So the economy's likely to slow. If you look at the futures market, they expect the Fed funds to be 4.5% by the end of 2024. So that's when the reinvestment risk starts to happen. Typically, when you have an inversion in the yield curve, the economy rolls over and the Fed eases. And people historically have gone to the short rate. And typically, you can look at 2000, you can look at 06, you're better off going long in those environments. Now, again, no one's going to ring a bell. We don't know which day this is going to happen, but ultimately, short rates will start to come down ahead of the expectations that the Fed's going to start to ease.
Jim Bianco, what would you say back to that?
Well, one of the things I'm more concerned about, or am concerned about, is we're anchoring ourselves off the 2010 to 2020 period when the market was unusually low, when real rates were negative, and that might be the outlier. And what we're seeing now is more of a return to normal. There's a line going around that basically we were in a sugar high between 2010 and 2020, and it created the Fed created market and economic diabetes. And now that we're taking the sugar away, we've got a hypoglycemic economy, forgive me for this metaphor. And that what we're seeing happen here is we're looking at these levels and going, they're very high. Real rates at 2% are very high. That's actually the 50-year average for real rates is 2%. It was those rates from 2010 to 2020 that were unusually low.
Jim, I was never going to jump in and cut that off. I was enjoying it. Truly, I was. In the bond market right now, yield's a little bit lower by 5 or 6 basis points on a 2-year. Certainly not the trend over the last couple of days on a 10-year. Back-to-back double-digit gains on a 10-year yield Monday, Tuesday. The data good on Monday. The data good yesterday. It was the ISM manufacturing, then it was job openings. The data this morning, downside surprise with that economic information. Here's Mike McKee. Morning, Mike.
Good morning, John. Well, what is it really telling us? That's the thing you always ask with ADP. They report only 89,000 jobs created in the private sector over the past month, and that seems quite low given the strength in the economy. We'll have to see how it plays out, because over the past year, ADP has overstated the private sector job creation 7 out of the 12 months. So if that follows, then we will have an unusually weak payrolls report on Friday. But hard to square with what we saw from the ISM manufacturing numbers, because ISM went positive and ADP says we lost 12,000 jobs. It all is the thing. All this kind of plays into the bond markets and what is going on. You guys have been talking about it here. If you deconstruct the 10-year, you can see kind of where the issue is. It's not that markets think that the Fed is losing control of inflation, but there is a term premium increase going on. It's not huge, but only about 22 basis points. But it does suggest that there are other factors out there that are influencing traders who are worried about something. What exactly that is, it's hard to say. It makes a difference because the inflation premium is usually thought of as the monetary problem for bond traders, and the term premium thought of as maybe a fiscal problem. Does that mean that people are really worried now about what's going on down in Washington? It could be. Janet Yellen asked yesterday if these rates are going to stay high in this area and keep pressure on the government, which has to spend more money to pay interest costs. And she says the answer is, I don't know. It's a great question, and it's one that's very much on my and the administration's minds. So this is the great unknown at this point, and it maybe comes down to the idea of the Fed raises rates until something breaks. Is something going to break? We don't know what it is. Got to say, John, I love Jim's analogy. And you know, they're treating diabetes now with Wegovy and Ozempic, the weight loss drugs. So we could solve two problems at once.
We could.
I can lose weight and the markets can calm down.
We can feed the bond market or inject it with Ozempic or whatever it is. Mike McKee, thank you, sir. Something did break earlier this year. It was the financials, some of the banks. Jim Bianco, what is going on with the nation's banks? If you pick out two charts, Citi, Bank of America, those charts are ugly. We're trading through the spring lows for many of those names. Jim Bianco, what's going on with financials in America?
Well, I think that they're really stuck with a big profitability problem, and that's from what has been termed the bank walk. People, you know, we have mobile banking apps now, 120 million people a month use them, and they're looking at, you know, deposit rates still around 1%, if not less, and they could pull their phone out of their pocket and they could move to a money market fund and get 5.5%. So you're constantly seeing this bleed of deposits out of the bank. It's actually now banks have lost 10 or 11% of their deposit base in the last year or so, which is one of the largest drawdowns we've seen, and data goes back to the mid-1970s. This doesn't mean that we're going to have a bank failure or that your money's at risk, but it does mean that the profitability of the bank is at risk, and that's why we're seeing these banks start to fall. And yeah, if you're not Chase, it seems like everybody's either wants to put their money in Chase or wants to put their money in a money market fund, and everybody else from the regional banks all the way on up seem to be suffering a lot more.
Bank of America down 22% almost year to date. Brian Levitt, Jim's right to make that distinction. The difference between a profitability issue and an existential crisis. Can we talk about one versus the other? Brian, do you see a risk of a repeat of what we saw in spring? Or have authorities, policymakers done enough to insulate us from that, even with these big monster unrealized losses in the Treasury market?
Well, they certainly helped to calm the situation from where we were in the spring. I think the critical thing is to differentiate, I think, for most investors from 08. This is not a challenge of banks sitting on, you know, significant piles of bad loans that were made. I mean, the capital ratios of these banks look quite strong, but there's certainly likely to be continued challenges at banks with regards to their interest rate exposure and their inability to hedge that exposure. So I wouldn't be surprised to see a few more challenges arise. I don't expect it to be anything severe like we've seen in past crises, but you typically see these tightening cycles end with some type of an accident. We've had a few accidents here, and policymakers have stepped in. I think it would be a surprise to not see a few accidents again emerge with the amount of tightening that we've seen in such a short period of time. It's largely, Jonathan, why I believe that you'll ultimately see interest rates come down. You know, when you get to these periods, there's this recency bias that hits our heads, say, well, it just happened, rates gone up, so they're going to stay up forever. The reality is, you know, what's really changed structurally around the world from where we were during what Jim had called the sugar high, 2010 through 2020. Sure, you know, COVID created some trends towards deglobalization, but, you know, European economy is weak. China and Japan have demographic challenges. U.S. economy still largely in the same place in terms of growth potential. So ultimately, I expect interest rates to come back down. Now, yeah, real yields will be higher than where they were in the past cycle, but I expect rates to moderate as challenges emerge and as the Federal Reserve has to back off its tightening stance.
Jim, what's changed?
I think what's changed might be that we are in a post-pandemic economy, and that's a fancy word for saying that the labor market has changed. You know, remote work is a big thing. Deglobalization has changed. We're seeing energy, especially among Russia and OPEC Plus, being used more as a political weapon. And all of that's filtering into higher inflation. Now, as I like to say, it's not 8, 10 Zimbabwe inflation, and I don't think it'll ever be that. But if it's 3% or 3.5% is the long run rate of inflation, as opposed to 2, then you're looking at like the 10-year note having a 4.5 as fair value. Okay, it's above it now and it's restrictive, but it's not nearly as restrictive as we think it would be if we're still using the metrics of, say, 2019, when maybe the fair value was closer to 2 to 2.5%. So I think what's really changed is this sticky inflation and this long-run inflation rate that I think is closer to like 3, or it has somewhere in the 3 to 3.99 handle on it.
It raises questions about how reliable this bond market is as any signal about where this economy is going with that in mind. Brian, I know you want to jump in, so please do.
If you look at the core personal consumption expenditure numbers over the last 5 months, which of course is the Fed's preferred measure of inflation, and you annualize the run rate, you're looking at about 2.5% inflation, which is very much in line what the 5 and 10-year break-evens are telling us. So what was astutely noted earlier is that this is not an inflation expectations problem. This has been a move in real yields. So expectation that growth, or the reality that growth has been stronger than many people expected, compounded with some of the challenges in D.C. My point is to say that, do I believe that we're going to go into a period of sustained higher growth around the world that would keep real yields at 2.5 or north of that? And I don't. So perhaps you get back to, to Jim's point, more the average real yield closer to 2%, which is why I think interest rates come down from here, because I don't see what the catalyst for higher sustained growth is in the world. Again, I pointed to Europe already likely heading towards a recession, China and Japanese demographics challenged, and the U.S. still largely being the same place that it was from a growth potential perspective, before we even thought of the word COVID.
Hey, Brian, thank you. Brian Levitt, Jim Bianco, you're going to stick with us. We'll keep arguing about this. About 16 minutes away from the opening bell. Futures positive here on the S&P. Let's get you some movers. Here's Abby.
And beneath the surface of those small gains to the upside, John, we do have some bigger movers, starting out with the shares of Palantir, the data collection company, the technology company. It is popping higher on the news that they are closing in on a controversial UK health data contract, basically one that will collect the health data of many folks living in the UK for the National Health Service. Investors, though, like the possibility of that revenue coming in. Intel, in an interesting move, up 2.6%. They are basically spinning out their Altera unit, the PSG unit. They will be seeking either an IPO or a private investor as they continue to streamline and transform their business. And then KeyCorp, you all were talking about what broke a little bit earlier this year. Well, KeyCorp did fall. A regional bank fell 50% earlier this year on the Silicon Valley Bank mess. Now it is trading higher as Wolf has upgraded it to a peer perform on rates benefits.
Abby, thank you. Coming up, a GOP power struggle leading to more dysfunction in D.C.
I believe I can continue to fight, maybe in a different manner. I will not run for speaker again. I'll have the conference pick somebody else.
Team coverage next.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to The Pulse.
This is Bloomberg Technology.
Welcome to Balance of Power. This is Bloomberg.
You all know Matt Gaetz. You know it was personal. It had nothing to do about spending. It had nothing to do about everything he accused somebody of he was doing. It all was about getting attention from you.
It's the benefit of this country that we have a better Speaker of the House than Kevin McCarthy. Kevin McCarthy couldn't keep his word. He made an agreement in January regarding the way Washington would work, and he violated that agreement.
Goodbye, Kevin McCarthy. Hello, uncertainty.
The yeas are 216. The nays are 210. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
Kevin McCarthy ousted from the speakership in a rare maneuver after GOP hardliners revolted over his shutdown compromise. His removal fueling concerns about more turmoil. The House set to hold speaker elections next week, and the next government shutdown deadline looms November 17th. Let's get to the team coverage. Bloomberg's Anne-Marie and Kelly Lyons in Washington, D.C. AMH, who's next?
Well, we're in uncharted territory at the moment, Jonathan. And, you know, what we heard from French Hill early on your program in Surveillance, he was saying only 4% of the Republican caucus voted for this. So there is, you can see that the majority of the Republicans actually wanted Speaker Kevin McCarthy to remain in that position. He's now no longer their speaker, and there's a bunch of names being floated around, and those are the faces right there on the screen. Steve Scalise, he's apparently been making some phone calls, Jonathan. The issue is he has multiple myeloma. This is blood cancer, and he's being treated for it. Now, yesterday in the halls, he said, listen, I feel great, but also, is he too much of an establishment figure? Remember, he was the deputy to Speaker Kevin McCarthy. Then there's Tom Emmer. He's part of the leadership team. You have Patrick McHenry, who is the pro temp right now. He is the interim speaker. His job, his only job right now, is to make sure the Republican caucus can get a speaker that they can get 218 votes around. Other names like Elise Stefanik, and then there's Jim Jordan as well. Now, Jonathan, he told Joe and I on Balance of Power Monday evening before this motion to vacate that he does not want to be speaker and he fully supports Kevin. But now maybe he's going to be looking into it because Kevin is no longer in that job.
Kelly, with all of that in mind, is a shutdown now just inevitable?
Well, of course, we're working against a clock here, Jonathan, a deadline of November 17th. The government funding that was agreed to in the continuing resolution of last weekend that led to McCarthy's downfall in the first place only extends to that date. And the issue is right now we have paralysis in the House. As Anne-Marie was just saying, really the only thing that pro temp Patrick McHenry can preside over is a speaker vote. He can't preside over usual business. And that speaker vote isn't even scheduled to happen until next Wednesday, October 11th. And if you recall, John, the first time around when McCarthy was elected speaker, it took 15 rounds and 4 days to get it done. So we could be looking at a protracted fight here once again, and that will start running the clock, and we won't be working on these appropriation bills. Remember, 12 of them need to be passed in total, and they need to be reconciled with the Senate, and that will be the difficulty for whoever does ultimately get the speaker's gavel, because they're going to have the same issue of trying to reconcile conservative hardliners' priorities for deep spending cuts with something that can pass in a Democratic-controlled Senate, and that job is really tough, as we have just seen play out, John.
What a mess. Kelly Lyons, AMH, to the both of you, thank you. Tremendous coverage, as always, in Washington on Balance of Power at 5 p.m. Eastern Time. Brian Levitt, Jim Bianco back with us. Jim, is there a fiscal risk premium in this bond market?
I don't think there is at this point. Because if you were to look at what a shutdown would be, it's bond bullish. It would either slow the economy, put the economy at risk, or if it lasted long enough, you would actually be talking about less supply because the government would be shut down and wouldn't be spending as much money. All of that should actually lead to a rally in the bond market, but as of 3 hours ago, the bond market had not been rallying through any of this. So I think it's looking past it. And let's not forget that in May, when we were all worried about the default, and last week when we were all worried about the shutdown, we had 11th hour agreements in order to prevent those. So there's nothing to stop us from having another 11th hour agreement around November 17th, maybe another continuing resolution. We did that for entire years in the early Obama administration. We never had a budget. We just went one continuing resolution after another to keep the government open.
Brian, can you connect the dysfunction in Washington with some of these bond market moves? Other people have. Would you agree with them?
I think it's a challenge to do that. I think the bond market has largely been moving on better than expected economic activity. I agree with Jim that, if there is this type of chaos or uncertainty and inability to get spending bills, that would probably lead to some form of flight to safety, ironically or paradoxically. I come back on all of this to the Churchill line. I don't know if he said it or didn't say it, but Americans always doing the right thing, but only after exhausting all other options. So I am very much with Jim on this one. I don't think investors historically have done very well investing based on their political hopes or fears. Far better off watching what's going on in the business cycle, far better off watching what the Federal Reserve is likely to do rather than spend a lot of time worrying about these 11th hour deadlines or these deadlines that we always overcome at the 11th hour.
Let's hope we overcome it again in the not too distant future. Brian, thank you. Brian Levitt, Jim Bianco, to the both of you, thank you. Coming up, the morning calls, and later, Cboe's Mandy Zhu joins us around the opening bout to discuss the impact of higher rates. That conversation just around the corner. Your opening bout, 7 minutes away.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. And it's then the market forces and the business incentives of global companies that transform that EU rule.
Towards the opening bout, just pulling back a little bit on the small caps, but other than that, we're positive here. Bad news is seemingly good news. Apparently, on the S&P, we're up by about 0.1%. That's the price action. Let's get you some morning calls. Your first call from KeyBank, downgrading Apple to sector weight, highlighting the stock's rich valuation and weakening sales outlook. Their stock is negative by 0.6%. Next up, Citi upgrading Leondale Basel to buy, seeing upside as margins continue improving throughout the next year. That stock is up by 2.4%. And finally, Piper Sandler downgrading B&G Foods to underweight, pointing to weakening sales trends and inventory concerns. We're down there by more than 5%. Up next is Cboe's Mandy Zhu, joining us at the opening bout, discussing the stocks and sectors poised to feel the most pain from higher rates. Your opening bout up next.
were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Five of the biggest names in business choose Bloomberg.
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg. Top experts. Great questions.
25 seconds away from the opening bell this morning. Good morning to you. Pulling back yesterday on the S&P 500 to the lows of early June. Trying to bounce this morning by 0.1% on the S&P. On the NASDAQ, up by 0.3. Trying to turn this bond market upside down after the sell-off recently. Trying to rally. Your opening bell rings in New York. Switch at the board and get to the bond market. Your rally in the Treasury market looks like this. Down 3 basis points on a 10-year. 4.76 overnight, breaching 5% on a 30-year yield. And then backtracking. The data good on Monday, good on Tuesday. Downside surprise this Wednesday morning on the ADP report. In the FX market, it means yields down, dollar weaker, euro stronger, 105.14. Call it 105.15. That currency pair positive by 0.5%. Crude backtracking lower, negative after a big rally over the last couple of months. We're down by 2.3%. $87 and about 15 cents on WTI. About 30 seconds into this one on the S&P, we advanced by 0.1%. On the NASDAQ, up by 0.2. One stock to watch at the open is Intel, announcing plans to separate its chip division into a standalone business. The company writing in a statement, we intend to conduct an IPO for the unit and may explore opportunities with private investors. Abby has more. Hey, Abby.
Hey, John. Yes, so we have this story that Intel is separating this purchase from Altera back in 2016, so they haven't had it all that long. It's called the Programmable Solutions Group, or short is PSG, and they're basically going to put it into this standalone business either through an IPO. They will be looking for private investors, as you mentioned, and it's really the shift that we've seen in the landscape. Now, this stock has basically been in a range going all the way back to 2000 between about 80 and let's call it 30 or so, so a very wide range. But unlike most other tech stocks, Intel hasn't put in a new all-time high since the tech bubble. So clearly, investors probably want them to do something to revamp their business. Analysts are relatively positive on this move, saying that it's a prudent move to unlock shareholder value and raise cash. One of our BI analysts is saying something similar, that it bolsters capital resources for the company's pivotal investment in the Intel Foundry business, the quote-unquote North American star. So shares are responding relatively well today, up 1.6%. We also, on the year, have Intel up about 35%. What makes that really interesting, John, I would have guessed that Intel would be underperforming the SOX, or that chip index, but they're actually, right in line there. So the SOX up about 34% on the year. Intel might even be gaining at this point. So investors like these changes that they're making.
Up something like 1% this morning. Abby, thanks for that. Let's turn to big tech. CEO Tim Cook selling more than 500,000 shares of Apple, taking in roughly $41 million and its biggest sale in more than 2 years. KeyBank downgrading shares to sector weight, writing this: U.S. sales are likely to struggle and is still trading at a large premium. Isabel Lee has the story. Hey, Isabel.
Hey, John, that still leaves Apple's Tim Cook with around 3.28 million shares, according to data compiled by Bloomberg. And the share sale this is rare. It came after there was pushback around his compensation. This was announced in January this year when Tim Cook was earning around $100 million in 2021 and 2020. And as a part of the changes, his stocks award tied to Apple's performance will also increase by 75% from 50%. Sticking with Apple, as you said, the company was downgraded by KeyBank. KeyBank is saying that Apple is trading at near all-time high valuations, but its sales growth is likely to slow. In addition, international growth expectations for re-acceleration may be aggressive, and we see the stock softening to around 0.3%. Still, shares of Apple are up around 33% this year, but it has retreated somewhat from its all-time high in July to around 12%. Now the stock is down around 0.3%, John.
Thanks for that, Isabel. Stock a little bit softer. I want to turn to Ford, slightly negative today in early trading. Some numbers from them on third quarter EV sales up around about 15% year on year. This one jumps out. Electric F-150 Lightning sales fell 45.8% in the third quarter. The latest from Ford there. F-150 Lightning expected to produce sales increases in 4Q. Those numbers dropped in the last 30 minutes or so. Let's stick with tech. Palantir has emerged as the top pick for a contract to overhaul the UK's National Health Service, drawing some controversy. Simone Foxman has this. Hey, Simone.
Yeah, John, this was a Bloomberg scoop that came after the bell yesterday. Sources tell us that Palantir, the winning bidder, could be announced as soon as this month. Of course, still subject to some final approvals, some legal arrangements. Now, this is less about the size of this specific contract than the potential for this to be a forerunner of future contracts with governments. The firm's on track for $1.26 billion in government sales this year. This deal over 5 years is about 480 million pounds, so $580 million, give or take. But as you mentioned, it has been extremely controversial. Most of these concerns have focused on data privacy. It was found, and according to leaked documents in 2020, that the company was allowed access to sensitive data about patients, employees, members of the public, things like political affiliations, religious affiliation, past criminal offenses. There was also criticism about the company's attempts to buy its way in to winning this NHS health deal. There was lots of hype in the summer for Palantir shares hitting a peak in August. We've seen that mitigate recently. Still, the name up about 140% this year. We're seeing some enthusiasm here, some positive catalysts up close to 2.9% in trading today, John.
Simone, thank you. Not seeing much enthusiasm with the banks. We all know about the issues we had earlier this year in spring. Let's talk about where we are year to date now. Bank of America's down 22% year to date. Morgan Stanley's off by something like 8 or 9. Citi really struggling. These charts are ugly. We're down about 12% on Citi. If you look at Bank of America and Citi, both of those names are trading below the post-SVB failure lows. KBW Bank Index not doing too much better either going into earnings season. 2 Fridays away, it kicks off with JP Morgan results. We talked a lot earlier this year about unrealized losses in the bond market. I can tell you in the Treasury market, if you're sitting on any of those bonds, those unrealized losses have got a whole lot larger. Wolf Research upgrading KeyCorp to peer perform with this to say, at least some good news on this front. We now see a greater likelihood of higher for longer rates extending well into 2024 and expect shares to enjoy greater tailwinds. Katie Greifeld joins us for more. Now, Katie, I think this raises a really big question. Are high yields good or bad for banks?
Maybe when it comes to net interest income, and that's really the basis of this call. KeyCorp is rising a little bit after that upgrade to peer perform, and Wolf basically sees KeyCorp catching up to its peers. Other banks, they did benefit earlier in the cycle from rising rates in terms of that net interest income before those higher rates became a little bit punishing. And that tailwind, though, it was relatively muted for KeyCorp due to the bank's hedging activities, but Wolf now expects that KeyCorp's 2024 results will be materially higher relative to its prior expectations. You can see that's giving a little bit of a lift to shares, but as you laid out, John, it's been an absolutely bruising run for these bank stops. The KBW Bank Index, just zooming out a little bit, it's dropped 16% from the start of August, of course, as yields continue to soar. It's down more than 25% so far in 2023. A lot of those losses coming in March. And if you take a look at KRE, that's the regional banking ETF, it's sitting on 32 2% year-to-date losses. And I'll point out, John, that short interest on that ETF is back to levels that we last saw in March.
Wow. Katie, thank you. Thanks for the update on all of that. The spotlight back on the financials, the spotlight back on the banks for all the wrong reasons going into earnings season. Looking ahead to JP Morgan, 2 Fridays away. The week after that, you hear from Bank of America. Let me get you another view on the south side. This from Evercore, weighing in on the banks ahead of those results, saying this: we expect third quarter results at the banks to reflect a leap out of the frying pan and into the fire. The rising 10-year yield is putting unrealized losses back on the radar. Think about where this bond market has been. 150 basis points higher from the lows post-SVB, 150 basis points higher from something like 330 all the way back up to something like 480. Joining us now to talk about some of this, Mandy Zhu of SIBO Global Markets. I'm pleased to say she joins us now. Mandy, let's talk about it. Is this bond market move we've witnessed over the last couple of months enough to wake up the VIX?
So my short answer is going to be no, not necessarily. And the reason for that is what is driving bond yields higher this year is very different to what was driving it higher last year, right? So last year it was very much about runaway inflation. It was very much about aggressive Fed action, potential over-tightening leading to recession. And that's why if you look at the yield curve, what was driving rates higher last year was the front end of the curve. And even as traders were pricing in more aggressive Fed action, they were also pricing in very steep rate cuts coming down the line as well because of lack of confidence in the economy. This year, fast forward to now, what we're seeing is very much actually the yield curve move is very much driven by the back end, right? Not inflation has come down, the labor market has remained resilient. People have become more confident in the Fed's ability to hold rates longer, higher for longer, and as a result, these are all very positive factors for equity markets. So to me, at the index level, this is not the catalyst to really drive VIX into a much higher regime. But underneath the index surface, at the stock and the sector level, I do believe higher rates will continue to drive those gyrations and the rotations underneath the index surface.
Mandy, as you know, I've read your work for a long, long time. This word that often pops up, dispersion. Can you walk us through what dispersion actually means and what you're seeing currently?
Yes, so dispersion is a very fundamental measure of just how much stocks are moving relative to each other. And the reason why this matters is, if you think for an equity investor, long-short investor, dispersion essentially tells you how much alpha there is to be had from stock picking, right? In a low dispersion environment where there's not much variation between the stocks, there's not much P&L that you're going to be able to generate from stock picking. In a high dispersion environment, that's going to really start to grow. And what's really tricky is that dispersion as a risk metric has historically been fairly hard to track and fairly esoteric. So what we've done at SIBO, actually, we launched last week a dispersion index. So the S&P 500 dispersion index, ticker DSPX, that's going to allow investors to track dispersion in a very transparent, easy to follow way. And importantly, just like the VIX index, it's a measure of implied dispersion. So how much dispersion market expecting for the next 30 days going forward.
So Mandy, let's finish up with this one. Favorite idea right now, what are you advocating for?
So I do, again, like going back to kind of the fundamentals, I do still think this is going to be a sector rotation market. It's going to be a strong stock dispersion environment. To me, really for those looking to play that upside in the VIX, you're going to need an unknown catalyst, right? But if we go back to the VIX, one thing that I've been highlighting that we have seen in terms of pickup in activity is those buying of those upside calls. People are starting to get nervous in an environment where VIX is kind of in the mid to low teens, or despite the pop recently, starting to get nervous that the soft landing narrative is becoming too complacent. So we have started to see very strong pickup in activity in those VIX upside calls. But to me, to get that VIX pop, you need something more than just higher rates, because that is still very much a fundamental catalyst. It's not a macro catalyst that's going to drive volatility higher.
Mandy, thank you. Let's catch up soon. The latest from Mandy Zhu there of SIBO. About 11 or 12 minutes into this session, equities up here by 0.3%. On the NASDAQ up by 0.6. Big downside surprise on the ADP report. A little more data a little bit later. We'll get a PMI and ISM services read for you in about the next 20 minutes or so. Looking at the bond market, post-ADP report, yields dropping down about 4 or 5 basis points on a 10-year. Let's call it 475. I think from the higher the session to the lower the session, we've had a range of about 15 basis points on a 10-year yield. still some way to go to get through today's trading day with a few more data points still to come. We'll catch up with Mike McKee in just a moment. Coming up, strikes emerging everywhere.
The reality is there is a real wage pressure problem, and this wage story is a big thing. Everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
That conversation up next.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority. This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
On the next episode of
The reality is there is a real wage pressure problem. And even though there's a smaller percentage of the economy is unionized now than back last time we had a significant wage-related issue in the economy, the fact that we have 24-hour a day, 7 days a week, 365-day-a-year financial press, and they're looking for things to talk about, and this wage story is a big thing, everybody hears it all the time. So that helps drive the momentum behind, yeah, I deserve to get paid more.
They're going to hear more about it now. Here's the latest. Ford delivering a sweetened offer to UAW leaders, including a wage increase of more than 20%, a deal that would launch its workers into the top quarter of all U.S. jobs. The Ford CEO, Jim Farley, writing this: "We've put an offer on the table that will be costly for the company, given our large American footprint and UAW workforce, but one that we believe still allows Ford to invest in the future. This is Ford and GM lay off about 500 more employees, citing the expanded strike, now in its fourth week." Let's get the latest from AMH in Washington. Morning, Anne-Marie.
Good morning, John. What we're seeing here from Ford is they're saying this is their 7th and strongest offer to the UAW, especially that 20% wage increase. The issue is our Bloomberg News colleagues have reported that these UAW workers do not want to emerge from a strike without a baseline of a 30% wage increase. So will this be enough? Also, we have been discussing on this program a lot the issue of the electric vehicles and the fact that this is the bedrock of a lot of anxiety and consternation within the UAW. And this is what the Ford CEO had to say about that. Quote, while Ford remains open to the possibility of working with the UAW on future battery plants in the United States, these are multi-billion-dollar investments and must operate at competitive and sustainable levels. So they kept their position on they will be willing to work with the UAW on potentially some of these jobs, but at the same time, they need to make sure that they are a profitable company. That's what it looks like for Ford, Jonathan. This does look like a strong offer. We do not have a response yet from UAW. But look at what GM is doing this morning. They need a $6 billion credit line. For me, that says that GM is expecting these strikes to go on for longer, and it sounds like it's going to be painful.
MH, thank you. Mike McKee, let's talk about further strikes as well, not just UAW, but Mike, we've also got strikes in the healthcare sector today.
Yeah, and they're not going to show up in the jobs numbers on Friday because the BLS has already put out its strike report, and they find only 17,000 workers on strike, none from the auto companies. And of course, the nurses just went out today. So look for October data, the first week of November rather, to reflect that. But at this point, it doesn't look like we're going to see a lot of impact on hiring. We will see the impact on jobless claims in weeks to come, however. We also have a couple of numbers here that just came out, John. The Standard & Poor's Global Services PMI and Composite PMI. They are essentially little change. The Services PMI goes down a tick to 50.1, and the Composite goes up a tick to 50.2. They are suggesting things are positive out there. But let's wait till the top of the hour. We get that ISM Services Index. Everybody's going to be looking at the jobs numbers because in the manufacturing numbers on Monday, we saw a gain over 50%, so over 50. So that suggests expansion again in employment in manufacturing. And in services, we'll see. That may have more of an effect on people in the markets if we get a big number than ADP did this morning.
Mike, let's talk about the data so far this week. ISM manufacturing on Monday. Tuesday, they had job openings coming in much higher than expected. Big downside surprise on ADP this morning. We always talk about the mosaic of the data. I think Andrew Hollenhorst, the city, was talking about that, Mike. How much weight would you put on each data point we've had so far this week?
I think people put the most weight on the ISM numbers. They tend to reflect a little bit better in a directional sense where we are. The ADP numbers don't have a very good correlation with jobs anymore, and they don't pretend to. But we do know that ADP has come in stronger on private payrolls for the last 5 or 6 months in a row than non-farm payrolls. So we could see maybe a weaker number, but hard to really put a lot on that.
Mike McKee, thank you, sir. The latest on the economic data. If you missed it a little bit earlier, 89,000 was your downside surprise on the ADP report. The number we were looking for, 150,000. 150K was the median estimate in our survey here at Bloomberg. So that's a big downside surprise. As Mike McKee indicated, for some of you I know, it's almost like the bad tasting appetizer for the payrolls report. Comes early just before it, but maybe it doesn't really give you a guide to what you're about to get afterwards. Speaking of what you're about to get afterwards, payrolls on Friday, the estimate at the moment could change between now and then. 170,000 currently. That's the estimate. The previous number, 187. For the broader price action, we look like this about 21 minutes into the session. Your equity market on the S&P 500 just about positive by 0.2%. On the S&P, on the NASDAQ up by 0.5. This after that downside surprise on the ADP report triggered a bit of a bond market rally for Treasuries. Real turnaround. Think about it. The 30-year had gone through 5% in Asian trading, then turned all the way back around again. It's down about 4 or 5 basis points to 488. The 10-year yield was having a little look at 490, just short of that level earlier on today. The 10-year now 475, down about 4 basis points as well. Let's get you some broader sector price action. We can do that with Abby. Hey, Abby.
Hey, John. Well, with just a small gain for the S&P 500, we do have more sectors trading higher than lower, led by consumer discretionary. Amazon, a big boost there, up about 1% on the day. Materials, tech, communication services, real estate, utilities, and consumer staples all higher. To the downside, energy down 2.4%. There's been a stealth $7 drop in oil since last Thursday, John. WTI crude is now at 86, 87 or so, at least stealth to me. It's going to be interesting to see how that plays out for the risk assets overall. And then if we take a look at what you've been talking about all morning, weaving it into the story, the banks, the regional banking index on the year, basically near those March lows after the blow up of Silicon Valley Bank and some of those other regional banks, down 27% right now if these declines stay in place. And actually, I should say the year-to-date decline is actually 33%. The chart we're looking at, down 27%. The worst year ever since this ETF has been in place since 2007, John.
Brutal stuff going into bank earnings, as I've said repeatedly, kicking off on October 13th. Friday the 13th, 2 Fridays away, with JP Morgan results just around the corner. Coming up next, we'll get to the trading diary. The calendar absolutely packed going into payrolls on Friday. I'll give you a sneak peek up next.
'Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
Minutes into the session, equities higher by 0.25% on the S&P 500, rebounding this morning as we start to rally in the Treasury market. Get to Treasuries, 2s, 10s and 30s lining up as follows. Your 10-year, higher the session, just short of 488, right now down 5 basis points to 474, following that downside surprise on the ADP report. At the long end of the curve on the long bond, the 30-year, very briefly, just north of 5%, all the way back down about 6 basis points on the day now to 486. The turnaround, the data at the epicenter of it. More economic data still to come. That's the price action. Here's your trading diary. Coming up very shortly at the top of the hour, ISM Services, along with Fed Speak from Bauman and Goolsby. Then, a little bit later, we'll get opening arguments expected in the Sam Bankman-Fried trial. Thursday, another round of jobless claims and more Fed Speak from Mester, Barkin, Daly and Barr. And Friday, it's your payrolls report. It's just around the corner. And your estimate currently is about 170,000. From New York, that does it for me. Thank you very much for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.
Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. The markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays. From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy.
It's 30 minutes into the U.S. trading day, Wednesday, October 4th. Here are the top market stories that we're following for you at this hour. Unstoppable yields. The Treasury sell-off takes a break after the 30-year yield makes a run for 5%. We have an all-star lineup for you. Jenny Johnson, the head of Franklin Templeton, Afsaneh Beschloss, the CEO of Rock Creek, and Richard Clarida, PIMCO Global Economic Advisor and former Federal Reserve Vice Chair. And you got Washington dysfunction. The House voting Kevin McCarthy out, leaving the chamber leaderless as the clock counts down to another potential shutdown. And spending boom or bust. ISM Services data drops right now. We get the instant analysis with Anthony Nieves, ISM Services PMI Chair. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Okay, ISM Services, what do you got?
Okay, it's a little higher than anticipated. It does drop from 54.5 to 53.6, but we were expecting 53.5. The component parts are, as always, where the interest lies, Alex. Prices paid sticks at 58.9. That's inflation, that's sticky inflation within services, which is interesting. Employment, though, dips to 53.4, but it's the new orders component which really is where the action is. We drop from 57.5, Alex, to 51.8. Is the summer boom finally over?
Right, and is that a good news? Is that a good news thing for the markets? I'm just looking at the 2-year, sort of staying right there. You have some buying in. You have yields down by about 5 basis points, so no real dramatic movement based on that. Stocks are still mixed, as we saw. Tech still leading the way. Is it a weaker news is good news, Guy?
I don't know. I think this is. No, I think you got to break it down. You got to figure out exactly which bit you want to focus on. The prices paid number is still quite elevated at 58.9. Remember, everything north of 50 is a solid number. It's a really solid number. But we dip on new orders. So we've had this really strong summer, and now maybe we start to see that fading a little bit. Well, let's try and figure out what the answer to all of these questions are. Anthony Nieves is the ISM Services PMI Chair. Joins us now to walk us through the data. Anthony, give us the instant analysis. How should we be reading this data?
Well, looking at the report, and yes, we had a slight pullback month over month, but even with the new orders coming down as much as it did, this sector still looks strong going into the last quarter. The new orders at 51.8, that was driven mostly by retail industry in September, or I should say into August. So now we're looking at this last 3 months, this last quarter, from what our respondents are telling us, that they're still on track for finishing up the year pretty strong.
Why? I know this is such a dumb question, but why?
you touched on it earlier. We had a nice summer boom. People were spending money on experiences. Now we're starting to see a shift into more commodity purchases as we get closer to the holidays. But again, employment looks good. As employment goes, that's how this sector goes. And even though it had a slight pullback of 1.3%, most industries are indicating that things are still boding well for the sector.
What are survey respondents telling you about the availability of labor right now? We are coming through the summer. Maybe we start to see a little bit of a fade on that front. But what are they telling you about the strength of the labor market?
Continues to be a mixed bag by industry, but overall, they're saying it's still very competitive for employees out there, and that certain industries have pulled back and are managing that variable expense, that labor expense. But overall, it's still a tight labor market.
So what's the net of that? Like, is this just where we stay? Is it really going to be then incumbent on the manufacturing number to start climbing towards 50 and services just kind of stay sticky right here?
I think we're going to see incremental growth through the rest of the year from the services sector. To your point, I'd like to see manufacturing continue to rise and get above that 50 baseline across the board. It looks like it's starting to get that way. But for services and what comprises this sector, I think we're going to see this path. And September is typically the pivotal month, and I think we actually accelerated that, and we saw it more in August than September.
Anthony, if you were looking at this and trying to discern whether or not the disinflationary trend that we're seeing in other data are going to continue, is this trend going to continue, and are we seeing this sort of immaculate slowdown? What would you say to those people that believe that we are in a kind of soft landing scenario? Is this data consistent with a soft landing?
Right now it is, but to your point about pricing, we're still seeing high fuel costs, right? And fuel pricing, especially with the reliance on overland trucking, disparate that we have in the services industry, that's a big factor. It also affects all the petroleum-based products, and food products are still strong as far as pricing is concerned, and there's still some availability issues.
Anthony, before we let you go, why haven't the strikes impacted this survey? I mean, you had screenwriters, you had actors, now you have auto workers, now you have healthcare workers. Where is it in the survey?
Actually, arts, entertainment, and recreation, that industry has been impacted. They've had contraction on the employment side. And you have to look at this composition of all these industries. Arts, entertainment, and recreation is a small percentage. It's less than 10%, in the lower percentile range compared to the big contributor in this sector is the real estate rental and leasing.
Amazing. Real estate still holding it. Hey, Anthony, we really appreciate it. Thank you for the instant analysis. Anthony Davis, ISM Services PMI Chair. And you are seeing yields kind of pair some of their losses here. You have yields down just 3 basis points versus 6, but nonetheless. All right, coming up, it is our question of the day. What are you feeling right now? Is it fear or greed? And then how do you invest? Afsana Beshlas is the CEO of Rock Creek. She joins us next. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg.
Everyone's concerned about catching a falling knife.
A bit of a falling knife right now.
Given the fact that we've seen this sort of precipitous rise in yields.
This huge rise in Treasury yields.
Bond volatility has been the bogeyman recently.
You want to be a little cautious as to adding exposure?
We should have been more surprised if we didn't get this back up in yields.
Bond yields had to reset to this collapse of the recession narrative. You've had a much more resilient growth environment.
It's really hard to know where we go from here.
The trend in yield is up until the market suggests otherwise.
Something has to happen to make more people want to buy more bonds.
You've got to see something which evidences a material slowdown in the economy.
Only do you see the yields start to come down once you see visible signs of economic slowdown.
Watch really closely for the upcoming non-farm payrolls because that could be the source of downside surprise.
When we start to see the labor market come under pressure, that will turn the tide for sure.
Those were some of the guests we've had on Bloomberg TV discussing the threat around rising yields. You're looking at the 2-year 5.11. It brings us to the question of the day, though. What are you feeling? Fear or greed? And what does that mean then for investing? Joining us now, Afsana Beschloss, CEO at Rock Creek, a global investment firm with more than $16 million in assets. Afsana, it is so wonderful to see you and get your perspective. What do you think, fear or greed?
Great to see you, Alex. I think we're moving closer to neutral. I think all along in the first part of the year, no matter what numbers were coming out, and as interest rates were going up so fast, the equity markets were holding up, and everyone was wondering at what point would they slow down, where we have seen the last few weeks that eventually interest rates have caught up. And I think where we are now is closer, I would say, to a neutral. I wouldn't say, sort of a big emphasis on fear or greed at this moment. But what is really interesting, Alex, is the emphasis for investors has suddenly moved from equity markets to bond markets. Everyone is getting a new tutorial on bond markets.
How many more lessons, Afsana, do you think they still have to learn? It's Guy, by the way. Nice to see you too. Do you think what else do we need to learn in this narrative? How high do you think yields can go? What do you think is driving this yield move?
Great to see you, Guy. Also, I think what is going on, obviously, is huge amounts of debt that has been issued by governments, by corporations, by everybody is there. And we also know that a lot more debt will have to continue to come out into the markets. We also know some non-US investors in our bond markets have slowed down their purchase of our bonds. At the same time, we are the news, the political news, whether it is Speaker McCarthy's news last night or other news coming up potentially with government shutdown next month, are not really helping markets. So they are creating what I would call more of uncertainty for investors. And that is certainly pushing people, one, into more bonds, and two, to the longer end of the duration of bonds.
Ironically, right? Afsana, so what is the best strategy? I mean, do you just buy the long end and sit and hang tight and sell equities? Like, how do you deal with all this?
I think lesson one for investors always has been to be diversified because, again, there are so many things that could happen between now and then. We could get inflation numbers getting much more moderate, and this long-term impact that we've been expecting happening sooner over the next few months. If the Fed does not increase rates, which it probably won't in November, and possibly not in December, a lot of what we fed into the market was the change in the expectation that Fed would only have maybe 1 or 2 or 3 reductions in rates next year versus 4 or 5, which had been the original expectation. Those expectations can change very fast, and then you want to be diversified.
Afsana, a lot of people have diversified into real assets. They've diversified into utilities, and people have looked to the climate change story and tried to figure out whether or not they're going to get a decent yield, off that story. How do you invest in things like utilities and climate transformation technology at a time when you're being offered 5% in a money market account, triple C's are offering you circa 14%. You're getting some really good yields, you could argue, in some places like that. Why would I want to put money into climate change?
The reason you want to put money into climate change is really what we're seeing every day in our day lives, right? Whether it's a flood or a fire or all the things that are going on, are pushing people to look at alternatives for their energy sources. Obviously slower than what we expected. However, the big push of the infrastructure money that is coming in from the government as well as the IRA is actually starting to be felt, and probably much more money will be pushed into the markets next year. So the momentum will be there. You also are seeing people's habits changing, whether it is buying EV cars, whether it is for the big utilities, as you said, who are investing in new parts of their software, let's say, to be able to take on solar energy versus just coal and oil.
But everyone's cost of capital is going up pretty hard.
Yes.
What does break, though?
By the way, cost of capital going up affects oil and gas also. Oil and gas industry have to make huge capital investments in order to maintain existing production plus new production coming on stream. So it's not a question of one needing investment and you only look at sort of investments needed on the renewable side. We certainly would need investments also on the traditional side. And I think the question is on the renewable energy side, there might be a lot more opportunities of smaller capital investments, allowing people to diversify their sources of energy much faster than the huge amounts you need for the very large oil and gas projects.
Afsana, it's been great to catch up, and this is an area which you're hugely interested. Afsana Beschloss, the CEO at Rock Creek. Thank you very much indeed. Still ahead, talking of restructuring, Scandinavian airline SAS paring its losses after the company announced a restructuring deal that will take it private. It wasn't what we expected. We're going to talk to the CEO, Anke van der Werf, the SAS president and CEO, joining us next. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
let's talk about what's happening in the airline sector. SAS, the Scandinavian carrier, its shares taking a little bit of a hit earlier on today. The airline announcing details of its financial restructuring that surprised many people. It's bringing on board new investors. It's wiping out the stakes in over 250,000 owners that were invested in the business. Basically, shareholders are being wiped out here. We're joined now by Anko van der Werf, the SAS Group President and CEO. Anko, everybody expected when we got the details of the restructuring plan that you were going to put forward and the capital raise exercise that we were anticipating, that it would be led by Apollo and that we'd probably see the Danish government being involved. Instead, we've ended up with Castle Lake and Ben Smith at Air France leading the charge. Anko, why did you decide to go down this route? When did you start talking to Ben? How did this come about?
Well, the answer is actually quite simple. When you look at the Chapter 11 process that we're in, Guy, it really, what matters is highest and best, right? So you have to, of course, get a deal to closure. And so what we've done under the supervision of the board, of course, is run a very extensive, very broad and deep equity solicitation process over the last months. And the outcome is, as you rightfully so said, a very strong consortium that we feel, the Danish stake, 25%, plus a consortium consisting of Castle Lake, Air France KLM, and Lind Invest from Denmark.
What does Ben Smith bring to you? We all know Ben. Well, he's an expert in restructuring. Does he bring that skill set to restructuring that you are now going to continue to do at SAS?
I think for us it's something really far more vital. When you look at SAS, of course, it's really very strong in essence, very strong markets, strong economies, Norway, Sweden, Denmark. We have, of course, access to really good airports here as well. What we still lack is parts of that globalization footprint, right? We are not part of joint ventures, for instance, and we have not been able to really tap into those over the course of history. So I think one of the real things that for us is very exciting is through these partnerships, eventually, because let's take this step by step, right? The Air France KLM portion of the equity is 19.9. So we're not talking about controlling stakes here, but definitely for us, one of the big benefits would be, hey, bigger network and having that, globalization impact.
My understanding is that Air France does have the option, though, further down the road in 2 years' time, to take a greater stake if it wanted to. How are you going to work the exit, which I'm assuming is coming from Star Alliance, into SkyTeam? Is that what is going to happen here, and does that happen when potentially Air France takes control? You talk about the global footprint. If I'm one of your customers right now and I'm a Star Alliance customer, how am I feeling? What's going to happen to my skin in the game here, the points I've built up with you? How is this all going to work, Anko?
Yeah. So first and foremost, let's take this really step by step, right? Nothing is going to change overnight. We are, of course, a very proud founder, in fact, of the Star Alliance, and we have very deep personal and professional relationships with, of course, the Star Alliance Airlines. We will honor, of course, everything that we stand for with our customers and for our customers, and we also expect Star Alliance to do the same. And so there will be, of course, a path in which we'll provide that full clarity. Secondly, this deal, right, the transaction where we announced yesterday the winning bid, what we now need to do is get to an investment agreement, right? We still need to get to that official formal investment agreement and need to file that with the US court, and that will take a number of weeks, right? So at least in that number of weeks, we, of course, need to sit down and see also with the individual Star Airlines and very much also with SkyTeam what those next steps are. We are really, after this long and extensive equity solicitation process, the best and highest is that bid that we have right now, and we're very excited to take that forward.
Ankur, hi, it's Alex in New York. Just a broader lens here. You guys have been through a lot in the last few years. You're finally getting to emerge here from bankruptcy. You have government shareholders now finally out of the business of SAS. And meanwhile,
rates are going bananas. Everyone's worried about what's going to happen in the credit market and defaults, etc. How do you see this evolving over the next few years? Bring your lens of what happened to you over the last few years into what you expect to see in the next few.
Yeah, this industry, look, I still think that there is something coming our way for some of us that really haven't fully restructured. I'm happy that we did. I still think that we did some of it too late. I think it would have been better if we do that immediately going into COVID. But I still see a lot of debt. I still see very challenging environments, I think, on the whole. I don't think we've seen, in that sense, the end of COVID yet for our industry and maybe even for the broader ecosystem. I'm really not sure. I've not done that analysis in detail, but I do think that we haven't probably seen really the end of, call it, restructurings in that sense, and whether that's light, deep, soft, hard restructurings, that remains to be seen. But I think you get the point, right? I mean, I don't think we're still there. In the case of SAS, again, happy. We are really now starting to turn that corner because, as I said, restructuring started maybe a bit too late. We've done it now, and yesterday's announcement, right, announcing 1.2 billion, of course, for us in a transaction, and really finding those investors and that stability in that group of investors, that, of course, is fantastic news for us.
With your outlook, tell me what you see about business travel coming back, and what do you see in terms of actual demand? The South got really hot. Are we going to see summer vacations now move to Norway? Walk me through what you see.
Well, we do see, actually, all of the above almost. We do see that people have prioritized travel, right? Since COVID, really, it's been somewhat extraordinary, if I may, right? I mean, people are still prioritizing. That demand is definitely healthy. What I do think we're seeing is that corporate travel, that has changed. I do think so. It will come back to 100. It will, of course, at some point make its way back to 100. But it's not there, and leisure is leading the way. And within leisure, you do see premium leisure being very healthy. We have seen that this summer, for instance, in search engines and also in our own traffic, that there was a very remarkable pickup from south to north, right? Which is of course, if you look at it from a historical perspective, rather unusual, right? Everything, of course, is north-south in the summer, but this summer there was definitely more going up north, and I think we'll see the same thing also for winter seasons when skiing here is pretty much guaranteed.
Anko, very quickly, I've got 30 seconds left. Do you think Air France's interest in you means that they're not interested in TAP?
That is absolutely a question you should ask Air France KLM. I can only, of course, say that we're very happy with where we stand right now. We work very hard together with that investment consortium to make sure that we get to that final stage. We of course, see what's right the next few weeks bring. We need, like I said, we need to bring that investment agreement to a close. And yeah, I do think that European consolidation, we've waited for it for very long, but it does really seem to take off now.
I try and ask them that question. Do I always get a response? No. Anko, great to see you. Thank you very much indeed. Anko van der Werf of SAS. This is Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point! From the pickleball courts of Arizona
to the kabaddi tournaments in India
to the cornhole boards at your local tailgate. This is what's next in sports.
From New York City,
in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone. Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
We're about an hour into U.S. trading session. ADP kind of disappointed a little bit, I guess. Like, it showed the jobs growth was slowing. ISM services, though, still coming in really strong. Abigail Doolittle is tracking the moves for us. It's a little conflicted here.
It is a little conflicted, and so are stocks showing that, at least on the week, Alex. And on the day, too, we have the S&P 500 moving between small gains and losses. Some of the other indexes mixed, too. But you can see clearly on the week, especially yesterday, there was a decline. At one point, the S&P 500 yesterday heading to its worst day since March 7th, closing off of those lows. But nonetheless, I think that this puts the S&P 500 on pace for its fifth down week of the year and the longest weekly losing streak of the year, which means that the superlatives of September and the third quarter, well, they're continuing right into October. Beneath this surface, and today it really is a relatively more flat surface, at least right now, these are two of the stocks that are gaining. It's not really clear why Tesla is up 2.1% or Amazon up 1.3%, but big heavyweights to the S&P 500 and the NASDAQ 100 helping out. To the downside, though, and this is a little bit of a surprise to me, I didn't really watch this too closely, but oil has gone from a peak last week of $95 per barrel, WTI crude, down below $87 per barrel. It is, of course, a risk asset, maybe not a good tell on the economy. Over the longer run, if it continues to decline, though, it could take off some inflationary pressure. Let's see. Now, let's putting all this together for the S&P 500. Let's check in on a chart that we've looked at many times. This is a chart that is working for the bears. This is this year's uptrend. There is still an uptrend. You can see that with these moving averages climbing. This is the area of consolidation that we watch very patiently. We have clearly snapped below the consolidation, and yesterday we were about 20 points away, and we still are, frankly, from that 200-day moving average on the S&P 500. The RSI is in oversold territory, but until a series of highs come in, it suggests that we could continue to see more selling. Guy, the Russell 2000, of course, is well below its 200-day moving average. The equal-weighted S&P 500, both of those indexes down on the year. It seems only a matter of time before the S&P 500 and the NASDAQ follow suit, and the long-term buyers get away, move away, at least for the near term.
We'll watch with interest to see how that develops. Abigail, thank you very much indeed. Okay, let's return to our question of the day. How are you feeling? What's going on? If you were to talk about an overriding emotion right now, is it fear or is it greed? Let's ask that question now to Richard Clarida. Rich Clarida, PIMCO Global Economic Advisor and, of course, former Federal Reserve Vice Chair. Rich, great to see you. How are you feeling? What's the overriding emotion right now? Fear or greed?
Well, let me talk about the market. I think there's certainly an element of fear, and as always, there's greed. I think it's important, as you're thinking about this sell-off, I think there are four potential factors. As always, there's the Fed, there's the macro data, there is fiscal, potentially, and there are technicals. Most of this sell-off, really, since the Fed, has really not been on Fed news. I think it's been a reflection of concerns about fiscal, a higher term premia, And of course, fiscal dysfunction in Washington never ceases to disappoint. So I think there's a lot going on here.
Does this mean a higher neutral rate, Rich, and sort of the echoes of that?
Well, it could, Alex. I think at PIMCO we try to distinguish between like a neutral bond yield on a 10-year and the neutral federal funds rate. We do think we're going to be in a world eventually of steeper yield curves, but there's no doubt that in a world where government debt's north of 100% of GDP and we really do not have a consistent fiscal policy in the U.S., we're going to probably be in a world of steeper curves for sure.
The neutral rate, always interesting to try and see it with hindsight. Rich, what we can certainly observe right now is a very fast move. Do you think the Fed's going to be comfortable with the speed of the move that we're seeing in the bond market?
Well, so far, Fed officials have had a chance at various appearances, and they've not really taken that opportunity to push back against this. My own sense is that to the extent this move really does reflect higher bond yields because of so much Treasury issuance, it's not something the Fed would necessarily want to lean against. It actually does some of the Fed's job for it. But obviously, if moves get extreme or persistent, it could get the Fed engaged. But we haven't seen that yet.
Yeah, I think Alan Ruskin of Deutsche Bank was saying that the recent 75 bips in the 10-year is like 150 bips worth of tightening for the Fed. So, okay, not the worst thing in the world. What looks unruly? Like, what would worry Rich if you were still at the Fed?
Good question. What I'd be looking at, Alex and Guy, is I'd be looking at the extent to which this sell-off reflects a big move up in inflation expectations. The Powell Fed wants to anchor inflation expectations. So far, most of the move has been in real rates, not in inflation. But if I were still back at the Eccles or the Martin building, I'd be looking to see that the Fed's credibility is still in place, which currently it is.
Yeah, the Fed would certainly like to maintain its credibility, and if things get disorderly, maybe it would have the opportunity to step in. Rich, do you have any idea, do you have any clarity on what the current strike price of the Fed put is were things to get disorderly?
Well, I think that's a tricky concept in general of the Fed put. What I do think we do know, Guy and Alex, is the Fed understands that the liquidity of the Treasury market is essential to achieving its mission. And certainly in my time at the Fed, we had disruptions in, for example, in the repo markets in 2019. So there can be sufficient or significant disruptions where the Fed steps in. We saw from the Bank of England exactly a year ago. But I don't know. I don't have a particular level that I would mention right now.
Do you think that the bond market is functioning well? I mean, we talk about liquidity risks, the hedge fund basis trade, like all that stuff. Is the bond market giving us a real read, or are there just a lot of distortions, and what do we do with that?
Alex, a good point, because I alluded to that a moment ago. I do think there are market technicals at play here. Essentially, what I mean by market technicals, tendencies for prices to move or overshoot in response to fundamental news. For example, I'll give you a good example. Just intraday, if you look at your Bloomberg screen, you'll see the yield on the 10-year Treasury moved up about 15 basis points and then moved down roughly that amount on the ADP data. So those are very big moves in response to one report. So that's telling me that there is a technical element here.
You've also alluded to the fact that the Fed's very comfortable with what it's seeing. To a certain extent, this is doing the job that the Fed may need to do further down the road. Rich, do you still believe that the Fed has further to go? I'm wondering what the right question to ask is right now. Is it still how high do they go, or is it now how long do they stay there? And it's that kind of, are we at the top of the Matterhorn, or are we at the top of Table Mountain? If you were to pick a mountain, where are we?
Yeah, well, if you had asked me this a month ago, and I think I was on Bloomberg Air around that time, I was in the camp going into the September meeting that we would likely get one more hike in this cycle, if really just for precautionary reasons. And certainly the dots at the September meeting had 12 of the 19 participants indicating one more hike. I'm less of that view now. I think given that, as I said, the bond market can do some of the Fed's job for it, if even some of this recent increase were to stick, I think the Fed could well be done.
If the Fed is done, first of all, thank you for breaking news with us. We appreciate it. If the Fed is done, what about 2024? It looked like the dots were looking at 2 cuts. Do you see that being real?
Alex, the interesting, and Guy, the thing about market pricing is that it's reflecting, a weighted probability weighted average of a lot of scenarios. 2 cuts looks about right to me, but I think there's certainly a chance that we don't get any cuts next year. Or conversely, if inflation falls more rapidly than I and the Fed expect, they could be cutting more. So I think the way to look at those numbers is that they're averaging across a range of outcomes, but that doesn't look unrealistic to me. What I will say is back in May, when the markets were pricing in 6 cuts, including starting this year, I thought that was out of line with Fed reality.
Okay.
But no, right now,
where do you, Rich? When we get into a rate cutting cycle, what does that cycle look like, do you think? How low do we go? Catherine Mann was talking the other day. She was talking about rates being permanently higher. Yeah. Do you agree with her?
Well, I think in the case of the UK, and my good friend Catherine Mann's done a great job there, I think that is right, because remember, they barely got rates above 0 before the pandemic. During my time at the Fed, we got the funds rate all the way up to 2.5%. What I do think, however, is central banks do have some room to cut now, and so they're further away from the 0 bound. But I do, not to sound boring, but I think I think central banks are going to be data dependent. But I think an important difference in this cycle, leaning in Catherine's direction, is this is the first rate hike cycle, at least in the U.S., in 40 years, in which the goal of policy has been to reduce inflation, not just to keep inflation from going up. So I think there probably will be something of a bias in this cycle as well.
Oh, that's interesting. And that also goes back to the neutral rate, right? And that it's still definitely unclear on that sense. So, Rich, I'm just wondering then what you think about the labor market. What happens if we get a super hot number on Friday? What happens if we get a nice cool number? How are you thinking about it?
Well, there's no doubt that the Fed wants the labor market to slow. It's hoping it can engineer that soft landing. But 180, 200,000 jobs a month is probably about 100,000 more than the economy can sustain without upward pressure on wages. So I think that our analysis indicates that we're going to continue to see a slowdown in gains in payroll growth. It'd be interesting tomorrow if for a change the ADP report is indicating something. If we got an 80K print tomorrow, that would certainly be downshifting into the range the Fed thinks is consistent. But I do think that the Fed is looking not just at the price inflation data, but also wage and compensation costs. They're still running hot relative to the Fed's long-run inflation target.
Yeah, the ISM services data certainly pointing us in that direction. We got that at the top of last hour. So, Rich, pull it all together for me. Jamie Dimon's warning of the risk of potentially going to 7% on the 10-year. We've got others making similar noises. Some are even saying higher. What do you think? What kind of trajectory are we currently on? Do I want to be buying the 10-year at this point? Do you think there's going to be a better entry point further down the road?
Well, what I'd say about that is we think that we're in a world, and we've said this in our publications, that we do think the Fed has credibility. It will get inflation to 2, and starting yields for patient investors are attractive. There are a lot of opportunities in the bond market and spread and mortgages and globally. So, I wouldn't necessarily highlight just an interest rate level at this point. But yes, the bond market is adjusting, as I said, to technicals, to macro data, to fiscal dysfunction, and prices will find a level, consistent with that data.
Rich, always going to get your perspective. Next time, with me in studio. We miss you in person. Rich Clarida, PIMCO Global Economic Advisor and former Federal Reserve Vice Chair. Great to get your perspective. I always learn a lot. Let's get more perspective now from the investment side with our question of the day. What are you feeling, fear or greed? Joining us now is Jenny Johnson, President and CEO of Franklin Templeton, with over $1.4 trillion in assets under management. She joins us now from the Greenwich Economic Forum. Jenny, it's so wonderful to see you. We just heard a lot from Rich Clarida on sort of where yields could go, where inflation could go in the labor market. Would you recommend investing right now for fear or greed?
Well, I think that the good news is it feels like the big recession that people feared with rates going up so quickly, it feels like we at least have a soft landing. Maybe it's recession, but it's certainly not a bad one. The challenge, I think, is whether or not the Fed can there are some headwinds to getting inflation down. Look at the wage pressure on things like the auto strike, and there was a lot of discussion. If they're successful, you'll start to see other unions striking. And sure enough, today you had the 75,000 employees at Kaiser Permanente going out on strike looking for wage increases. Those are going to be very inflationary. Oil, obviously, the price of oil shirts down a little bit, but it's still high. So look, my gut is that the Fed raises one more time. Why not? It's built into the market. And then the question is, how quickly can they cut? And I think that even, it certainly is not going to happen before the second half of next year. As long as you believe that, people are staying probably a little bit short duration. After this cut, maybe people we're seeing investors start to go a little further out on the curve. But my fear is that this sticks around for longer than the market expects.
Okay, so a little bit of caution may be justified. Jenny, good morning, it's Guy. So what are you thinking about doing in that kind of a scenario when you think about how you are going to be setting up for that kind of a world? What are you doing, and what is your degree of certainty right now? It feels as if there's a lot of competing forces at play right now that are really difficult to sort of tease apart.
So I think there's some real opportunities out there. I mean, first of all, let's face it, you actually get paid to be in fixed income. I mean, even if you're in cash in a money market fund, you're getting 5.5% yield. But I think there's some great areas in the market. I love if you can withstand the illiquidity risk of private credit. I love private credit, and especially now as regional banks have even retreated. We're seeing in our private credit team anywhere from 11.5% to 12.5% yields. Those are equity yields in the fixed income market. So I think you're seeing that as an opportunity. Sure, I tend to believe the 10-year is actually going to stay up a little bit longer, just because of the macroeconomic environment where the deficit's gone from 30% GDP up to 100% of GDP, where it's $31 trillion, and you need buyers of that. And if we don't have enough buyers, it's going to keep interest rates on the long end a little bit higher. I think fixed income's a great place to be. How much of that's all built in a longer cycle of higher rates? How much is that built into the equity markets? I'm not sure. And so if I'm in the equity markets, I actually like a little more conservative, good cash flow, generating companies with good dividends.
So based on that point, 60-40 portfolio, just straight up now, isn't doing great. We're seeing stocks and bonds kind of move together over the last 3 months. So I'm wondering, with your view on private credit, is it like 60-30-10? Is it 50? It's like fast math. 50-40-10? What do you think?
It all depends on the individual.
Sure, but you're the individual.
No, like I said, high yield, you're getting just under 9%. That's a really nice yield. We're not seeing increase in defaults, so it feels like that spread is actually pretty comfortable. As long as the economy doesn't go into recession, you're not going to see defaults in the fixed income market. Again, how much have we priced in? I think actually this recent correction in the equity market has priced in some of the interest rate and some of the more growthy stocks. That's corrected itself a bit. But again, I feel like right now it is possible that that the inflation is going to be harder for the Fed to get under control. You're definitely seeing it, but with that, you're probably going to have rates stay a little bit higher for longer.
Jenny, that kind of goes to a little bit about what Ray Dalio was saying at the Greenwich Forum yesterday. He was talking about the high rates that are achievable in high yield and maybe elsewhere, talking a little bit about private credit as well. But the point he was making was, are these really good rates? They're high rates relative to recent experience, post-GFC. Are they really good rates relating to the environment we are in now? Do you still think that the yields that are being offered right now are compensating investors for what they're seeing? and are going to be compensating for that slightly higher inflationary environment that you're alluding to?
So I would say yes, because I think that we're not going to have an economy that has a hard landing. I think as long as we have a soft landing, we're going to be able to withstand. You're not going to start to see defaults on the credit cycle. A lot of the equity market companies actually went long duration on their debt. So their debt's really cheap compared to what the market is. And so, as long as you have a good cash flowing company, you're going to be able to withstand an environment of higher interest rates. As long as you don't have a lot of defaults, you're actually getting paid really well compared to where inflation is today.
Jenny, how do you view the dysfunction in Washington? And I'll tie this back to long-term yields. Clearly, there's fiscal dysfunction. Clearly, it looks like we are headed more towards a government shutdown now in November, since there's no House Speaker right now. And I'm wondering, does this just permanently increase the term premium we're going to have to see in the long-term bond market because of this, because of the fiscal deficit, the fiscal spend, and the inability for Washington to get stuff done? And how does that sort of frame any long-term thinking?
So I actually tend to think a lot of that is noise. Obviously, it's dysfunctional, but let's face it. Even if the government, couldn't come to agreement, an IOU from the U.S. government is probably the best IOU you can get. I think the longer-term issuance story is just this year. The U.S. deficit this year is going to be $2 trillion, up from $1 trillion last year. That all gets added to the U.S. government debt, and the trajectory continues to increase. So, you're going to have to find buyers of that. So who are the buyers? If the debt's 31 trillion, 25 trillion of it is required today to have buyers. That's the Fed is 25%. You take, foreign investors, Japan's only 1.1 trillion. They're the largest foreign investor. Then you're looking at corporates, mutual funds, pension funds. They're all going to have to support that U.S. government debt. And so I actually think that's the bigger worry, is just the pace in which we're taking on debt as a country.
Does that mean you want to look outside the United States, Jenny?
Well, I do think there's some really interesting markets, the China plus one story, right? Companies learned that during COVID, your supply chain can't rely on a single country. And so, it's not that they're leaving China, because China's actually, a cheap source of supply chain, but they're going to places like Vietnam, India, Indonesia, and so all those become opportunities to be able to invest in. And so, yes, I think there are opportunities. You go to Latin America, where you have much of the raw materials for batteries are going to be supplied out of Latin America. So I think there's a lot of interesting opportunities in those markets as well.
It feels though if yields stay higher, dollar is also stronger, that EM is where things break. As Jenny Johnson looks at the landscape, what are you worried about breaking?
What am I worried about breaking? Here's the fight. You never really can predict. Obviously, as I said, I'm worried about the U.S. debt. But I think the most important lesson that we learn over and over is have a diversified portfolio, because you cannot predict all these things. Usually, when people are predicting it, it's already built into the prices in the market. So the best message I can give to everybody is make sure you have a very diverse portfolio.
But the problem, Jenny, at the moment is that diversified portfolio isn't really working. Alex was talking about 60-40 a little bit earlier on. Bonds and equities are moving in the same direction. Yeah, you could probably get some diversification by being in private markets and maybe in real assets as well. But people are struggling to diversify in a world where bonds and equities are doing the same thing.
Yeah, I mean, that's always a challenge, and it's unusual that happens. But, again, you're actually getting paid pretty well in the fixed income market. I mean, if inflation's, 4% or so, you're getting in high yield almost 9%. So those are not bad returns. And even if rates go up a little bit, you're just going to have a little degradation of that. So I actually think that you're getting paid in these markets for the risk.
Jenny, we love talking to you. You're so honest. You're thoughtful. We really enjoy the conversation. Jenny Johnson, Franklin Templeton, CEO. We'll see you next time. All right, let's turn now to Wall Street B, where we take a look at what's buzzing on Wall Street and the world of banking and finance. And today we are headed downtown in New York City. Bloomberg's Shelley Bassig is outside the courthouse for us, where jury selection is still underway in the trial of FTX founder Sam Bankman-Fried. Opening arguments are expected to begin today as well. All right, Shanali, what are you watching? What's the mood? What's the vibe there?
Yeah, it's an interesting and strange day where you have Sam Bankman-Fried's hair making front page news in so many ways over the last 24 hours. He has shown up here. His parents are here down at the Southern District of New York. To your point here, they're still going through jury selection. They are looking for 12 jurors, 6 alternates, and this will amount to what they think is the start of opening arguments today. The prosecution will bring forward about 30 minutes worth of their statement, and then we'll hear from the defense for another 30 or 40 minutes or so, and then we'll hear from witnesses. Remember, the reason this trial is so highly watched is not just because this is a historic trial, but also those witnesses, as they come forth, will be fascinating. We know that there are a lot of cooperating witnesses that have already pled guilty, including his former girlfriend who ran Alameda and had been a very central part of the operations between FTX and Alameda during a very critical time. So as the trial, a 6-week trial, it will take some time to get through all the witnesses, but as they are called forward, they will be very highly watched because of how high profile they are. And now the fun starts really today, where we'll hear from the bulk of what we expect for Sam Bankman-Fried to defend himself against so many criminal accounts.
Shanali, to what extent is the world of crypto on trial here as well? How important is what happens here to the crypto landscape?
You've never seen people distance themselves so quickly from somebody, haven't you, Guy? You have, for example, a lot of big players in the world right now, BlackRock, trying to start a crypto-linked ETF, seeking approval from the Securities and Exchange Commission. Remember, the Department of Justice had dropped their counts against Sam Bankman-Fried when it came to the political financing. But remember, when you look down in Washington, the relationship that lawmakers had to Sam Bankman-Fried were very fraught, given the nature of what had happened and those initial charges brought forth with him when it came to his political financing. So how then do you have lawmakers that can move forward and really bless agencies to take a softer stance to crypto? Yes, but yet they are. We have seen lobbying happen to a massive degree in recent weeks alone. You have significant players in that lobbying space coming in to talk to us here on Bloomberg Television and in every major media outlet across the world. Bitcoin itself is up more than 60% through the end of September, but still 60% down from the peak at which had sunken FTX and, frankly, a number of other crypto players. Certain bad behavior has been washed out of the system, and you regain trust in a system that has led to a failure like FTX.
It's going to be a busy day for you, Shanali. Thank you very much indeed. Bloomberg Shanali Basak on the trial taking place, the FTX trial. We'll continue to watch that for you. What we're also watching very carefully is what is happening with the markets right now, Alex. Stock 600 down by 0.4%. Equities are kind of marking time, really. I think we're now kind of waiting for the payrolls Friday. It's going to be interesting to see what happens there. Today, you did get a reaction to the ADP. You didn't get as big a reaction to the ISM data coming out of the US. We have seen earlier the pound was much stronger. That move has now faded, 121.15. We did see German 10s going through 3 a little bit earlier on. We're kind of back to fairly flat there as well. Lots to discuss. Are you feeling greedy or are you feeling fearful? Max Kettner, multi-asset strategist at HSBC, joining us next to discuss. How's he feeling? This is Bloomberg.
one of the largest and wealthiest consumer markets in the world. And there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is gonna be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Wednesday, the 4th of October, European stocks kind of drifting lower a little bit. The FTSE 100's under a little bit more pressure than most. Energy stocks are the biggest sector loser here in Europe. Oil is down pretty hard. I think Brent's down circa 3%. We've got a builder Cushing. So that's a story to take away right now. But the yield narrative is still the kind of the bigger narrative that we are focusing on. The countdown to the close starts right now.
The countdown is on in Europe. This is Bloomberg Markets European Close with Guy Johnson and Alex Steele.
Stocks down 0.4%, 438, so we're below 440, which is significant. Just keep paying attention to the technicals. People are at the moment. So we're down. We're down. Energy is the big drag today. As I mentioned, you do have oil down pretty hard. You've got the energy stocks following suit. So that's weighing on London right now. Single stocks are quite interesting. Novartis. People often go on about the sort of defensive nature of the pharmaceutical sector. Here is a company maybe delivering on that promise. Novartis is up by 12% today, sticking with guidance. Investors seem to like the story, the narrative that continues in terms of money coming back to them, back to shareholders. That stock certainly responding really strongly today. Imperial Brands down by 3.05% today. Rishi Sunak has basically said effectively that over time he is going to raise the age at which you can buy cigarettes in the UK. Effectively, over time, he will be banning the purchase of cigarettes. Basically, what he has said is that if you're a 14-year-old now, you will never be able to legally buy cigarettes in this country. It's having an impact. Imperial Brands, Alex, down by over 3%.
Yeah, definitely. You also stole my oil thunder, but I'll get to some more oil thunder. S&P is down by 0.1, no big deal. We did get ADP coming in weaker than estimated, but maybe that's a good thing. We also, the ISM services, though, still doing really well. New orders were weaker, but that's maybe because of retail clearing out their inventory. Now, as Guy was mentioning, oil was getting hit. The energy index is down 3.5%. Not only did you have a build in Cushing, but you saw the weakest gasoline implied demand since 1998. So maybe some more balance coming into the market. Where we're seeing the action here is the 2-year down by about 5 basis points. Buying coming into the front end of the curve. Yes, the 30-year did touch 5% for a hot second today and then came off that level. But after the ADP and then after the ISM services, buying really resumed throughout. Dollar yen, I'm just flagging it. It's 148.99. It feels like that 150 has definitely now been said. This is the line in the sand. Do not pass. We're a little bit away from that, but nonetheless, Guy.
That was the action this time yesterday. We're watching it very carefully. 5 basis points feels like a nothing move these days after some of the volatility that we've been watching. Alex, we did go through 3%. You were talking about what's happening on your side of the pond. We did go through 3%. on a German 10-year a little bit earlier on. We faded that move a little bit. We're trading 2.967 right now. So yeah, there's some interesting levels being pushed through, resisted a little bit. We'll see whether or not the market has another go at it. But German 10-year north of 3% a few weeks ago didn't feel like that was going to happen.
No, it really didn't. And the speed with which we re-rated. So last hour, we spoke to Rich Clarida, PIMCO Global Economic Advisor and former Federal Reserve Vice Chair, about the moves in the bond market. Here's what he had to say about the curve.
At PIMCO, we try to distinguish between like a neutral bond yield on a 10-year and the neutral federal funds rate. We do think we're going to be in a world eventually of steeper yield curves, but there's no doubt that in a world where government debt's north of 100% of GDP and we really do not have a consistent fiscal policy in the U.S., we're going to probably be in a world of steeper curves for sure.
And he knows. Rich Clarida talking to Alex and I in the last hour. Takes us back to our question of the day. Given what we're seeing right now in the markets, how are you feeling? You feeling fearful or are you feeling greedy? Joining us now, rocking the Bavarian chic, Max Kettner, multi-asset strategist at HSBC. Nice outfit. How are you feeling? Are you feeling greedy or are you feeling fearful?
I'm feeling more greedy, to be honest. I really don't feel that fearful, particularly when you look at credit, for example. Credit's actually been pretty resilient, right? Let's be honest. If you look at high yield and investment grade credit, I can feel you feel a bit more fearful, right? But there we go. So I think, look, in terms of what we've seen so far, sentiment's already re-rated quite a bit, right? We're seeing already, if we look at the VIX futures curve, we look at survey-based sentiment, a couple of those things already flagging quite a bit of pessimism and quite a bit of fear. So to me, this is not the time where I'm saying, oh God, now I need to really throw in the towel. It's actually really, particularly in the riskier credit, right, really something where I'm like, you know what, I'm getting 9%, that's fine, right? Like you've got really low maturities coming up, particularly in US high yield, and that's pretty good.
It's not me, you want to worry about Alex.
Yeah. It's me. But Max, I guess what gives you the confidence that it doesn't turn into fear? I mean, sure, high yield's holding up, the credit market's holding up okay now, but why do we think it's going to continue to hold up? The equity market has been very resilient to some extent. Why do we think it's going to continue to be?
Look, because I think part of that is because there's already a lot of fear in there, right? Part of that is really because when we look at, for example, our sentiment index, it's collapsed quite a bit already, right? That's number one. So you already have quite a bit of fear in the market already. That's number one. And number two is when we look from a growth perspective, particularly from a growth expectations perspective, the interesting thing is we continue to see the same pattern from the last 4 or 5 quarters, right? We're starting now Q4 with the same setup of very, very pessimistic growth expectations, particularly for the US, right? If you look at Q4, Q1, Q2 expectations next year, they're all sort of around 0, right? I think for this quarter there is 0.4. For Q1, it's around 0. So the bar to beat in terms of growth expectations is really, really low. Also, when we look at the earnings expectations now for Q3, it's just a little bit of quarter-over-quarter positive earnings growth that consensus is expecting. And all the revisions that we've seen, right, have really happened. The downward revisions have happened in the cyclical sectors, in consumer discretionary, in energy, particularly in materials, right? So really a lot of pessimism already in those earnings expectations. So the upcoming Q3 earnings season could actually, again, spring a bit of an upside surprise.
So you're not worried about yields rocketing higher? Nothing to worry about, nothing to see here. Not an event.
I'm not worried that much about the level of yields. I'm more worried about the volatility of yields.
Rate of change is quite extraordinary.
That's the thing, right? So I'm more worried. I'm not really worried if you tell me, like, we're going to be at 5% and we're going to be stuck here for the next 12 months. Is something what we've got to deal with. But let's be honest, if you look in for example, the S&P, if you look at the maturity wall of the S&P in 2024, super low. If you look at the Russell, less than 4% of total debt is maturing next year.
The Russell's been tanked there.
Absolutely, but that's a different issue, right? Because in the Russell, you've got almost half of the companies that don't make profits, right? So the sort of the small cap trade is kind of gone, unfortunately, particularly in the US, because you've got around 40% of the Russell companies don't making a profit, right? So you can't, that old sort of, if I buy high yield over IG, I buy Russell over the S&P, that's kind of dead right now. But that's a profit issue, not a yield issue.
Okay.
So Max, do you like US or European stocks with the setup that you're talking about?
The setup clearly speaks for US stocks, right? It speaks actually more broadly for US risk over European risk, right? because the growth expectations are most pessimistic really at the US. We are seeing also more momentum behind the US, right? We're also seeing more momentum behind US earnings than European earnings, right? You've seen that already in the Q2 earnings season, that, for example, when we look at what we track and what we call guidance sentiment, we're clearly seeing that guidance sentiment is more positive in the US compared to Europe. So all of that actually speaks for the US. And what we're also saying is that that sort of tailwind that we've had last year from a weaker euro, right, that's actually started to fade. That will only come in now, probably in 2024, but we're actually having a tailwind from the weaker dollar compared to last year. We've had that still for most of Q3, right, in July and August. It's now started to fade, but it'll be only a Q4 issue. In Q3, the relatively weaker dollar compared to last year is probably still quite positive for US earnings.
Max, what I love about you, apart from your sartorial elegance, is that you sound like you've got a high degree of certainty, that this is a world that you are understanding and able to navigate. Is that true?
I wouldn't do my job correct, right, if I came here and said, I have no clue what's going on. No, but look, the reality is, I think I would be much less confident if we went into this now, where yields would rise, volatility would rise in equities, in credit, and in rates, and at the same time, you would have very, very high growth expectations, both top down and also earnings. Because then I kind of go like, you know what? Now we're faced with higher yields, right? I'm faced with that relative value decision, but at the same time, I see almost no chance of positive surprises on the growth side. So then it's pretty crystal clear that you go for bonds over equities, right? Or risk off over risk on. Whereas right now, you're still faced with these relatively low growth expectations. And let's face it, I mean, I've been here for 10 minutes and I feel like the world is going down, right? Like I've only had like the most pessimistic questions from you and Alex, right?
Okay. It's hard to. Well, we asked you the question at the beginning. Are you fearful or are you greedy? We came through.
We put it out there.
That unscathed.
Does that count as bullish already, right? That's the most bullish question we can get today.
Okay, maybe it had some bullish elements to it, but you sound so convinced that we have to ask you. Yeah, and we have to be skeptical.
Yeah, I think that's absolutely true, right? And to be fair, in our client conversations recently, we've also been only faced with those kind of negative.
So it's not just me, or Alex.
No. It's not just you too, right? But that gives you the confidence, right? It would give you less confidence if people would say, you know what, yeah, things are kind of fine, you're right, let's give up on the risk-off stance, everything's kind of fine. Then, the alarm bells have to start ringing. If you keep getting, pretty much bombarded with, but what about this, what about that, what about student debt, what about consumer credit, right? What about, government shutdown and this and that, then it's pretty, it gives you the confidence that people are pretty one-sided in terms of their opinions.
Yeah, you know me. I'm like soup cans and gold bars. Fair enough. Max, thanks a lot. I appreciate it. Max Kettner, multi-asset strategist over at HSBC. We appreciate it. Coming up, Aston Martin re-entering the Le Mans, that's how I'm saying it, right? Hypercar class.
Le Mans.
Excuse me. Le Mans hypercar class with a new Valkyrie race car. God, those are so pretty. Lawrence Stroll, Aston Martin executive chairman, joins us with a peek under the hood. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand like all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like there's a deeper purpose here. Like women deserve better and we shouldn't be an afterthought.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
So a moment ago, we were talking about Max Kettner's sartorial elegance. I think it's an opportunity to maybe widen the lens and talk more broadly, Alex, about your favorite subject, fashion. Caring under a little bit of pressure today as a result of Bernstein downgrading the stock. They're questioning the Gucci re-acceleration. They saw what happened on the catwalk. They're not convinced they're being dare enough. But Alex, this speaks more broadly to what is happening with these luxury stocks and the fact that they're getting dinged up pretty badly right now. LVMH, Moncler, Richemont, you just go on and on and on. The hit has been hard, and you do wonder if the stock market cracks, whether that could hit these stocks even harder. The upper echelons, will they stop spending if they start to see their portfolios under pressure?
Yeah, and just take a look at this. So over just 3 months, you look at Kering, LVMH, and Richemont, just to take a perspective of how badly they've gotten hit. I mean, Richemont's down 26%. Yes, you have some banks coming in and upgrading some of the luxury stocks, saying, look, a lot of the bad news is priced in, but it does raise questions as to the future of the upper end of luxury, and does it spread to other aspects of the market? We saw used watches, for example, the high-end watches, that those prices come down.
Yep.
Do we see that in other areas like cars?
Yeah, I used my board the words re-acceleration. I think that's quite appropriate for the conversation we are about to have. So can you basically extrapolate from what is happening with businesses like Richemont, with LVMH, into Ferrari, into Aston Martin? Well, let's try and answer that question right now. Aston Martin announcing their brand new prototype, the Valkyrie hypercar, is going to be competing against Le Mans. We're all excited about this. We know what we can see on the Formula One stage. Now we're going to take it to endurance racing as well. The company's executive chairman is, of course, Lawrence Stroll. He joins us now from the company's new campus at Silverstone. Lawrence, great to see you. Thank you very much indeed for taking the time to join us here at Bloomberg. We've just been discussing what is happening with luxury spending more broadly. Watch prices are coming down. Luxury stocks like LVMH are coming under pressure. There's a concern that maybe spending is going to slow down. Is that also going to be true in your market, in the upper end of the car market?
Well, we're in a very fortunate position. We don't feel that at all. Our order books have never been stronger. We're starting with our DBX, our SUV. You know, in a couple years since we launched it, it's taken 20% market share of high-performance luxury SUVs. And most recently, we've announced that we're rolling out our next-generation front-engine sports cars. We launched our DB12 in the south of France in May before the Monaco Grand Prix, and the order book's never been stronger, the strongest order book Aston Martin's ever had. So I think as long as you have the right product, the demand is 100% there. And again, we're feeling great upside, if anything at all.
Now, fair enough. I mean, I would bet you that LVMH would probably say they have the right product too. So I wonder if you were to look at any cracks, where do you think they would emerge first, Lawrence?
Again, we're not feeling any. I think a lot of it does have to do, when you're in the car business, that you roll out all new launches of all new products after coming off of 7-year-old products, which still sold out in our dealerships. So again, we're not feeling any cracks whatsoever.
Lawrence, you've recently raised money. You're investing more into the business. You've got Geely on board. You've got Mercedes on board. You've got technology coming, therefore, from those businesses as well. We're seeing turbulence in financial markets. Raising money is going to get harder and harder, it looks like, from here. Do you have the money you need right now? And do you have the technology you need right now to compete with brands like Ferrari?
We most certainly do. Our last capital raise money was raised to pay down our mezzanine debt, which we're going to do very shortly. Otherwise, the company is fully funded and we don't require any further funding whatsoever. And as far as technology is concerned, as we launch all of our new products, we're bringing out all of our new technology. So if you look at our DB12, which we just launched, which is our first of our next generation front-engine sports cars, it's the highest technology of any GT. We're calling it a super tour of any Gran Turismo car on the market. Better vehicle driving dynamics, more horsepower, the highest technology in the interior in terms of HDMI, infotainment. So yes, we are perfectly, I think, ahead of the competition in terms of our technology as well as our performance.
So that car behind you, that's a Valkyrie, right? And it's going to be in Le Mans.
Correct.
What do you get by being in Le Mans?
Yes.
What's the deal for you?
Well, it's a hugely commercial beneficial event for the company. One, you have millions of viewers around the globe watching these cars, not only Le Mans, but it's also in America at IMSA, at Daytona, at Sebring, at very historic tracks around the world. This is our customer base. You know, we sell these cars at a substantial profit. It's great marketing to see us go around to Le Mans, go around to Sebring, go around to Daytona. You have millions and millions of viewers. It's extremely aspirational and has a trickle-down effect over the whole brand, the halo effect.
It's a different market, therefore, by the sounds of things, Lawrence, to F1. How are you seeing the F1 story developing from here, and what benefit do you see coming from that over the next few seasons? The number of teams looks like it's going to be increasing. How do you feel about that? What do you see the opportunity in Formula One is? Kind of just give us a sense of how you think that brand is going to develop for you as we see maybe more teams coming in.
Formula One has truly transformed Aston Martin. It's introduced us to a much younger customer base. We have data showing 50% of the consumers today buying our product were not Aston Martin customers before seeing us in Formula One. So it transformed us at the highest echelon of technology in automotive, at the highest luxury in automotive, which is very much our client base. So Formula One has really been transformative for us as a marketing tool. Also, again, we are bringing performance to Aston Martin, technology performance. There's no better performance, no greater performance than Formula One. So for us, it's just been absolutely fantastic. And our largest market... Our largest market being America, you know, with now 3 races being held there.
Does that effect now get diluted, though? More teams come in, Andretti comes in. You've seen the effect and the dramatic effect that it's had on your business.
Yeah, but by the way, Andretti has been approved by the FIA, which is one of 2 of the bodies that have to approve their entry. The second is FOM, who has not approved their entry. So Andretti is far from entering Formula One.
But if he does, same kind of question. Are you worried there's going to be too many cooks in that F1 kitchen?
I think that F1's in a great place with 10 teams, and I have a very strong suspicion it will remain 10 teams.
Okay, that's interesting. Lawrence, you're at the new campus. How big an advantage does it give you?
Oh, it's enormous. It's over 500,000 square feet, over 3 buildings. We moved in May into building number 1. Building number 3 is a new wind tunnel, which we will have online next September. That again, transformative for a Formula One team to have the latest and greatest wind tunnel. The last wind tunnel built in Formula One was in 2004. I think you can imagine how technology has moved on in the last 20 years. So it's a game changer. There is no other facility like this in Formula One, and it's again for us, it's totally a game changer.
All right, Lawrence Stroll of Aston Martin, we totally appreciate it. A beautiful car. Good luck. We appreciate your time today. Thank you very much. Guy, have you ever driven one that looked like that? For fun?
A Formula One? No.
No, not a Formula One car, but like super fancy high-end luxury car?
I once drove a caterer around Silverstone, which was quite the experience, one of the high-end caterers. Not sure I was completely in control the whole way around, but it was quite a lot of fun. And a BAC mono. I drove one of those around a course,
track?
a place up in Anglesey. That was fantastic. Amazing.
I want pictures of that. All right, this is Bloomberg.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
On the next episode of Hello.
Slice through the noise.
Forget the noise. Ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal.
Now, more to the point.
What is the lesson or the observation?
It's worth taking a check here on the markets. Okay, we have S&P is up 0.2, but it's the NASDAQ that's outperforming. The NASDAQ 100 is up 0.7. Here's the why guy. It's Tesla. It's also the best performing stock on the S&P, and I really can't tell you why. So there is that. On the downside, you have energy. That feels like no surprise after we wound up seeing gasoline inventory rising. Implied demand is the lowest since 1998. Cushing inventory rising, et cetera. And just to check in on the 10-year, 4.74. I don't know, 5% doesn't seem that crazy anymore, Guy, but yet everyone seems so calm.
It's amazing, isn't it? I guess today's moves need to be seen in the context of yesterday's moves. And maybe it's fascinating to look at the fact that we haven't kind of completely unwound them. That's worth bearing in mind as well. Nothing goes in a straight line for long. Stock 600, absolutely flat today. Energy is a drag. That's weighing on London a little bit more. The pound, though, is higher. We're up by around 0.5%, 121.44. You were going to see a little bit of dollar weakness at some point. Maybe that just happens to be today. Euro, similar picture as well. German 10-year went through 3 briefly earlier on. We catch a little bit of a bid into the bond market right now, but we are waiting. We are waiting. We're going to figure out exactly what is going to happen here next. We don't really know. I think it's fascinating that we talk to so many people about the degree of certainty they have right now. I'm not sure there's a great degree of certainty right now in these markets. We're building up to payrolls on Friday. There is a lot going on. Today feels a little bit calmer, but at some point we were due a calm day. Anyway, the close is coming up next. We'll deal with what's been happening here in Europe in a little bit more detail. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's look to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
Wrapping up the session here in Europe, it's actually all gone rather grey. Kekaron's flat, DAX is flat, London's under a little bit of pressure. The oil stocks are weighing, so London's down by around 0.8%. If you're looking for some excitement, FIFA has just announced that the 2030 World Cup will be hosted by Portugal, by Spain, and by Morocco. So some action down there, at least over the last few minutes. Let's talk about the session that we've seen thus far. We have rolled over a little bit as the day or the afternoon has progressed. Was that the ADP number? Maybe. Was that the ISM number? Maybe. I don't know. Trying to sort of pin things, price action on things that are happening, I think at the moment feels a little tenuous. Anyway, we're back trading 440 right now. We're down by 0.1%. Waiting for the next big catalyst. Does it come Friday in form of the payrolls? Novartis. That looks like a different share price than the one I was expecting. But anyway, we'll park that one for the minute. Tesco is up by 3.66% today. That has had a very good day. The company coming out with really positive guidance in terms of what it's seeing on the top line. So quite a positive narrative there. We were talking about that yesterday. And I was mentioning a little bit earlier on what was happening with the tobacco story here in the UK. Rishi Sunak, the British Prime Minister, effectively over time will be banning smoking. I think if you're a 14-year-old now, you will not ever be able to legally buy cigarettes in the UK. Imperial Brands down by 3%. Let's talk about the day ahead and show you what's happening. This is the picture as we are going to see it. Imperial Brands, sales and revenue. We've also got Shell sales and revenue as well. That's going to be interesting. We've got European leaders. They're going to be meeting. They've got a lot to discuss right now. Ukraine front and centre. But also, just what are they going to do with the Growth and Stability Pact? I think that's going to become an increasing issue. And Alex, weirdly, the Geneva Motor Show is going to be in Qatar. So look for that one. We're also going to get Volvo cars and sales revenue, which is going to be interesting as well. You were mentioning what was happening with Tesla a little bit earlier on. You think about what's happening with Volkswagen right now. Volkswagen is really struggling. It's now not going to proceed with a big factory, EV factory. It's having to maybe sideline some of its staff because it's not getting the demand that it was expecting for some of the EVs that it's making. Kind of what is happening in this EV landscape? It does look as if margin sustainable without significant government support.
To your point, Novartis actually closed up 0.4%. So that's probably more of the stock price you were looking for. And also, you should point out that Ford, EV of F-150 pickup sales actually fell 46%. They're expanding their factory. There's some delayed delivery issues. There's quality checks. So it's not smooth sailing all around the board. So I want to stick to some of those numbers we're expecting from Volvo. We're joined now by Hampus Engellau. He is the sector head of capital goods and autos from Handelsbank. He has a market perform rating on the stock and a price target of 60 Swedish krona. Hampus, thank you for joining us. What are you expecting tomorrow?
Yeah, I mean, we're expecting a similar trend as we've seen in July and August. And to begin with, Volvo had increased the production in second quarter by 50%, and that has kind of continued going into third. So we're seeing volumes being up 29%, around 64,000 cars sold. And it's basically the C40 and the XC40 Recharge that are driving sales.
What do you think is happening more broadly with demand, Hampus? What is the picture going forward from here? As I said, Volkswagen's really struggling at the moment to have the demand. I'm seeing factories not proceeding. I'm seeing staff being laid off. How would you describe demand for EVs right now, particularly in Europe?
I think what we're seeing, the OEMs are working off backlogs on production. If you look at the demand situation, I think what we're seeing on the BEV side is that it's typically a car that you have on a subscription package, which means that you're subscribing by using the car. And what we're seeing is the increasing interest rates coming up, and it's making it more expensive to buy these cars. And also with some less government subsidies, it's becoming an increasingly costly vehicle to drive, and people are looking more at used cars currently, I would say.
And also hybrids. There was a great article out on Bloomberg that said EVs are too pricey, so hybrids look more interesting at this point. What do you think we're realistically going to get from governments to support the kind of demand that we're going to need to see to have confidence in these auto guys to build and make profits on them?
It's, I mean, typically when you have an economic slowdown maybe around the corner here, and people become more cautious generally in their purchasing behavior here. And the thing is that we've been in such a restrained situation from the supply side from the OEMs, and we've also seen for some time lower production levels. It depends. I guess it's a trade-off here. How much you want to drive battery electric vehicle sales. It's hard to come up with a kind of how much support they will give. I think they're looking at it now.
Just as an investor, how much should you rely on governments in Europe protecting domestic manufacturing? One of the best-selling cars in the Nordic region right now is out of China, and I'm wondering whether or not car companies like Volvo do need protecting, whether they are being unfairly treated, and whether or not the benefit of protecting them outweighs the opportunity that exists to sell into markets like China.
Yeah, it's a very good question. I mean, Europe OEMs are generally very dependent on China, very big market. China has also been very fast in moving into battery electric. And from an historic perspective, that is very logical, because one of the barriers to enter Europe has been very restrictive emission standards, etc., making it very tough to compete with traditional ICE cars from China's perspective. And now kind of Europe is more open for China competition, and they're very competitive vehicles. I think it's a very tough call, because both parties are dependent on each other, and Europe can't go very protective given how much they depend on their auto industry from an employee perspective and all of that.
It's going to be fascinating to watch how this unfolds, the two competing forces coming together. Hampus, thank you very much indeed. Hampus Engellau, sector head for capital goods and autos, joining us from Handelsbank. European equity markets finishing off session lows, a little tick higher during the auction process, but as you can see, the FTSE 100 under pressure, down 0.8%. Oil stocks weighing there. DAX and the CAC, Alex, basically flat. Up next, we need to get back to our question of the day. What are you feeling right now? You feeling fearful or are you feeling greedy? Lisa Donahue, Alex Partners co-head for the Americas and Asia, joining us next. This is Bloomberg.
focus and the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. The top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird. It's called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
I still think that there is something coming our way for some of us that really haven't fully restructured. I'm happy that we did. I still think that we did some of it too late. I think it would have been better if we do that immediately going into COVID. But I still see a lot of debt. I still see very challenging environments, I think, on the whole. I don't think we've seen, in that sense, the end of COVID yet for our industry.
Anko van der Werf, the SAS Group President and CEO, speaking to Alex and me in the last hour on the company's restructuring. He has coming through Chapter 11. Takes us to our question of the day. Anko's talking about the fact that there's maybe still more pain to come. What does that mean for you? You feeling greedy? Or are you feeling fearful right now? Lisa Donoghue, Alex Partners co-head of the Americas and Asia, joins us now. She joins us from the Greenwich Forum, the Greenwich Economic Forum. Great to see you, Lisa. Thanks for joining us. How are you feeling right now? What do you see in front of you? Is it a world in which you want to be greedy, or is it one you want to fear?
Hey, good morning, and thanks for having me. I think it's both. I think it depends on your perspective. I agree with the sentiment of the SAS CEO that it's always better to get ahead of your issues, and doing something earlier definitely improves your optionality. And the way that I look at something like this is a crisis for some is a problem, for others it's an opportunity. So sorry to kind of vacillate a little bit, but I'd say it's both.
Well, you're the person they come to for advice. You kind of got to do both. Lisa, a lot of borrowers on the one hand refied when rates were low, but then high yield spreads are moving higher. Where is the distress going to come from, and what does that wind up looking like?
It's funny. I get asked this question a lot about recession, capital R recession. And the truth is, we're seeing a lot of underlying signs that whether or not there actually is a formal recession, we're seeing the consumer start to behave as if it's coming. We're seeing and talking with our CEOs and CFOs across the board they're trying to be prepared. It's being agile, looking at your financial hygiene, not just fixing the balance sheet, but also taking a look at the underlying operations, top line costs, taking a look at your customers and your customer and product profitability. So it's really a holistic approach to try to get ahead of whatever's coming, and whether it's a recession or not, for sure there's disruptive forces that are out there.
Lisa, we have a better view of what's happening in public markets than we do of private markets by definition. What do you think is happening under the cover of private markets right now? Are we seeing similar trends? Are the trends different? Do they have more time? You talk about the fact you want to get ahead of these things early. Is that what's happening there? Just give us your perspective.
One of the things, as you mentioned, I'm here at the Greenwich Economic Forum, which caters to private equity investors. And one of the dynamics that we've been seeing, at least for the last quarter and a half, is number one, increased M&A activity. But number two, which goes directly to your point, is we're seeing private equity sponsors more actively engaging and preemptively engaging with their portcos, taking a look at help us think through how we can help this management team be successful. Help us think through what a holistic program looks like. So the good news is they're not waiting until there's a problem to reach out to try to anticipate. They're being active and supportive and getting in early as a sponsor to either hire advisors or to really take a holistic approach to what their options could be.
Lisa, in terms of getting ahead of stuff, I'm wondering what the conversations are with CEOs that you speak with about labor. I feel like it's strike after strike after strike. And then today, the latest, Kaiser Pharmaceuticals employees might be going on strike. That's about more than 75,000. What do you tell CEOs about unions, about workers?
Well, as you probably know, being a reformed turnaround professional, I've dealt with labor unions really around the world. And what strikes me about what's happening now, and you think about the UAW, you look at the writers and actors strikes, it's about some of the changes that are coming. From the writers and actors perspective, it's AI, it's streaming services, and going back to the agreements that were made back when the industry was very, very different. Similarly, with the UAW and some of these other strikes that you'd mentioned, Teamsters, et cetera, with Yellow Freight, it's about the changes that are coming. It's about the movement from, combustion engines to EV, the parts suppliers, the need for workers, et cetera. So the discussions that we're having now, as it specifically relates to unions, is flexibility, upskilling, trying to look to the future and figure out what that looks like together. But, I think there's a common theme here.
Do you think there has been a more permanent shift, though, in labor's favor away from capital?
I don't think it's a permanent anything. I think it's a point in time and a reaction to some of the changes that we're seeing, and some of, as I mentioned at the beginning, the disruptive forces, technological change. What does it mean for the workers? And frankly, what does it mean for management and the companies? I think we're all trying together to figure out how to capitalize on this in a positive way and try to think about what the management team and the workers, et cetera, of the future look like based on some of these changes that are coming our way, whether it's a different distribution channel by virtue of the writers and the actors, or a change down the supply chain and what that means for the different parts, the different suppliers, and the skills that are required in order to deliver the product.
Lisa, quickly, if there was a word you would use to describe the sentiment of your clients right now, what would it be?
I would say anticipatory, which is good, because I think folks are trying to get ahead of the change that's surely coming and trying to think about what does it mean for them, what does it mean for their customers, what does it mean for their suppliers, and how can we be flexible and agile. So Anticipatory.
Anticipatory. Okay. I was expecting that. Lisa, really great stuff. We appreciate you. Lisa Donahue of Alex Partners, thank you very much. All right, coming up, well, here's a potential big thorn in your side. What's happening in Congress? So hardline Ohio Republican Jim Jordan is throwing his hat in the ring to replace Kevin McCarthy. After the Speaker's historic ousting, we're going to have the latest after the House goes on vacation for 7 days. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
This is Bloomberg.
Stocks around the highs of the session. Go figure. NASDAQ 100 up 0.9%. I would not have expected this coming in this morning. Abigail is tracking the moves for us. Abby?
Yeah, and quite a move from just an hour ago, Alex. Take a look at the S&P 500, to your point, up 0.4%. Earlier, it had been down slightly. The NASDAQ 100 faring a little bit better, up about 1%. Of course, yield not a pressure, at least today. So investors seem to be looking past the higher for a longer narrative. You can see that the VIX coming in a little bit, but nonetheless, a 19 handle. The NASDAQ 100 VIX, the VIX in at a 23 handle. So a 4-point spread there, a little bit narrower than what it typically is, closer to 5 points. Kevin Kelly at Kelly ETFs has told us many times that spread does suggest that we could continue to see more volatility this year, especially for the big tech sector, but along with the S&P 500, a broader sell-off that would catch up with some of the selling that we have seen for big tech. As for yields over the last 3 days this week, the 10-year yield, this is pretty interesting because we've given back. I mean, it's kind of amazing. We were at 488 yesterday. I mean, that's just such a high level relative to where we've been. So we've given back nearly 20 bips, but we're still up 16 basis points on the week. So this is one of the pressures that has stocks down for a 5th week in a row in the longest losing streak of the year. Speaking of the year, the two best sectors on the year, communication services up 41%. Those are your Googles and your Twitters and those types of communication companies, along with some of the more traditional communications. Tech also doing quite well, up 34% despite this rise in yield story. But look at the traditional yield heavy sectors. They are down. Utilities down 20% as yields go higher. Those dividends look less attractive. This is the worst year for right now at least, for the utility sector going back to 2008. And then finally, if we take a look at the equal weighted S&P 500, because big tech has outperformed the S&P 500, the SPW, well, it is actually down on the year. The S&P 500 at this point up just about 10% on the year. Pretty wide divide there, guys. It's going to be interesting to see how the last couple of months play out here.
Yeah, I think we could be in for a bumpy ride, judging by recent experience. Abigail, thank you very much indeed. I will narrow the lens a little bit, get a little sort of shorter term. What are we watching for the rest of the day? FTX opening arguments. We've now got a jury, it seems. President Biden making comments on student loan debt cancellations. That was announced a little earlier. White House press briefing taking place at 1:30 p.m. New York time today, Alex. I wonder what the White House makes of what is happening in Congress right now.
Oh, I'm sure there will be comments made. So apparently hardline GOP Congressman Jim Jordan announcing he is running to be the next House Speaker after Kevin McCarthy's ouster, want to go to D.C. with all the latest. Kelly Lyons, who's on Capitol Hill. This is just kind of the first, and I'm sure a huge group of people who are going to be vying for speakership. What do we know so far, Kaylee?
Well, we know, as you say, that Jim Jordan has officially said he is running. And of course, he chairs the Judiciary Committee. He is one of the leaders, really, of the impeachment inquiry into Joe Biden. So theoretically, he could be one that some of these hardline conservatives would support. But there are a number of other names being floated as well, including the number 2 Republican, Congressman Steve Scalise, who right now is actually fighting cancer. And he is in a room with the entire Texas Republican delegation, along with some other candidates for Speaker who have been floated, the likes of Congressman Kevin Hern. There's other leadership names that have been buzzing about as well, like Tom Emmer or Elise Stefanik. Right now, it's really anyone's guess. And of course, any one of these individuals would need to be able to get 218 votes to actually get the Speaker's gavel. That vote isn't going to start until next Wednesday, October 11th, so they do have some time to sort things out. But keep in mind, back in January, it took 15 rounds and 4 days for McCarthy to be elected Speaker. So we could be looking at another protracted fight again here.
How protracted? How long could this last? Is this going to be a problem when it comes to resolving the debt ceiling? What does this mean in terms of policy making? Kaylee, what does this mean for the functioning of the U.S. government?
Well, it's just simply not really functioning right now in the legislative branch is the issue, Guy. The acting Speaker pro tempore, Congressman Patrick McHenry, only has limited power, basically just to preside over a Speaker vote. The understanding is he can't really be carrying out normal business of the House, importantly, like voting on appropriations bills that are needed to keep the government open and funded past November 17th. Congressman Garrett Graves, who is a close associate of McCarthy and McHenry, was actually just speaking with some Bloomberg reporters earlier at the Capitol, suggesting McHenry might need to be buckling up to remain in that acting position until November 17th if they can't sort out this Speaker thing. So definitely the feeling seems to be here in Washington that this entire episode, the ousting of Kevin McCarthy, the uncertainty about what happens next, just increases the likelihood of the government shutting down come that November 17th deadline.
Kaylee, this might be an unfair question because you've been sort of stuck there on cam with your great reporting, but what's the feeling in Washington? I mean, to some extent, the public is like, yeah, okay, whatever. And the other extent, it's like, guys, there's no functioning government in one of the houses. What's the feeling?
Well, right now, it's really quite quiet. There are a few members meeting, as I said, like the Texas delegation with some of these potential Speaker candidates, but technically the entire House is not even in session again until Tuesday. They could go home if they wanted to, because what are they going to do in the meantime? In the Senate, though, there is still stuff going on, and a lot of the members of the Senate, including the Majority Leader Chuck Schumer, have had some pretty harsh words for what went down in the House yesterday. There is a lot of upset about the fact that really just 8 Republicans were able to destabilize the U.S. government in such a manner. But yeah, it all just is kind of chaos that in some ways we have gotten used to, but in many ways this is just a simply unprecedented moment here in Washington.
Yeah, and sort of what the rest of the world sort of thinks about it. Kelly, thanks a lot. Really appreciate great reporting. Kelly Lyons joining us. In a programming note, Representative Matt Gaetz will be on Bloomberg, I cannot speak anymore, Bloomberg, Balance of Power at 5 p.m. New York time. You definitely want to stay tuned for that. That wraps it up for Guy and me. Coming up, Google Fitbit Vice President and General Manager will be joining Bloomberg Technology with Caroline Hyde. Definitely stay tuned for that. NASDAQ around the highs. This is Bloomberg.
business.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more, and that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue.
He's no longer trying to run away from
that really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure. With two more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
I'm Caroline Hyde at Bloomberg's World Headquarters in New York. Ed Ludlow, he's off today. This is Bloomberg Technology. Coming up, we will go live to the Manhattan Federal Courthouse, where the opening arguments are set to begin for Sam Bankman-Fried's historic fraud trial. We'll have the latest. Plus, we'll talk investing in generative AI with a key hedge fund investor. And, of course, we're going to go live to Alphabet's Made by Google event as the company takes on Apple with a new Pixel that's, well, more like an iPhone. But first, let's check on these markets. And after yesterday's torrent sell-off, where we saw bond markets sell off and the yield spike higher and the pressure on the tech stocks, what were the reverse of it today? We have a little bit of buying. We're up about a percentage point on the NASDAQ. Some of the big tech heavyweights doing the lifting on the day. 10-year yield, though, helping out. We're down some 6 basis points. Look, today, instead of the jobs data looking strong like it did yesterday, today it's the flip reverse. The ADP number showing that actually maybe there's some softening in this labor market. Maybe the Federal Reserve isn't going to be having to go so far, so fast. And actually, those probability of a Fed hike come November just dials back that little bit. We're seeing Bitcoin basically flat on the day as the dollar just comes down from what has been a rapid run-up. Move on and have a look at some of the individual players that we're looking at, because we have seen Tesla, your outperformer of choice on the day. We're up more than 4% on the NASDAQ. But we're seeing Palantir actually getting a bit higher. Of course, another Peter Thiel-related company. This one looking like it's getting close to clinching that important deal with the UK, with the NHS. We're talking healthcare much more later in the show. And Zoom actually on the downside, one of the worst performers. That as we see that it has announced some new products, and analysts, well, weren't particularly over. It seems with Microsoft, particularly in the docs area, we're off by 2.7%. But let's go back to the crypto story today, because it is a historic moment. A jury has been selected. Opening arguments are set to start today for Sam Bankman-Fried's trial, where he's accused of orchestrating one of the biggest financial frauds in American history. Joining us now from outside that very courthouse with the latest, Bloomberg's Shonali Basak, and we'll get us up to speed with who's going to be listening in on all these oral arguments.
Yeah, it's a good point. We are just getting an idea of what the jury will look like here. You're looking at a nurse, a physician assistant, a social worker who is currently unemployed and has previously served on a jury before. You are looking also at, folks who are retired corrections officers, other high school graduates, You have a mix of people here. You have a number of jurors here that, again, have been very heavily questioned here over the last 24 hours, Caroline, about whether they had preconceived notions about cryptocurrencies and other parts of Sam Bankman-Fried's world. tourism. That's another thing that the jury had asked to make sure that there weren't going to be negative vibes coming from that jury headed into this 6-week trial with very serious criminal counts being faced by Sam Bankman-Fried. Now, as I stand outside the courthouse, the jury, as we say, has been selected. We know generally who these people are, what they do for a living, how they have been questioned. The opening arguments are starting imminently as well. We will hear from the prosecution really for the first time to lay out their argument, and more importantly, we don't know how Sam Bankman-Fried prepares to defend himself against these charges, and we will hear from them as well in a series of 30 to 40-minute open remarks from both sides.
Of course, 31-year-old pleading not guilty to wire fraud, conspiracy to commit wire fraud, securities fraud, the list goes on, Shonali. It's quite a changed Sam Bankman-Fried who entered that courtroom, much slimmer and changed, well, certainly from a hair perspective, but how do we think his demeanor has changed?
In a lot of ways, to your point here, a lot of people have been talking about the way his appearance has changed. He looks noticeably thinner. According to the Wall Street Journal, he has also been dressing a lot differently, buying suits from Macy's at a 40% discount. Remember, he was known for that T-shirt and shorts and even flip-flops in front of even world dignitaries in the past, but now he is suited up indeed as he enters court himself. We'll see. We don't know that he will necessarily testify. He's not currently expected to testify, and what tone he would take if he would, but again, much more silent. We are not used to Sam Bankman-Fried being so silent leading up to these charges. You remember just how much he had taken to the media to describe what had happened at FTX, and ever since then, it's been nothing but silence. And so this will be a telling trial. Remember, after those opening remarks, which will take about an hour or so here, we will also start to hear from witnesses. And that will start to get very important as we know that a number of his closest friends and colleagues over time are expected to testify in this trial.
Important for the individuals, important for the industry. Liquidity in the digital asset market still only half of what it was before the FTX collapse. Shonali Basak on the ground there for us all day. We thank you for it. Meanwhile, coming up, we're going to get the outlook, well, for what we're all now talking about if it's not crypto. We're talking about AI, investing, and we're going to discuss why Apple CEO Tim Cook just decided to sell 500,000 shares of the iPhone maker. Let's have a look on Apple stock, of course. In fact, it seems to be timed along with a downgrade. KeyBank, the analyst over there, saying it's high valuation, weak sales outlook. The analyst really worrying about the stock's valuation as a large premium to the NASDAQ, they say. In US sales, they're likely to struggle. We'll have more ahead. Still managing to tread water, up 0.3% on a day where the NASDAQ is up more than a percentage point. This is Bloomberg Technology.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
City, in London, in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening. Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers Jobs Day like Bloomberg.
Time now for Talking Tech. First up, Apple CEO Tim Cook selling shares of the iPhone maker in his biggest sale in more than 2 years. Cook sold 511,000 shares. That's worth about $41 million after taxes. It's all according to a filing with the SEC. This all comes after Cook took a rare pay cut, about 40%, to just $49 million for 2023. Meanwhile, Intel is planning to make its Altera unit into a standalone business and take it public. The programmable chip division will become an independent entity starting January 1st. It's all part of the CEO Pat Gelsinger's efforts to really try and wring more value from the semiconductor company. Meanwhile, let's turn our attention to AI because Masayoshi Son has a message for Japan. Adopt artificial intelligence or get left behind. It was the SoftBank founder's first public appearance in months at SoftBank World. It's an annual event for the tech investors' domestic corporate clients. Now, the billionaire compared humans without AI to goldfish just in a bowl, unable to process information like language. So let's talk more about this AI euphoria, AI necessity, and how to play it. James Fishback's with us. He's the founder and chief investment officer of Azoria Partners, its global macro hedge fund. Prior to Azoria, of course, you were with macro investing over at Greenlight Capital. And James, therefore, with your focus on all the ways in which you could get long AI, is it about smaller companies, bigger companies? How do you play this?
Well, Carolyn, it's a real pleasure to be here. Let me say that to Masha's point, my name is Fishback, so I am the goldfish in this equation. So I'm trying to figure that out. But I think the way to look at this is to look at some of the companies that have the best balance sheets, the best markets, and existing user workflows and ecosystems, and then monetize off of that. At the risk of sounding like Steve Jobs in January of 2007 when he launched the iPhone, the types of companies I think you really want to look at in this environment are the hyperscalers, the ones that are providing the cloud computing infrastructure, the amplifiers of this technology that can then deploy it to existing users and devices, and the innovators, those who are either developing or are strategically partnering with those who are developing. And so, much like Steve Jobs said, these are not three separate companies in many cases. They're actually one company in several cases. Microsoft is one of them. I believe that Google and Amazon are others as well. And so it's a unique opportunity to own strong cash flow generative businesses that offer embedded optionality to capitalize on the AI boom.
Interesting that it really seems to be being owned by the United States at this time, James. When you're thinking about what's happening with Microsoft's partnership with something like an OpenAI, how do you see these sort of frenemies continuing? How do you see the companies striking these? We just had Amazon, of course, taking a big stake and partnership as well with other key players in the space. Does that accelerate? Is that just the way in which you want to see deals being done?
That's exactly what you want to see. You want to see key innovators of this technology, like Anthropic, like OpenAI, have strategic partners in Amazon and in Microsoft, respectively, to then deploy that technology. Look at Microsoft today. Their 365 Copilot product is now being opened accessed to 160 million enterprise users who can now use it to expedite workflows in Microsoft Word, in Excel, and in PowerPoint. And so you now take users who are already used to Microsoft Word, already used to the existing workflows that they have, and then you're supercharging it. You know, if I wanted to go to a Fortune 500 company and sell them Fishback AI and say it's the best word processor out there, I couldn't do that because I don't have those kind of relationships. Microsoft has a moat in this market. They have the relationships. They have the trust. They're going to drive value for enterprise players, and as a result, they can drive pricing power longer term.
Do you think that there's a risk that any of these really big, and in many ways, companies trying to fight the monopoly, oligopoly name that keeps being thrown at them, is there any risk they get displaced? I mean, in the same time as the dot-com boom and bust, in the same way that we've seen some business models just eroded, are all of them ahead of the curve? Are any of them at risk of losing their mantle?
You're absolutely right. I think there's reason to be skeptical, Caroline, by what happened in early 2000 with the dot-com bubble. But there's a couple key differences here. One is valuation. The peak valuation at the dot-com bubble was 52 times earnings for these average tech stocks. The average AI tech stock today at the top of the list has a PE of around 25 times. And that simple comparison is to say nothing about the strong fundamental position these companies are in. As I said earlier, they are free cash flow generative. They have strong balance sheets. They have simple, predictable businesses. They don't need to rely on debt and equity markets. Increasingly, a debt market that's seeing rising interest rates, it seems like every single day now, to fund the aggressive R&D behind this. So I think they're doing all the right things. Microsoft with OpenAI, Amazon with Anthropic, Google with DeepMind and its own internal operations to then power this forward. And the thing that I'm most excited about is these companies already have billions of existing users and device ecosystems that they can deploy this new technology to pretty much overnight. So you don't have to make a lot of assumptions here to see how powerful and how impactful this technology can be, not just for the end user, but also for their fundamental share prices.
And it's allowed the NASDAQ to really reap in the rewards for this year. But September was really ugly, James. And September was ugly because of the macro picture, because of the worry of what the Federal Reserve is going to do, how we tame inflation, a very strong jobs market. How do you think these big tech bets can withstand a higher for longer scenario?
It's a great question, and there's no doubt about it. The macro picture over the past month has been challenging, to say the least. Look at what's happened to 30-year Treasury yields in the U.S. and the higher for longer hawkish narrative coming from the Federal Reserve. I think the key thing to note here is that the AI view is not a multi-quarter view. It is a multi-year view. And so if you look at some of these companies, they have the potential to compound. In the case of Microsoft, it's compounded at 25% over the past decade, year over year. And that's despite all the macro volatility, both in the real economy and in the financial system we've seen. Yet at the same time, it's important to look at what this opportunity presents long term. I think a key assumption, Caroline, in this space is that higher rates is actually negative for this type of narrative, for big tech going higher. And I don't think that could be further from the truth. And here's why. Companies like Apple, who issued 30-year debt at a mid-2% rate back in 2021, that have termed out debt in many cases for 10 or 15 years, have strong balance sheets, are seeing higher rates, but are not actually seeing higher effective interest costs. One, because their liabilities have been fixed, the large issuance in 2020 and 2021 that was, of course, aided by quantitative easing at the Fed, and by their assets, rather, which are actually increasing in value as they're, in the case of Microsoft, a $100 billion balance sheet is compounding in line with Treasury rates at 3 to 4%. So I would push back against that narrative just a bit and view opportunities like this as an opportunity to actually get in some of these positions and develop a longer-term view on where AI is going to be in 3 to 5 years.
Really thoughtful. Thank you for laying that out for us, James Fishback of Azoria Partners, coming in with the macro perspectives for us. Meanwhile, coming up, look, we're going to get the latest on the micro details of Google's brand new Pixel line. Shanaz Sachs is going to be with us, Pixel Director of Product Management for Google. That's up next. This is Bloomberg Technology.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the Chief Future Officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Well, look, we know that Alphabet's Google has been going head-to-head with Apple in many ways for years when it comes to hardware, but really it feels head-on right now. The new Pixel phones, have you seen them? They're kind of more iPhone-like than ever before, particularly when you're looking at the price point. Bloomberg's chief correspondent, Mark Gurman, who has all the insight track around these product announcements. Give us your thoughts. What did you make of some of the updates, the camera, the way in which they look and feel?
Yeah, I mean, I think Google is continuing to push out, pretty impressive AI-driven products. The new Pixel phones, the Pixel 8, the Pixel 8 Pro, very impressive new camera features, new G3 tensor processors. This is their third generation custom processor. A few upgrades here that make it a little bit more like an iPhone. Surprisingly, the facial recognition on the previous Pixel phones, at least the last couple generations, they weren't graded security-wise high enough to be processed for payments using your banking apps. Now they've upped the security on that. As you know, Face ID on the iPhone since 2017 has had that level of security. The design of the Pixel phones continue to be some of the best smartphone designs on the market. But the trend continues here, right? Google is pushing out some really nice hardware, great software integrations, probably some of the best Android phones you can get globally. But that really hasn't translated into really strong amounts of market share, right? So that's the problem Google will continue to grapple with, at least for the foreseeable future, making really good phones and really good hardware products that are just not selling as well as their competitors from Samsung and Apple. And that's what Google now has to figure out. They have the right hardware. How do they get them to sell in those bigger quantities?
Well, point. We think Google has about 3% of the smartphone shipments during the second quarter, according to Counterpoint Research. Great analysis from Chief Correspondent Mark Gurman. We thank you, as always, for running us through, well, what the product's like, and he liked it. So let's talk a little bit more about what's in this product and how they do take on market share. Shanaz Zak is with us, Director of Product Management for Pixel at Google, fresh off the stage where you presented what are these big upgrades to the phones. And look, I've been agnostic for years. I've had Pixels, I've had iPhones, and I'm interested as to whether you like or dislike the idea of becoming more like an iPhone.
I wouldn't compare that, because I think Pixel are the best phones for Google, especially bringing the hardware plus the software plus the best of AI from Google into people's hands. And that's how we think about our phones, of it's bringing the best of Google in people's hands.
What about the best of AI? It does seem to be something people are now referencing far more within their product detail. I mean, now it's because finally a consumer really understands it. They can touch it, feel it, use it when they're using Bard, for example. How will that be interwoven to make it that much easier product to use?
So when Pixel started 7 years ago, even at that time, AI was a core part for Pixel, and we continue on that line. And as you saw in our announcement, we have AI with supported by our Tensor G3 across the phone, including our integration of Assistant with Bard that will be coming soon.
It's interesting that, of course, you have pushed up the price point. What is it? iPhone 15 Pro now, same as the Pixel 8 Pro, $999. Is the consumer ready for that price point? How did you sort of test and feel that that was the right amount to be charging?
There's a lot of testing we do, but as you can see in our phones, we've upgraded the hardware. We have a completely new camera system. We are also have a lot of software, and we're also supporting the phones for a longer period of time, for 7 years of OS support, security, feature drops. So that's how we think about our phone.
But it's interesting, therefore, isn't it, that Bielgo is supporting them for longer, so people might not need to renew for longer. How do you start to inch away at this market share that, as Mark pointed out, is sort of surprisingly low considering the integration of software and hardware?
So from Pixel and Google's perspective, we do want people to use their phone longer, and we see that people are using their phone longer, right? And so as part of sustainability also is important for us, and so that support was natural for us to help our users support their phones for a longer period of time.
Overall, when you're thinking as well about some of the not just sustainability but security that people want to be seeing, you have been up in the ante when it comes to facial recognition. Are people going to be frustrated that it took so long, or what actually goes into needing to ensure that you can qualify for those sorts of levels of security?
In terms of the phone, our phones always were secure. We had our Titan chip, and our phone security was supported for 5 years. So we are upping that to 7 years, and yes, they are one of the most secure phones out there.
What do you think it will take to get the market share higher? Why do you think there has been reticence? Has it been, and just because people are used to the iPhone ecosystem, it's harder to drag them out? Is it more that you therefore focus on an international consumer? Particularly, you've made real inroads in Japan, for example.
That's right. Pixel is the fastest growing smartphone in our markets, and it's the only phone that grew in units sold year over year. So we're definitely seeing that, and we're looking forward to more of that, and especially with all the AI features and all the amazing hardware and software, that's what we're going after.
How are you thinking internationally about your supply chain as well?
In terms of supply, like you mentioned it, Pixel is doing very well in our international markets in Japan as well. And so that is a core focus of how do we make sure that, users across the world in our markets get our phones.
And what about ultimately building the phone? Because there has, I think of an Apple that's had to really rethink the way in which its product is made, where it is made in this global landscape where suddenly China and the US just aren't getting on in quite the same way. How do you think about, with sustainability on the one side, also supply chain resilience on the other?
So like you said, sustainability is a big focus for us, and it's been years in the making. It's not something we're doing right now. As we announced on stage, actually, on sustainability, this is the first phone which is free of plastic. So sustainability, where it's made, how it's made, has been a key focus and is a key focus for us.
And a lot of this is also about, well, the entire ecosystem, not just the supply chain, but also of what you're offering alongside, the earbuds, the watch, the way in which you can interact across all of the software too. I mean, you're someone who's been at Google now for 17 years, I think it is. What is it that makes you so addicted to continuing to build with this company?
The people. The people. I've been at Google for I grew up with Google, and it might sound cliche, but I do love the people that I work with. They push you to think well. They push you to do the right thing. And that's what I really enjoy about working at Google, the people around us.
Well, we're thinking about your product today, Shanazak. Thank you very much indeed for joining us. We've got a few more of your people on the show a bit later. Director of Product Management for Pixel at Google. Great to have some time.
Thank you for having me.
Meanwhile, coming up, look, we're going to be taking the pulse of the VC industry when it comes to, well, the frontiers, whether it be crypto, digital currencies, particularly with the SBF trial upon us. I'm pleased to say we've got Morgan Bella joining us, partner at NFX next. Future technology, whether it's crypto, also space too. This is Bloomberg Technology.
That's me, Max. What's up? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Wall Street is waking up. Europe is already trading. And Manus Granny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything.
Good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets, China Open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
Welcome back to Bloomberg Technology. I'm Caroline Hyde in New York. Let's get you up to speed where these markets are, because we're bouncing back after yesterday's 1.8% drop on the NASDAQ 100. We're back up 1.1%. Even though we have political turmoil in the House in the United States, it's more a focus on the macro data. The jobs data ran hot yesterday, runs cooler today. Does that mean that therefore we're dialing back some of the anticipation of how far the Federal Reserve has to raise rates? We're seeing an S&P 500 that hit technically oversold levels yesterday, below that 30 level of the relative strength index. So now time to get a little bit of a pop, up 0.6%. But it really is big tech doing the heavy lifting on these sorts of benchmarks. 2-year yield screams back lower. That has been the pressure point. This has been the anxiety that we've had for the last few days. How fast yields have risen. Now we're down some 8 basis points on the 10-year. Move it on, have a look at what's happening in our own risk asset choice. It is, of course, Bitcoin. I'm currently seeing it treading water, up about 0.25 percentage point. The US dollar just maybe easing off a little bit today. But notably, this has been range bound of late. We're seeing 27,000 there or thereabouts of the level of Bitcoin. We know that liquidity has been thin, far thinner than it was, of course, a year ago. And we are really thinking about crypto at the moment, given the start of, Sam Bankman-Fried's time in court. Let's have a little turn our attention now to VC Spotlight and bring in Morgan Bella, partner at NFX Capital Management, who was also one of the founders of Facebook's cryptocurrency project Libra. Remember that one? She was building one of the first stable coins. You've ridden out what has been sort of the highs and the lows of how crypto more broadly is seen, not only by consumer Morgan, but also by a regulator in the US. I'm interested as we do start to see the time of Sam Bankman-Fried in court, the pain points relived for so many. How are you feeling about the crypto sphere in which you're investing? Is there activity going on, particularly in the startup community?
Thank you so much for having me on. I have a potentially not popular opinion on this, but I am so much happier investing in crypto today than I was 12 months ago, even before the FTX scandal. And a question that I've asked other crypto founders is, do you think that there's a chance that we look back on this FTX mess as a positive? And people looked at me kind of like I had 5 heads, but let me explain why. And I think it's FTX. It was crazy out there. And the laws of gravity were not thought to apply to crypto startups. And what FTX forced us, people in the crypto industry, to ask ourselves and answer, I think, were 3 straightforward questions that we all should have been asking regardless, which is, 1, does this company solve a problem for anyone or this product? 2, is anyone using this? And 3, will this make money? And there were so many companies, and there are so many companies that were funded, that are funded, that don't answer one of those three questions, let alone three of those three questions. So like the party that was going on had to come to an end. The FTX way of it coming to an end was the most dramatic way that could have happened. But I really do think that there's a chance that it ends up being a gift for the crypto startup world, for the companies that are solving real problems, which I know is not a popular opinion, but I do believe that.
We want contrarians, Morgan, and I'm interested in, even if this happens to be a cathartic moment for crypto more broadly, are the builders building here in the US? Are the problems being solved? Is the money being made? Are people using some of the dApps and some of the applications here in the US? Or are you having to go to abroad for those sorts of founders?
So yes, and like we are definitely still seeing companies built in the US. I think what you saw pre-FTX was everyone and their brother and sister was starting a crypto company because it was the gold rush. What has been filtered out now is people that are starting crypto companies are only starting crypto companies because they actually see a problem to solve and actually have a passion for the industry versus they just see a casino that looks fun. So I think that there's a filter now in a good way for who's actually starting companies. And then yes, people are using crypto applications, but if we're all being honest, like the only application that's really achieved any kind of product market fit as far as scale is Bitcoin, Ethereum, and stablecoins. But you're still definitely seeing development in the US.
It's interesting. We do understand, in fact, that the trial for Sam Bankman-Fried is underway, and we understand that opening statements being made. Bankman-Fried currently expressionless, we understand, as the government continued with their opening remarks saying that the defendant wanted money he didn't have and he committed fraud. But Morgan, let's move away from that for a moment to the regulatory environment with which we're in, because you do have an SEC chair who seems adamant to police, whether it's after these companies are built or as they're being built. And I'm interested as to whether that's really an environment people want to find product market fit in at the moment.
I think it's an environment that people want to find product market fit in if there is like a market and a business to be built, but it's definitely a thorn for sure. And I think an issue is there are very few topics that rally both sides and that gain you favor on both sides. So if you're a politician with political aspirations and you're trying to win favor on both sides of the aisle, going after crypto is one of a few categories that no one's going to really oppose you. So the incentives and the psychology behind that are definitely not in crypto's favor, which is a bummer.
Well put.
But there's still a prize.
Technical term.
I mean,
go in there then and get nitty-gritty with some of the problems you'd like to be being solved in this. I mean, what's getting you excited when you're getting up 12 months on and you're saying it's a far better environment to be writing checks into? NFX has a lot of money to put to work. You're already putting money into various startups, whether it's Stoke Space. I mean, whether you're also in Miston Labs. Ramp is a company, of course, that's all about trading of crypto and assets. Where do you want to see some of these problems solved for you?
Thank you for those shout outs. So stablecoins still, I spent 4 years banging my head against a wall. So I still think that there's a lot of room to go there, more from the US government buy-in side. And if you think that digital money is going to be the future, the US government really needs to recognize that and get on that, or else we're going to wake up and be living in a world with Chinese digital money running throughout the world in people's hands, which I don't think is a first choice for us in the US. And then also just usability. I think what you've seen with AI is ChatGPT had this moment with mainstream consumers. Crypto has not had its ChatGPT moment yet. So something that brings net new users into the world in a real, meaningful, productive way is, I mean, obviously the holy grail, and I don't have any specific answers, but something we're always looking for.
Well, we'll keep on waiting for the answer to. Morgan Bella, come back with it soon, we hope. Partner at NFX Capital Management. Great to have some time with you today. Meanwhile, look, here's something else that we're watching. Founders of online delivery companies worldwide. Look, they exploded during the pandemic in terms of they got a lot bigger, but now they're watching their fortunes disappear. The group includes the founders of, say, Turkey's Getir and Silicon Valley's Instacart, DoorDash. Well, they've now collectively lost $15 billion, more than in terms of overall market valuation. Coming up, let's talk about healthcare tech. The startups, Commure and Ethelas, they're merging to drive value for doctors and patients using the power of AI. Conversation with Tanay Tandon, CEO of Commure, as he brings those two companies together under his leadership. This is Bloomberg Technology.
Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, the big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Taking a look at Palantir shares for you today, because the data analysis firm, co-founded by tech billionaire Peter Thiel, of course, but is closing in on a contract with the United Kingdom's National Health Service, the NHS. It could be a 5-year agreement, which is designed to help the agency analyze medical data, detect suspicious patterns, ultimately overhaul its entire system. Now, sources say the government is on track to announce Palantir as the winning bidder as soon as this month. Now, from one Tolkien-inspired name to another in the world of healthcare, 2 healthcare startups are forging a new path using artificial intelligence to become a health operating system. Data platform Commure and Athelas, which is also from Middle-earth, which builds remote patient monitoring technology, will complete a merger by the end of the month. Joining us now is Tanay Tandon, CEO of Commure, who was, of course, leading Athelas. And I'll ask you at the end why Tolkien is such a big part in all these naming of these companies. But Tanay, ultimately, you're trying to use AI to make healthcare more, efficient in the same way that Palantir might do with the NHS, correct?
That's right. And first of all, I'm impressed you got the Lord of the Rings reference. Most people don't. But that's exactly right. We're taking one of the biggest pain points in healthcare, which is a disparate set of data sources across hundreds of different systems and tons of manual work that doctors and administrators do every day, and supercharge that with large language models to automate workflows and grow doctors' revenue and health system revenue.
What everyone is, of course, slightly concerned about with Palantir and the NHS is data and data sharing and the knowledge. How are you making sure that from the get-go, the users, ultimately at the end of this, feel very secure about the security of their data?
I think that's a non-negotiable. When you look at healthcare IT companies, software businesses, it really comes down to making that a P0 in terms of how you design your systems, and working forward from there to really help, at the end of the day, to drive value for doctors and clinicians, while at the same time protecting patient information. And the companies that, go ahead.
I know, I was just going to say, driving value. Well, clearly the business that is bringing you together and some of your VC backers think that you're going to have a lot of value, and ultimately together you've got a combined valuation of about $6 billion. And tell me about the revenue streams therefore today. How are you going to be building and making sure that you can win business in a profitable manner?
Definitely. I think the exciting thing about healthcare is it's 20% of U.S. GDP. Athelas already processes hundreds of millions of dollars worth of claims. Commure deals with billions of dollars worth of appointments every single year. And this is just a small percentage of the total dollars that flow through the healthcare system. And the exciting thing here is that we can use software that at the end of the day automate these workflows and drive a profit margin for health systems, and end of day take a small cut of that to grow the profitability of our own business.
How did this merger come about? Was it all to do with General Catalyst? Of course, it was backing both of you.
I think this merger's been a long time coming. I've known Hemant Taneja, the managing director at General Catalyst, for 7 years now. He's known me since before I dropped out of school to found Apellis. And end of day is a marriage made in heaven. These two companies serve similar customers, have similar end goals. One has a data platform that saves time. The other builds large language models and revenue cycle software. You put them together and you get magic.
And talk about those large language models that are going to sort of be part of the magic. There's a lot of hand-wringing around AI, around ultimately how it disrupts, how it boosts productivity, but also how you regulate it. How are you managing to weave LLMs and actually make it really integral to your business solve here?
I think there's a lot of noise in the LLM space, but there's also a ton of signal. The first time one of our doctors used Scribe, which is an automated workflow for transcribing information and generating CPT codes, their jaw dropped. And it saved them a couple hours that single day in documentation. And so for us, language models are a tool to accomplish an end goal rather than the goal itself. And I think businesses that use them as a powerful software and automation tool will continue to grow and will continue to serve their customers in a very unique and honestly novel way.
Go in there on the unique and novel, because there have been a fair few startups looking at tackling healthcare, making it more efficient, more easy to use with the power of AI. We're just hearing how Palantir is going to be sort of taking on the NHS. What makes you different?
I think the exciting thing here is GC's health assurance ecosystem. We have HCA Healthcare, which is the largest hospital operator in the country, on our board and one of our largest customers. We have thousands of small businesses in terms of small practices like private doctors, a solo practice, 10 provider clinics also on the platform. And so the breadth of appointments, the sheer volume of notes that we're processing every day, I think is what makes us very unique. And the partnership, the deep partnership with legacy healthcare. We're not trying to disrupt anyone, we're just trying to empower them.
And then what of your post-merger being? Where do you take this? Are you going to have to cut down on people ultimately? How are you going to ensure that you're margin-focused, revenue-boosting in a time where that's exactly what VCs want to see?
The mandate here is to grow. We're a company that thankfully both companies, 5+ years of runway, independently on track to go public as individual companies. Bringing them together only accelerates that path. And I think we're going to be one of the biggest hirers in the next year in healthcare and software. And so hopefully a home for many of the folks that did get laid off in the last year or two.
You were busy raising money when you were leading Apellis, and I'm looking at what Sequoia, General Catalyst, as you mentioned, Y Combinator, but also NVIDIA. And I'm interested about how, at the moment, where there is such fierce competition for compute, for chips, for access to be able to build these large language models, how much is that a hang-up for you?
This is a defining moment in computing. I think what NVIDIA's unlocked is a new kind of magic in terms of software and automations. And end of day, they're going to make a lot of money on it, but so are a lot of other great companies, and they're going to build a lot of great products. And my goal as the CEO of Comure is to leverage the power of GPUs to train these models to do things that just weren't possible before. And so there'll be a fight for GPUs in the coming years, but ultimately I think everyone will get their share.
Tanay, great spending some time with you. Tanay Tannen, CEO of Comure. And it wasn't me who knew the Tolkien stuff. It was my producer, Marguerite, so shout out to her. Meanwhile, let's take a look at the summer of strikes, the continuing of basically bleeding into the fall now. More than 75,000 Kaiser Permanente workers in 6 states have taken to the picket lines. The 3-day strike is expected to shut down services for non-essential services for nearly 13 million people in at least half a dozen states, making it the largest strike by healthcare workers in recent US history. Coming up, more on Google's latest announcements with a focus on, well, health. We're going to be joined by James Park, Fitbit co-founder, Vice President, General Manager of Google. That's next. This is Bloomberg Technology.
consumer markets in the world. And there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Source for news and analysis covering the biggest challenges facing the UK government, economy, financial services and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
Let's get back to Google's announcements today. It's not all about the Pixel lineup because, well, Silicon Valley company also wants to compete with Apple and many more health trackers, for example, and watches with the Pixel Watch 2, which includes faster Qualcomm chip. It's also lighter. Let's bring in James Park, Fitbit Vice President, General Manager at Google, who's just been presenting the new watch. And how are you setting yourselves apart? What is the offering that you have different from some of the other things that are on the market right now, James?
Great question. One of the key things that we wanted to do was improve upon the great things that we did in the first generation Pixel Watch. So as you pointed out, we introduced a new processor, which makes the performance a lot smoother and snappier, and it's very noticeable for our users. We've also dramatically improved the battery life as well. With the always-on display on, you still get 24 hours of battery life, and we're also offering much faster charging time for our users as well. And along with that, one of the most important aspects of the Google Pixel Watch 2 are its safety and health features. So we offer this feature called Safety Check. You just check in, and if you don't check in after a certain period of time, your location will be automatically shared with your emergency contact. So it gives you that peace of mind. And then we've introduced 3 new health sensors, including skin temperature, dramatically improved heart rate with 40% more accuracy, and a new sensor called body response to help you manage your stress. So there's a lot of improvements packed in this next generation of the Pixel Watch that we're really excited about.
Who's your typical buyer right now? I, as a parent, immediately am starting to look at the world of smart watches as a way to ensure my children are safe. But who is generally the purchaser and wearer of this?
I think it's really anyone and everyone who's interested in just improving their overall fitness levels and also interested in having a great companion to their phone as well. So the Pixel Watch 2 not only combines helpfulness features like Google Maps and Wallet, but a lot of great health and fitness features as well.
Can you push us forward? I know it's frustrating on a day where you're just announcing the second version, but what does health and health wearables look like in the next few years? Many have been hoping for blood glucose monitoring. Many are now looking at, AI and the way in which you're going to have an AI wearable. How are you trying to be ahead of the curve at Google?
So you can see from the leap from the Google Pixel Watch 1 to Google Pixel Watch 2 that there's always a continuous spectrum of improvements that we're making. from general purpose helpfulness to health and safety features. And what I imagine for the future is that these devices, whether they're trackers or smartwatches, are going to be very essential component of people's lives. It should be something that you don't want to leave home without one, because they can massively improve your life, or they can even help save your life in the future. For instance, our watches have an algorithm that help detect irregular heart events like AFib, which can massively increase the risk of stroke. So all of these things, I think, really bring a lot of helpfulness and utility to people who wear them.
What are some of the biggest blockers to the next iteration, to the next vision of where you see healthcare going from a wearable?
Well, I don't see them really as blockers, but I see them as opportunities. For me, the things that are really exciting for me are introducing technologies that were only available in a hospital-grade setting or medical-grade devices, and bringing that capability and that helpfulness to as many people as possible. And that requires breakthroughs in power management, better processors, improved sensors that can actually fit within the confines of a smartwatch. So to me, those are really exciting opportunities of research. And I think, we hinted at this in our announcement today. The application and the use of AI in healthcare is going to be an exciting new frontier, where AI can really find connections and correlations in your health data that were just very difficult to spot before, and give you personalized insights and guidance and coaching.
James Park, Fitbit Vice President, General Manager at Google, fresh off the stage. We thank you for it. Meanwhile, that does it for this edition of Bloomberg Technology. You do not want to forget to check out our podcast. Go find it on the Terminal 9, on Apple, on Spotify, iHeart. This is Bloomberg Technology.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section, and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better, and we shouldn't be an afterthought.
On the next episode.
markets. I'm Matt Miller. Let's get a quick check of where the markets stand at this hour. We do see gains now on the equity indexes. The S&P 500 up about 0.5% or 21 points to 4250. We also see a 10-year yield coming back down. So a little bit of a reversal on both sides there. 473.29 going out 5 significant digits. Of course, we had been all the way up to 490 on 10 years. Bloomberg U.S. dollar index right now coming off, but still at very high relative levels. The same is true, of course, with Treasuries. The Bloomberg dollar index at 1274, 1275, and you see oil continuing to drop now, losing another $3.94 a barrel to 85.29. The main thing keeping yields at this elevated level is concern that the Federal Reserve will continue to keep rates higher for longer. Here's what Franklin Templeton CEO Jenny Johnson told Bloomberg earlier today.
My gut is that the Fed raises one more time. Why not? It's built into the market. And then the question is, how quickly can they cut? And I think that even, it certainly is not going to happen before the second half of next year. My fear is that this sticks around for longer than the market expects.
Bloomberg's Abigail Doolittle has more on this, I guess, unprecedented rise in bond yields. Abigail?
Yeah, it is pretty incredible. And that idea that we could see one more hike from the Fed, I wouldn't be surprised if there was even more than that. The question of cutting, I don't know how that's even coming into play, given the fact that the Fed hasn't been talking about it at all. The idea that there could be cuts next year, to me, that would mean a recession would have to match a recession. I can't make sense of it any other way. Taking a look at yields, though, on the year, look at this huge backup. Now, this is clearly an upside down world between the 2-year and any of the other parts of the curve. Here it's a little bit better, but not really all that much. But the 2-year yield above 5%, really paving the way for the rest of the curve to go higher. Of course, we've had some big names talking about the idea that the 10-year yield is going to go back above 5%. Some people out there have been floating double-digit numbers. From a technical chart perspective, I can't get to a double digit, but you can get to 8 or 9% really pretty quickly. Let's put this move into the perspective of a chart, because this backup is extraordinary. This is probably one of the few times, if the only time in history, where you can say that the backup is basically equal to the yield. This is the 2-year yield. The backup is 4.92%. The yield itself, 5.06%. Such a narrow spread. That just shows you how tight things were back coming out of the pandemic. And now with the Fed hiking, we have this massive move higher in yields. As for what this means for some of the credit out there, well, junk credit and junk bonds in particular hit to some degree. If we go into the Bloomberg terminal and take a look at JNK, on the year, it's down just slightly, but you can see that this uptrend has broken, suggesting more selling could come. We could go back to the 2022 lows. Over the last 2 years, we're down about 20%. So the junk bond market is in a bear market, Matt. As yields go higher, it makes current bonds, the return, look a little bit less attractive. And as for what could be behind this move for yields, well, there's all kinds of ideas, and of course, the Fed is a main one. But there are a couple other things to take a look at, including the yen. As the yen goes lower, the Bloomberg dollar index, you can see the spread here, that it's really, this is yen weakness here. People borrow the yen and then they turn it into dollars or other assets. So the yen carry trade is certainly a piece of it. You can also see GDP is sort of solid. And then take a look at the unemployment. We have a really low unemployment rate. So in some ways, the economy is really pretty strong, a little bit hot, and maybe that's why the Fed stays in place.
Yeah, very interesting stuff. I look at INGO a lot, which is just a collection of key fixed income indexes on the Bloomberg terminal, and it's really high yield is the only place that you see any gains year to date, whether it's global high yield, whether it's European high yield or U.S. corporate high yield. Nowhere else other than Chinese aggregates do you see gains year to date. So very interesting market. Bloomberg's Abigail Doolittle, thanks very much for that. Now, Liz McCormick is Bloomberg's chief correspondent of global macro markets. She joins us now on this run-up in yields that we've seen. And there have been a number of times over the past few weeks when people have said it's a screaming buy, back up the truck, yields aren't going to go any higher, but they just continue to get higher and higher. What do you think is going on here, Liz? Are the bond vigilantes back?
Well, I
was saying to someone earlier, let's not use that title because it brings its own issues sometimes. But I would say that in the sense that the bond investors are saying we command some compensation. There is too much risk, especially in the long end of the Treasury market, 10, 30-year bonds, et cetera, that to park our money with you if we don't get some more yield compensation, a la higher yields, right? Let's get out of the wonky stuff. And I think that comes from a lot of what Abigail said. Labor market remains strong, although ADP was kind of soft today, so that's helping yields fall off. But we have a plethora of bond supply from the U.S. government that has started to pick up. It's going to continue to pick up well into next year. We have a deficit. We have the Fed getting out of the bond holding business. That's all adding to it. And then bouts of when oil was picking up. I heard Ray Dalio on TV yesterday with you folks saying, I think inflation is going to stay sticky, maybe around 3.5%. That adds to you want a higher yield in the long end of the market. So I think it's all kind of coming together.
Do you have any sense that some of this, at least, is driven by the fact that we're looking at $1.5 trillion deficits? And clearly, Congress is in no place to do anything about that. We're looking at a $33 trillion debt that's marching, I think, a lot quicker than anyone expected to, maybe 50 trillion by the end of the decade? I mean, that's a little bit terrifying. Do bond markets think in these big picture terms, Liz?
Yeah, I totally think so. I know in years past, maybe I've even been the one writing about deficits and stuff, and people kind of say, like, chill out. But now I think the dynamics have changed because, like you laid out, the trajectory is really troublesome. Plus, Matt, which I think we've talked about before, the issue, too, is usually you get such deficit situation when we're in a recession and the government's trying to help us get out of that. Now we do have growth. I mean, it's slowing, but we have growth. And there's, obviously we just had the Speaker of the House ousted. I mean, we did get a temporary, deal, so we didn't have a government shutdown, but there's just nothing on the radar from our Washington politicians right now for, cuts in spending, raises in taxes, things that will deal with the deficit. And let's add to that, the Fed bringing their policy rate to a 22-year high. The U.S. Treasury Department is seeing their interest burden just to service the debt they have just catapult higher this year. And that's eating more into all, there's not too many discretionary spending components, right? You know what I mean? So they just have to pay up more and more to service the debt. So I think the Treasury market, investors globally have taken notice. Plus, like you brought up the BOJ, rates abroad have gotten higher. So there's better options. It's not like the Treasury market is the only game in town for a decent yield anymore.
All right, Liz, thanks so much for joining us. Liz McCormick there talking to us about the rate situation. Let's bring in Wells Fargo Bank macro strategist Eric Nelson to talk about, his take on this. Eric, what do you think is behind the drive higher? And can yields go higher from here?
Well, Matt, you have to sort of keep in mind that the move is almost entirely in real yields. So it's not as necessarily as if this is some sort of necessarily sticky inflation where people want to get protected against that kind of move. If anything, we're actually almost seeing the opposite, less demand for these inflation-protected securities. There's a couple things going on here. I think part of the issue is we've broken some really key technical levels. We're kind of in this sea of unknown levels here where, what's the right price for our star? 225, 250, 275? No one has a great idea. The other problem is talking to a lot of investors, a lot of them are probably happy to miss the first 15, 20 basis points of a rally as opposed to getting caught up and trying to catch the falling knife. So you need some sort of momentum behind a rally, and then you'll see the flush lower. But we just haven't had that catalyst yet. Could be the jobs number on Friday, certainly possible. ADP today, unfortunately, not a great signal one way or another in terms of its reliability. So I think we're going to have to wait for that number.
So if we do get a strong jobs number and continue to see this very low unemployment, Eric, that, I think, is more ammunition for the Fed to raise rates again. And as Liz pointed out, it's already been priced into the market. Do you expect them to go in November?
Well, the key message, Matt, to me from Powell's last press conference was the use of the word carefully, which I think he said something on the order of 15 times. I think he's biased toward not hiking. Of course, there's others who have different opinions on the committee. But also the notion that the Fed wants to see above trend growth to actually keep hiking. I'm not sure they're going to see that. Yes, if you see a 250 number on jobs, that's probably something that can spur a hike. But I think at this point, there's enough of a, sort of lack of consensus here that, 125 or 175 won't necessarily drive, the Fed to hike, especially if the unemployment rate keeps ticking up. We're up, 0.3 percentage points off the low. So I think the Fed wants to be careful here. I'm not sure a hike is necessarily a sure thing.
How much do you think this bond market sell-off is a reaction to spending that looks kind of out of control? I mean, you could kind of understand running $2 to $3 trillion deficits during the pandemic. But we cut it down to $1.4 trillion last year, and now we're back up to more than $1.5 trillion this year. There's nothing to stop government spending.
Yeah, what's so funny, Matt, about this narrative and this move is, we and surely others have been making this argument for a while. Watching for, risk premia, term premia. Obviously we've had a regime shift in inflation. Deficits have started to widen out again in recent months. So all these forces have been in place for a while, and for some reason, for whatever reason, the first half of the year was characterized by mostly strong price action in Treasuries, mostly rallies in bonds, and we've now seen the complete opposite. Hard to know exactly why it flipped, but I do think that these forces are still in place here. We are still bullish on bonds. We think certainly at these levels, you definitely want to be scaling in to both tips and to nominals. But understand that it's difficult to sit here and go all in when we're a little bit in limbo from a technical perspective. But we are, looking ahead over the next 6 months, we remain very bullish on U.S. fixed income.
All right, Eric, thanks so much for joining us. Wells Fargo Bank macro strategist Eric Nelson talking to us about the run-up in yields. Coming up, we are awaiting President Biden, who's set to discuss his plan to cancel more than $9 billion in student debt loans. Plus, he may discuss the ouster of Kevin McCarthy as the Speaker of the House. We'll discuss the state of D.C. as well with Isaac Boltansky next. This is Bloomberg.
CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
This is Bloomberg Markets. I'm Matt Miller. We are still awaiting President Biden. He's set to discuss his plan to cancel more than $9 billion in student debt loans. Not as much as he wanted to cancel, but still a pretty decent amount. Plus, he may discuss the ouster of Kevin McCarthy as Speaker of the House. Let's bring in BTIG Director of Public Policy, Isaac Boltansky. And Isaac, we'll start with that. I mean, 8 Republicans voted to throw out McCarthy. All of the Democrats voted to throw him out. And it looks like at the end of the day, the Democrats are punishing Kevin McCarthy for being bipartisan, for reaching across the aisle, for making a deal. And they know they're going to get somebody in his place who will not make a deal. So the government will be shut down next time.
Yeah, so look, I think you've said it well. There's something to be said for the devil you know, and right now there's no clarity as to who is going to be the next Speaker of the House. We know that Majority Leader Scalise is going to run. We also know that Jim Jordan is going to run. We know that it's going to take some time, and there are probably going to be a number of lengthy votes that we have to all live through again. But most importantly to me and our clients, I keep hitting the point. It's hard to believe that they are going to use this time wisely to then advance all the spending bills that they want to advance so we can finally get to the negotiating table and craft a deal to fund the government beyond the November 17th deadline. That's the deadline that we should all care about, because without a deal before then, the government will shut down, and we all know what happens then.
Is there any hope that that there will be an adult in the room that's going to slow down what has to be described as runaway spending at the federal level here, Isaac? Because, you know, the only people who seem to be able to do anything about it would shut down the government. Let's go and listen to President Biden. He's coming out and speaking right now.
What took place yesterday in the Congress? I'll be very brief. The House will now reorganize and select a new speaker. I know it's going to take some time, but I remind everyone, we have a lot of work to do, and the American people expect us to get it done. The argument we reached was all about what comes next, but we had an agreement. We reached an agreement over the weekend. Funds for government, only another 40 days. We cannot and should not again be faced with an 11th hour decision on brinksmanship that threatens to shut down the government. And we know what we have to do. We have to get it done in a timely fashion. More than anything, we need to change the poisonous atmosphere in Washington. You know, we have strong disagreements, but we need to stop seeing each other as enemies. We need to talk to one another, listen to one another, work with one another, and we can do that. I join with Minority Leader Jeffries in saying that our Republican colleagues remain committed to working in a bipartisan fashion. We were prepared to do it as well for the good of the American people. Twice in the last 6 months, both houses came together on a bipartisan basis. Once to avoid default, once to keep the government open. And while we should never have been in this situation in the first place, I'm grateful that leaders on both sides came together, including former Speaker McCarthy, to do the right thing. Now, turning to student debt relief. When I ran for president, I vowed to fix our broken student loan program. Because while a college degree is still the ticket to a better life, that ticket has become excessively expensive. Americans who are saddled with unsustainable debt in exchange for a college degree has become the norm. Since my administration has taken significant action to provide student debt relief to as many borrowers as possible, as quickly as possible. That starts with making sure the existing system works and the way it was supposed to work for student borrowers. We fixed what was called the Public Service Loan Forgiveness Program, which was designed originally to make sure school teachers, firefighters, social workers, and other public servants can get their student loans forgiven if they make 10 years of payments and do 10 years of public service. By the time I took office, that program had been in place for nearly 15 years. But because of red tape, only 7,000 borrowers had been helped. Well, today, thanks to the reforms, more than 700,000 borrowers have had their debts forgiven. Just the other day, I spoke with Tanya and Chad, a married couple in their 50s, who both work at public high school in Milwaukee. For years, they paid over $800 a month toward their student loans. It meant they couldn't put away any money for retirement. And this summer, thanks to fixes we made to the debt relief program for people in public service, Chad and Tanya's remaining balance was forgiven. Tanya said, quote, "The amount of relief this gives us is indescribable," end of quote. Now they can finally start savings for retirement. Next, we fixed what's called the income-driven payment repayment program. And here's how that works. If you have an undergraduate loan, after 20 years of straight paying, not missing paying the debt on a monthly basis, whatever is left of your loan is forgiven after 20 years. But because of administrative failures, some people who did pay their loans for 20 years or more did not get the debt relief they had earned. We fixed that and made sure borrowers got credit for every single payment they made. As a result of these changes, today I'm announcing my administration has approved an additional $9 billion in relief for 125,000 borrowers in just the past few weeks under that program. With the latest debt cancellation in total, my administration has canceled $127 billion in student debts for nearly 3.6 million Americans. This kind of relief is life-changing for individuals and their families, but it's good for our economy as a whole as well. By freeing millions of Americans from the crushing burden of student debt, it means they can go and get their lives in order. They can think about buying a house. They can start a business. They can be starting a family. This matters. It matters in their daily lives. This latest progress builds on other steps we've taken. We made the largest increase in Pell Grants in over a decade, helping students and families making less than $60,000 a year get to college. We made additional improvements in the income-driven repayment program. Before I took office, student borrowers would pay no more than 10% of their discretionary income on a monthly basis if they wanted to do it that way. But under my administration's plan, which is called SAVE Plan, we reduced that to 5% for undergraduate borrowers. It's now the most generous repayment program ever. Under this plan, no one with an undergraduate loan today or in the future, whether at a community college or a four-year college, will have to pay more than 5% of their discretionary income to repay these loans. That's income after you pay for necessities like housing, food, and other necessities. You can sign up for the SAVE plan at studentaid.gov/save. studentaid.gov/save. And remember, if you keep up your payments after 20 years, whatever's left in those loans is forgiven. And we're still not done. As you might remember, last year I announced a major proposal for student debt relief. We're on the verge of providing more than 40 million Americans with real relief from their student debt. The money was literally about to go out the door, but Republican elected officials and special interests stepped up and sued us. The Supreme Court sided with them, snatching from the hands of millions of Americans thousands of dollars in student debt relief that was about to change their lives. As I said at the time, I believe the court's decision to strike down my student debt relief program was wrong, but I promised I wouldn't give up. Since then, my administration has been pursuing a new approach, grounded and under a different law, the Higher Education Act. This act allows the Secretary of Education to compromise, waive, or release loans under certain circumstances. Last week, the Department of Education took a critical step in this process by identifying specific challenges that borrowers face in the current system, so we can move forward with a new rule to address these changes. For example, there are many borrowers who have made payments for many years, but because of interest, they still owe more than they originally borrowed. My administration is doing everything it can to deliver student debt relief to as many as we can, as fast as we can. This is in contrast to House Republicans who helped block the previous debt relief plan, nearly shut down the government over the extreme demands, which would have hurt hardworking families. But they had no problem with the Paycheck Protection Program. Remember that? The PPP program during the last several years, which was designed to help business owners who lost money, which is legitimate, because of the pandemic. Members of Congress got over hundreds of thousands of dollars in order because their businesses lost money. It was a worthy program. Let's be clear. Some of the same elected Republicans or members of Congress who were strongly opposed to giving relief to students got hundreds of thousands of dollars in relief for themselves to keep their businesses open. Several members of Congress got over $1 million, and all those loans were forgiven. The hypocrisy of this I find stunning. I supported that program, and I support the student debt program. My administration will continue to use every tool at our disposal to help ease the burden of student debt so more Americans can be free to achieve their dreams. It's good for our economy, it's good for our country, and it's going to change their lives. Thank you very much.
Mr. President, my question is on Speaker McCarthy, if I can. Speaker McCarthy, then Speaker McCarthy, said that the two of you hadn't spoken directly in a long time. Why is that, and are you committed to engaging more regularly with the next House Speaker?
We had 2 agreements we shook hands on, and I assumed he was working with, I knew he was working with the Democrats in the House and Senate. It wasn't for me to do anything. If he wanted to talk to me, I was available. I'm available to whomever wants to talk to me. But the idea that I was going to somehow convince McCarthy to change his view was not reasonable.
Can I ask you a question very quickly? Does the disarray on Capitol Hill after your conversation with allies yesterday worry you that you won't be able to deliver the aid that the U.S. has promised to Ukraine?
It does worry me, but I know there are a majority of members of the House and Senate in both parties who have said that they support funding Ukraine. With your, I'm going to be announcing very shortly a major speech I'm going to make on this issue and why it's critically important for the United States and our allies that we keep our commitment.
Mr. President, are you also concerned about the rest of your domestic and foreign policy initiatives being imperiled because of what we saw happen yesterday, the dysfunction in Congress, the chaos that we saw on the House side? Does that concern you in any way?
The dysfunction always concerns me. The programs that we have argued over, we passed bipartisanly. I'm not concerned that they're going to all of a sudden come in and try to undo them, although there will be some. There will be some, I'm sure. There's half a dozen or more extreme MAGA Republicans who would like to eliminate just about everything I've done. But I don't think that's going to get there.
If I may, without additional funding, how long will the United States be able to support Ukraine?
We can support Ukraine in the next tranche that we need, and there is another means by which we may be able to find funding for that, but I'm not going to get into that now.
Mr. President, have you promised President Zelensky attacks for Ukraine?
Say again, I'm sorry?
Have you promised President Zelensky during his visit in the White House that you would provide attacks, the long-range missiles for Ukraine?
I have spoken with Zelensky, and everything he's asked for, we've worked out.
Tell us a little bit more about this speech you're going to give. What argument are you going to make?
Why don't you wait and listen to it? I'm going to make the argument that it's overwhelmingly in the interest of the United States of America that Ukraine succeed. And it's overwhelmingly in our interest. I've spent 2.5 years putting together coalitions that no one thought could be put together. And they've strengthened us across the board, not just as it relates to Ukraine, whether it's Japan and South Korea, or whether it's what's happening in Europe itself. And so I think that it's clear to the vast majority of the foreign policy community on both left and right that this has been a valuable exercise for the United States of America to increase the support we have around the world. And what I don't want to do is we put together over 50 nations supporting Ukraine. And we are the organizer of that. I met with, don't hold me the exact number, 16 or 17 yesterday, a long conversation, and made the case that I knew that the majority of the American people still supported Ukraine, and the majority of the members of the Congress, both Democrat and Republican, supported it. So I don't think we should let them gamesmanship get in the way of blocking it.
Mr. President, what is the plan for those businesses? Sir, not that they're asking, what's your advice to the next House Speaker?
That's a bubbling pain grade.
Thank you, sir. I did not hear his suggestion for the next House Speaker, but that was President Biden there talking a little bit about the U.S. Congress after Kevin McCarthy was thrown out as Speaker of the House for making a bipartisan agreement, as well as the student debt relief plans that he has. I want to welcome in our BNN audience right now. They join us here on Bloomberg News. And John Ehrlichman, welcome to the show. Great to have you here after listening to President Biden there. Let's bring in BTIG Director of Public Policy Isaac Boltanski, as well as Bloomberg's Wendy Benjaminson to talk about both the, I guess, chaos, as some have called it, in Congress, as well as this new proposal for student debt relief, which is only, I suppose you could say, $9 billion in the face of $1.5 trillion of annual deficits. That doesn't seem like very much, but it's still spending money that we don't have. And Wendy, I wonder why the president is so focused on student debt relief. He thinks it'll be helpful to the economy, but there's much more money in mortgage debt. Why not cancel out mortgage debt if you want to help out American people?
Young voters. Young voters. They are the ones, they are much more likely to support Biden for his reelection than they would Donald Trump, the likely Republican nominee and former president. And so they are unimpressed so far with Joe Biden's handling of things, especially the troubles he's had with relieving their student debt. And so this will be good for the economy. It'll put more spending in people's hands, and at the same time will give relief to mostly young voters, lower income people who he desperately needs to turn out in November of 24.
Isaac, what was your takeaway from that press conference we just heard? You know, it goes to the overspending discussion that we were having earlier, but it's a lot easier to overspend when you have somebody like Kevin McCarthy there who's willing to make a bipartisan agreement, and President Biden lauded him. Why did the Democrats then throw him out?
Yeah, look, so first on Congress, I'm reminded of that old saying that when the universe wants to punish you, it gives you exactly what you asked for. And I truly think that it's going to be far more difficult to get any type of compromise done in the House than it was under McCarthy. And I think that that means that the odds of a shutdown in mid-November have increased. I also think that means that it's going to be far more difficult to get any type of compromise done at the end of the year regarding tax extenders or one-off policy items like campus banking. In terms of the student loan side of the equation, it reminds me of the final years of President Obama's term when he said that he was going to use his phone and his pen to move forward administrative actions. And I completely agree. This is about younger voters. I would throw on top of it, he's doing it because he can. The Higher Education Act gives him wide latitude in special circumstances through rulemaking to cancel these loans. And by my count, he's up to about $127 billion in canceled student loan debt, impacting 3.5 million borrowers. So it's not the huge splash that he wanted through the larger cancellation plan that would have done $400 billion all at once, but he's chipping away at it.
And Wendy, if the president is urging this end to a poisonous atmosphere in U.S. politics, obviously at an increasingly jittery time for the economy, what do you expect the dialogue to look like over these next few days, these next few weeks, especially at a time when everybody's trying to figure out who ultimately ends up being the speaker?
Well, I think the ouster of Kevin McCarthy, as some of others have said here, is certainly increases the amount of rancor among Republicans, first of all, and then depending on who can get the 218 votes to become Speaker, who will probably be somewhat conservative within the Republican spectrum, that will mean things will be less bipartisan. I mean, Kevin McCarthy was no liberal Republican, but as Biden said, he had been able to work with him at one point, and then, he was pushed to the right by this, by the Freedom Caucus and by this one-person motion to vacate. So if the new speaker does not have that threat hanging over his head all the time, he or she might be able to do some negotiations. But we think Ukraine funding is in danger. We think we are headed for another government shutdown and right before Thanksgiving. So, we're in for a bumpy ride here this fall.
Right, and that threat, of course, remains maybe healthier and stronger than ever in Congress. Wendy, thanks so much for joining us. Wendy Benjaminson there from Bloomberg, and BTIG Director of Public Policy, Isaac Boltanski. Thanks so much for sticking with us. Now, programming note, speaking of the threat, Representative Matt Gaetz will be on Balance of Power at 5 p.m. Eastern for a wide-ranging interview with Anne Marie Hordern and Joe Matthew. He seemed to be really the catalyst, obviously, to drive Kevin McCarthy out of Congress, although he couldn't have done it without the help from the Democrats that he got in full force. So it'll be interesting to see what he has to say about that. Another concern for President Biden and for the U.S. economy is the current UAW strike. General Motors appears to be preparing for the long haul. They're going to the mattresses with a $6 billion line of credit to shore up liquidity and maintain operational flexibility. Bloomberg Detroit Bureau Chief David Welch joins us now in our New York headquarters. So, David, what do we know about this line of credit and how long it gives them? Because they've already spent hundreds of millions of dollars in the strike that we've had so far.
That's right. So the losses of $200 million, it's largely lost production. And that comes from the first plant that was struck in Missouri that makes the mid-sized pickup trucks. I think you like those quite a bit, Matt. And they have another plant that's shut down. It was just shut down the other day. So that's in Lansing that makes the mid-size SUVs. That wouldn't be counted in there yet. So more damage to come the longer the strike goes. They have plenty of liquidity at $39 billion. This is sort of a rainy day fund or something that just bolsters that. Because you have to remember, right now, GM is spending a lot of money to ramp up production of its electric vehicles. They've got the electric Silverado pickup, the Chevy Blazer SUV. They're ramping up Hummer and Cadillac Lyriq production. And they've got other plants that they're converting to make EVs. All that costs a lot of money. So they're investing in the business at a rapid rate, and then they've got this strike that's going to burn cash.
And David, as you mentioned in your story on the terminal today, the ongoing dialogue with the UAW, constantly we've seen GM, it seems like, navigating the union even more so, arguably, than Stellantis and Ford.
It seems that way. The union let both of GM's rivals off the hook in previous escalations of the strike. We do know that it's pretty far apart right now based on what the union is saying, what the companies are saying. And, I think there's still big issues on the table that need to be worked out. I think probably pay is one where they might have some common ground and be closer than others. But then you've got other issues like the future of battery plant workers and how they're paid, how they're treated. And pension issues is another one that's been out there for quite a while. Cost of living allowance is something the companies don't want to get into. And I think you've seen from the offers of the other two companies that they've budged on some of those. And GM hasn't budged enough for the satisfaction of UAW President Shawn Fain, that's for sure.
What do we know?
David,
Sorry, go ahead, John.
Sorry, Matt. No, I was just going to ask. I mean, we're digesting all of this on a day when we're also looking at the latest sales figures out of the Detroit players. And I guess if you're looking at the electric vehicle story, that for GM versus Ford, one could argue that Ford is selling a few more vehicles than GM is right now. To your earlier point about just making sure they've got enough financing at the ready, how much of that is part of this broader story?
It's a big piece of it because GM's in a period right now where they're just getting their Ultium-based vehicles out. That's their newest battery. It goes beyond what the Chevy Bolt EV can do in terms of range, in terms of performance, and it's billions of dollars to add the battery plants that they're adding, and they've got a couple coming online, and to convert some of their assembly plants to make these vehicles. Now, the good news for GM, and really all the car companies, but GM had a particularly good third quarter. Sales have been very good, especially for their large SUVs and large pickup trucks, and those are the big money makers of the companies. Now, that's sort of a ball and a strike when you think about that in context of the strike. On one hand, a strong third quarter means they have a lot of money, which will help them withstand a longer strike further still. But the union may look at those profits, if we're still out by the time earnings are released, and say, look, you've got even more money, another great quarter, so pay us more.
What do we know about inventories, David? I'm often asked about that. How long until it's a problem for, a customer will go to a Chevy dealer and see, oh, they've got no trucks left, and just go down the street and see if he can get a Tundra or I don't know, a Titan?
For the Chevy Colorado and GMC Canyon, those mid-sized pickups, dealers tell me they're already running low. In fact, I talked to a dealer in Dallas-Fort Worth the other day who said he was already lean on those even before the strike because they're popular vehicles in a market like Texas. So you'll see that, you see that impact already, right? For the Chevy Traverse, Buick Enclave, those are the mid-size SUVs made in Lansing. That walkout just started, but those are also popular vehicles. Sales were up huge in the third quarter for those. So you have to assume that drew inventory down a bit because they've been pretty successful that quarter. And you shut that plant down for a couple weeks and you have the same issue. And you'll see the same problems across town with Stellantis and with Ford. And at this point, because the strike is sort of a rolling strike, adding plants here and there as the union sees fit, it's going to be a very plant-specific thing. The one thing that they're really going to go short on is replacement parts because Stellantis and GM have those shut down by the strike.
All right, I should have said not Tundra and Titan, but like Taco and Frontier, right? That's what you're cross-shopping, or a Ranger if you're looking at a Colorado or a Canyon. David, great having you in the studio. Thanks so much for joining us. Bloomberg's Detroit Bureau Chief David Welch talking to us about the strike that just continues to go on. And his story today on the Bloomberg terminal, GM has taken out a $6 billion line of credit to try and hold strong. Now, coming up, Tilray positions itself to capitalize on the legal cannabis business worldwide as the Senate prepares a vote on the Safe Banking Act. Tilray is our stock of the hour. Next. This is Bloomberg.
A lot of the focus on the breakthroughs were because a lot of these research labs, the OpenAIs, Anthropics of the world, DeepMinds, had this focus on AGI, artificial general intelligence. Can you build an AI that can do anything?
Yes.
And it turns out maybe you can. So
making a machine that's in our own image, in a sense, that's what AGI sounds like.
More than that, it's a general intelligence. So it's the kid that made you look bad at school because he was good at everything. You know, the top performer.
Right.
Like GPT-4 now can pass the bar exam, the medical licensing exam, the GRE. It's probably going to Stanford, you know, next fall. But then our take was, that's great. You can have these amazing giant general models. What will be better is to mimic humanity, where our companies are not one generalist doing everything. What if we made it so you could bring your own data to the models and have lots of specialists working together and have those models working for you that you own?
Right.
These models like really talented graduates that occasionally went a bit weird, called hallucinations or other things, but that's because we feed them bad data. So we were like, what if you had open data, open models, and allowed it to be customized and specialized? So again, like a talented graduate, and they can learn very quickly from a few examples. So they have this base of generalized knowledge. They've been through kindergarten, high school, and university, but they're not specialized yet. But you can train them yourself, or you can just show them some examples, and they learn very quickly.
Wall Street is waking up. Europe is already trading. And Manus, Cranny, and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
This is Bloomberg Markets. I'm John Ehrlichman with Matt Miller. Time now for our stock of the hour. Shares of cannabis companies have been caught up in the recent market sell-off. That includes Tilray. The Canadian company just reported financial results. It's growing market share in Canada as it awaits bigger opportunities in the United States. One of the ways that it's hedging its bets in the meantime is through beer. It's now the 5th largest craft beer brewer in the U.S. after acquiring some brands from Anheuser-Busch. Matt Bottomley covers cannabis stocks as an analyst with Canaccord Genuity. He joins me here in our Toronto studio. A lot of strategy you have to have if you're a Canadian cannabis operator waiting for that bigger opportunity in the U.S. What do you make of what's going on with Tilray?
Well, I think when you look at Tilray's results, I think when they reported their prior quarter, they telegraphed pretty well that things are going to look a little bit different subsequent to the closing of HEXO. But if you look at what the company did in each of its divisions, I think certainly in the Canadian market, it's doing well in what is a bad situation with respect to some of the headwinds. Growing their market share, able to increase the amount of innovative products that they have to market. It's something that I know investors have been frustrated with as of late when it comes to the Canadian cannabis sentiment, but I think it's something that is at least trending slowly in the right direction.
You have a buy on the stock. You don't own any yourself. Why not, Matt?
I'm sorry, I didn't catch that.
You have a buy on the stock, but we just showed a board. You don't own any yourself. Why is that?
Well, I'm not able to own any of the stocks that I cover for compliance purposes, so that goes with anything that I cover in my coverage, regardless of the rating.
All right. So,
in terms of the,
what do you think about the possibility that safe banking will pass here, and that cannabis companies will be able to, take debit cards for purchases in a much more straightforward way, bank those revenues, do M&A? I mean, how likely is it?
Well, I think there's a saying with it, fool me once, shame on you, fool me 9 times, shame on me. And it's something that, certainly trended in the right direction when it comes to the headlines with safe banking, or now it's being called safer banking. But at the end of the day, this is something that, the Congress is going to have to get aligned with. It's something that has passed the House when it was under Democratic control about 7 times. And now it's looking to get a vote on the Senate floor, which would be something that has been unprecedented, never happened before. So I think it would be very positive for the overall sentiment of the equities. But in terms of the ultimate change practically in the sector, I think it's going to take some time to flush out, depending on what the House wants to do this after we get a successful, or if we get a successful Senate vote.
And Matt, beyond that, just in terms of the products in this sector, like we referenced the fact that in this case, Tilray is buying into the beer business. I know cannabis players on both sides of the border have experimented with drinks, but what is the opportunity to really grow these businesses? Because you referenced the Canadian market where, yes, the numbers would suggest growth, but I don't think this is the growth that people really expected when they were flying into this sector a couple of years ago.
Yeah, I think there's a few things going on there. We're currently at a $5 billion legal market in Canada today, so it's certainly not small potatoes, but really the issue we've had is how those economics have been divided up. And I think you've seen a lot of companies like a Tilray, even like a Kronos, that really hasn't put a lot of acceleration into the Canadian market, just for the fact that it's very difficult to sort of make ends meet, if you will. So this is why a company like Tilray is looking for investments and opportunities that might have a parallel to the cannabis industry and use it as a vehicle or a platform should there be catalysts on the federal front.
Okay, Matt, thanks very much. We'll continue to watch what's happening in the sector in Canada and the United States. Canaccord's Matt Bottomley joining us. Coming up, today's U.S. ADP report showing a smaller job gain than was expected. We'll talk about the state of the economy through the lens of small business. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
This is Bloomberg.
This is Bloomberg Markets. I'm John Olifman with Matt Miller. Time now for today's For What It's Worth. How about 89,000? That's how many private jobs were created last month, according to ADP. It's down sharply from the 180,000 new U.S. jobs that were added in August, and it marks the weakest month of job creation since late 2021. It comes ahead, of course, the Friday government payrolls report for both Canada and the United States, Matt. But we'll be watching very closely as the market has already been digesting this latest jobs data today.
Yeah, I thought it was a great way to describe it this morning on Surveillance when John Farrow said it's kind of a questionable appetizer that you maybe don't want before the main course, and yet people still trade on it. Let's discuss the big picture from a small business point of view. For that, we bring in Thomas Sullivan, Vice President of Small Business Policy at the U.S. Chamber of Commerce. And, small businesses are the biggest job creators in the U.S. How does the employment picture, the labor picture look from your perspective, Tom?
Well, thank you, Matt. The headwinds that small businesses are facing right now certainly are caused in part by worker shortages. This is not new. Small businesses have been facing this for over 6 years. We poll our small business members 4 times a year, and our latest poll from MetLife shows that about 40% of small businesses are planning on hiring in the next 6 months. Now, that's the good news. The bad news is that's down about 7 points from the previous quarter.
So how does that then affect inflation? I mean, are these companies still able to raise prices? Are they having to pay more for workers? Do they have margin compression? What are they looking at?
Well, Matt, there's a lot in that multi-part question. I'll try to hit each one of your points. So the first is the good news. Small businesses are doing pretty well right now. Our latest MetLife and U.S. Chamber of Commerce Small Business Index is at the highest level since the pandemic. Now, inflation is still the strongest headwind, and it has been for 6 consecutive quarters. Within inflation, small businesses' biggest concern, and that's 56% of small businesses, are worried about wage inflation. And that really gets at your core question, is that even though small businesses are more confident, and that confidence is at the highest level since the pandemic, even though small businesses are more confident, they're really worried about what it takes to find, hire, and keep the best employees. And so that's where wage inflation is now tops the list of all of those inflationary things that small businesses are worried about, whether it's cost of supplies, cost of energy, and then their highest concern, cost of labor.
Well, it is fascinating when you think about the fact that so many companies, especially during the pandemic, coming out of the pandemic, were scrambling to make sure that they had the workforce that they needed. But we're now entering this period where I think, and Matt was alluding to it already, we're trying to determine at what point you start to see more weakness in the employment picture. The jobs market typically is more of a lagging indicator. When companies are making those decisions on whether or not they ultimately have to pare back their workforce. Thomas, at what point does it enter the dialogue? What point do they start thinking more seriously about that?
Well, so small businesses have been trying to hire for a long time. I mean, I'm sure the two of you have come across situations where you go to a restaurant and only part of the restaurant is open because that's all they can staff. And so this is not a new phenomenon. This has been going on for about 6 years. So small businesses want to hire because they want to keep up with that high consumer demand, but they just are not able to find and keep the best employees. Now, the good news that we found in our latest MetLife survey is that small businesses feel as though they have an advantage over some of their larger competitors because 89% of small businesses believe that their family atmosphere within their businesses gives them a hiring advantage over some of their larger competitors. So I heard some time ago this expression that small businesses are leaning into their smallness to overtake some of the challenges. Now, their latest challenge is wage inflation, and so I expect that we're going to see small businesses leaning in to what makes them unique as an employer to try to get the best employees working for them.
All right, Thomas, thanks so much for joining us. Thomas Sullivan there, Vice President of Small Business Policy at the U.S. Chamber of Commerce. After the ADP number, of course, we're looking for any indicator, John, of what we're going to see in the non-farms payrolls number on Friday. And that then could, at least for the market, be an important indication of what the Fed is going to do in November.
Well, because every new economic data point, Matt, it does feel like we see those trader tweaks on expectations for a rate move by the Fed before the end of the year. Now, on this trading day, to your point about the jobs data, it gave investors a reason to buy in. The S&P 500 up about 0.1% at this hour. But we are seeing that continued weakness in oil prices right now that's weighing on energy stocks, for example, up here in Canada. For Matt Miller, I'm John Ehrlichman. This is Bloomberg.
Obviously, we were trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
in Sydney.
From Washington.
In Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching. You do not want to miss this story.
Is there the kind of upside?
The cross-asset sell-off put on pause. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld, kicking you off to the closing bell, about 2 hours to go. We're actually looking at some gains. You look at the S&P 500, currently up about 0.2%. We were up higher earlier, but the screen, it's still green, so we'll see how we end. Big tech doing a little bit better. The NASDAQ 100 up about 0.7%. And I had to check this and then check it again. We're actually seeing yields fall today. It feels like a long time, but you look at the 10-year Treasury yield down about 5 basis points right now. Of course, still at very elevated levels, near 4.75%, still hovering near the highs of about 2007 or so. And I wanted to also highlight the VIX. It's lower, but it's higher relative to its recent history. The VIX currently with a 19 handle. We'll see if we get to about 20, Romaine.
All right, of course, this market has been battered around a lot here by what we've been seeing in the labor market. The latest data, roughly 24 hours since we got the last government data on job openings, and now this morning we got another interesting data point here. Of course, this comes from private payrolls tracked by ADP Research here, coming in at around 89,000, about half of what we saw in the previous month, and more importantly, the slowest pace of growth that we've seen going back to 2021. This gets us back maybe into that sort of bad news is good news is bad news type of scenario, as this market really is trying to look for any sort of evidence out there that the Fed might actually have a little bit of a breathing room to not only stop raising rates, but maybe even potentially cut those rates. But of course, you know, that could be a bit of wishful thinking here as we talk about, well, continued labor strife. This was the summer of strikes. Now, so drifting into autumn here. The latest news this morning, 75,000 workers over at Kaiser Permanente walking off the job. Now, we should point out this is just a 3-day strike here, a planned strike they've been doing here. But all non-essential health services effectively shut down. So think if you're going to an optometrist, a dentist, or even for just a basic routine checkup with the doctor. This has a lot of concerns right now just about the power of labor right now, the inflationary impact that could potentially have, and of course, the reaction function by the Fed. Of course, that changes the calculus for investors, and Katie Greifeld, another big part of that calculus, of course, is where yields are going, and more importantly, where they've been here. We talk about that premium that investors usually demand, that earnings yield premium to hold stocks relative to maybe what they would get if they just bought and hold bonds. I'm told that premium is basically non-existent right now.
Well, I have good news. I have a whole chart to explain just that. Like Romaine said, you look at the S&P 500's earnings yield right now. It's forward earnings yield, and you compare that to the 10-year Treasury yield. That premium that equities enjoy, what you earn from equities, it's been narrowing and narrowing. And right now, it stands at about 0.3738%. We haven't been negative on this spread going all the way back to about 2002. But as you can see, the direction of travel is clear. That's where we're headed. And of course, a big part of the reason why that we've seen bond yields rise, it comes down to what's going on in real yields, of course. When you think about what we're seeing in terms of the nominal yield, it hasn't been inflation expectations. It's been those real yields. In blue, you can see we've been getting higher, currently sitting around 2.4% when it comes to 10-year real yields. And you think about the relationship to the equity market, as you can see, as real yields go higher, the S&P 500 has trended lower. That gap is growing, Romaine. It'll be interesting to see how those lines actually come back together.
All right, let's get some insights here out of our next guest to help kick us off to the close. Bill Gross joining us right now, the co-founder of PIMCO, and out today here with his latest investment outlook, a look at some of those yields, a look at the risk of holding on to stocks and the differential, I guess, in the premium that, as we just said, Bill, doesn't seem to exist anymore. If that risk premium isn't there, Bill, I am curious as to exactly what equity investors would have to hang their hat on to justify entering into this market.
Well, I think, Romaine, they would have a hat to hang on
perhaps AI and the potential increase across the economy in terms of productivity. As of now, we don't really know what that is. As well, they would hang their hat on a stronger economy that may continue to persist as opposed to a recession that many are expecting. That's what they would hang their hat on. I would go the other way and take the hat off.
Take the hat off. And I mean, we know in the past from speaking to you as well as some of your other public statements that you took that hat off a while ago here. I mean, what hat are you wearing right now?
Well, let me explain it this way. I think PE ratios are coming down. Katie explained it in terms of an equity risk premium being close to, basically the bond market, and meaning that there's little risk in terms of stocks relative to Treasury bills or short-term Treasury notes. I would put it this way. Give me 30 seconds for an example that. A PE ratio at 20, turn it upside down as an EP ratio at 5, so an earnings ratio at 5. A PE ratio of 20 was a year and a half ago, and since then, real yields, as Katie pointed out, have gone up by a good 350 basis points. If, and I'm not saying this is going to happen, but if the earnings yield ratio, the EP ratio, went up from 5 to 8.5%, then PE ratios would be down around 12 or 13. Now that's a little old school. That's Gordon discount, dividend discount model type of thing, but it does indicate the direction in terms of PE ratios that they might move if we see a situation of real yields still at 2.40%.
And let's break down what we've seen in terms of nominal yields. As you mentioned, real yields very high, and they've been in the driver's seat, really, if you think about this rise in the 10-year yield. Talk to us, though, about break-evens. Do you think that inflation expectations should be higher here, given what we're seeing in the energy market?
Yeah, I think it should. And, the break-even rate for the 10-year, amazingly, is rather stable between 2 and 2.3% today. I think around 2.34%. And so that's the expectation for inflation. I would say it's more like 3. Getting down to 2 is going to be very difficult going forward. And so, that to me means that nominal treasuries, take the 10-year again at 4.75 or 4.8, that nominal treasuries are basically based upon an expectation for a 3% Fed funds rate over a long-term basis. There is a equity risk premium that you talked about. There is a term premium for bonds as well of about 1 to 1.25%, because that's the risk of owning a 10-year versus a Treasury bill. And so if Fed funds settle around 3 to 3.5%, a 5% 10-year Treasury is decent value. It's not great value.
What is great value, though? When you think about 5% on a 10-year Treasury, we haven't seen that for 15 years plus. If that's not great, what is great?
Well, it's greater. There's no doubt about that. But 5%, again, would be a normal bond term premium of about 1.25% under 3% inflationary expectations. So that's okay. And I know corporate spreads have widened out a little bit, and that makes them attractive. But what I think has happened, Katie, in the past several weeks, and the market is beginning to recognize Treasury supply, based upon a $2 trillion deficit. They're beginning to recognize, basically the selling of bonds by the Fed in terms of the QT. They're beginning to recognize higher for longer as well. And so those two factors have been important in terms of the current rise. What I've seen in the last week is that the bond vigilantes, to the extent that they are now individuals owning, billions and billions, hundreds of billions of bond ETFs, they've been spooked over the last week or so by declines of 2, 3, 4, 5% in their ETFs. And so I think they're joining the crowd in terms of selling, and we're seeing a little bit of an oversold market here headed to 5%.
Certainly oversold, but I do worry, Bills, about some of these external events. Of course, yesterday there was a lot of hoopla around basically the Speaker of the House losing his position here and whether this was symptomatic of just the dysfunction in Washington. You mentioned the federal debt. We know debt servicing costs have gone up from sub 2% here for the government to, I think, now somewhere in the 4 to 5% range here on average. How much of that ends up becoming a factor in investment decisions, or can you ignore it?
Well, I don't think you can ignore it. We're going to see the point again 30 days from now in which they have to vote, and we'll have a new speaker, I assume. But to me, it indicates disruption in terms of the process, additional disruption based upon what we've seen, because 10 conservative Republicans basically are running the show in the House. And so that will increase volatility in terms of all markets, and certainly is a negative.
Well, yes, we can blame those 10 Republicans, but there really hasn't been a major player, at least when it comes to, fiscal conservatism for quite some time, at least not one that is listened to. And I'm talking on both sides of the aisle here. So this isn't just a party issue here. It just seems that whatever appetite that we had to address the fiscal situation, at least for now, just seems to have completely dissipated.
Well, yeah, the fiscal situation is very much of a negative. I mentioned $2 trillion in terms of a deficit, at least for this particular fiscal year. And the incredible thing you've pointed out in the past, that the higher level of interest that the Treasury must pay is going to add increasingly to this deficit going forward. And so we don't have much to hope for in terms of deficit spending. If anything, you would think that the fiscal side would come in and start spending money if we have a recession or a significant slowdown. So deficits, as far as the eye can see, is what I can see, and that puts obvious supply pressure going forward, probably twice as much as what we've had over the past year or two in terms of Treasury supply. So,
well, it makes me wonder then, Bill.
See what happens.
Yeah, well, it makes me wonder, Bill, about the whole ideology of bond vigilantes. Is that something that even really exists in this current environment? Is there someone or some group of people that have that much sway still in the market?
No, there isn't, Romaine, and I use the term loosely because back in the day, the vigilantes that Ed Yardeni talked about were in control to some extent. These days, to speak about an ETF holding by an individual as representing a bond vigilante is a little loose, a little bit of a stretch, as I suggested. But what I've seen in the past week or two are significant sales of ETFs. The volume on AGG or the volume on BND, which are $100 billion ETFs, has been significant. And so what I see are these smaller vigilantes joining the Treasury, joining the Fed in terms of negative pressure for bond prices and higher pressure for bond yields.
Well, just to ask sort of a simple scene-setting question, if it's not vigilantes, what do you think is driving this move at the long end? Do you think about 80, 90, 100 basis points move higher in 10-year Treasury yields over the past couple months? What's driving that, and what's going to bring it lower?
Yeah, I think that's important, and we talk about a forecast for a 10-year Treasury, but we should also talk about the shape of the yield curve. And as you mentioned, longer yields are headed higher, shorter yields not so much, and we have a less negative yield curve, which I think is important going forward in terms of markets. So what's driving it? I think to some extent the sales of ETFs, which own long duration as opposed to short duration, is important. I think the mix of Treasury sales is important going forward. Next week we'll see a 3, a 10, and a 30-year combined offering of perhaps $100 billion. And so the long end is being pressured based upon supply and based upon expectations for a stronger economy than what was the expectation 3 to 6 months ago.
All right, we're in conversation right now with Bill Gross, the co-founder of PIMCO. We do need to take a break, but Bill is going to stick with us. We have a lot more questions coming up here on the mortgage market, of course, with rates now at more than 7%, and some questions as well about merger arbitrage. Stick with us. The Close, right here on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
To the housing market and the impact of a 30-year fixed mortgage rate rising over 7%. Back with us now, I'm thrilled to say, is Bill Gross, the co-founder of PIMCO. And Bill, you tweeted yesterday, 30-year mortgage at 7.7%. This shuts down the housing market. And to that point, Bill, it feels like everyone is unhappy here. You have sellers struggling to sell, and buyers don't necessarily want to buy in this market either.
I think that's true. That speaks to the secondary market. What I was suggesting as well is the new housing market, construction, new housing starts, and so on. And it's hard to see, despite the relative success, I guess, of home builder stocks in the past several months. It's hard to see how new homes can be sold with a 7.7% mortgage and maybe some points added onto that. So, typically housing, Katie, leads the economy by 6 months or so. And so what we've seen is a relatively robust housing market, but at 7.7%, that doubles and in some cases triples the payments, the home payments that a homeowner would have expected, perhaps a year and a half ago.
Yeah, absolutely, Bill. And I am curious, though, too, if we talk about the secondary market, and our apologies to our viewers if you hear the phones, there's a national test going on here that's going across the newsroom and beyond. So no worries there, Bill. You weren't the only one with the phone on. I am curious, when we look at spreads, I mean, you mentioned earlier about corporate spreads, but I was taking a look at MBS spreads as well, and they've really sort of widened out to, I think, probably some of the cheapest levels that we've seen, at least since the big housing bubble collapse a few years back here. I'm curious if what we can extrapolate about that here. If you have that tightness in the housing market and nobody's making money in MBS here, what's the equal sign and what comes after that?
Well, I think you're correct. I mean, the spread between a 30-year mortgage, and there's an index on your Bloomberg screen that will point that out at 7.7% or so. But that spread relative to a 10-year government is significantly wide. To me, what that portends going forward, if that spread narrows, is that it's very much of a benefit to mortgage REITs, such as Annaly's, such as AGNC, that yield about 16%. Now, this particular sector thrives on a less negative yield curve, and it thrives, basically on lower market volatility in terms of the Treasury market, both of which, hopefully we're going to see going forward. So is a 16% yield on a mortgage REIT a safe yield? Not necessarily. They've been cut before if these mortgage REITs, have been over-levered. But I think they learned their lesson. I think we can move into this sector, and capture the yields as well as perhaps a 10% price appreciation if the mortgage spread narrows.
And Bill, I did want to switch gears here in the couple minutes we have left with you and ask about something that you had in your investment outlook. You wrote that some of the best bets right now are arbitrages in merger and acquisition deals. You specifically named Microsoft buying Activision Blizzard. I'm curious whether you view that as idiosyncratic to that specific deal, or are merger arbs in general more attractive right now?
Well, they've become more attractive in the last week or two as liquidity in both markets, in the stock market and the bond market, has declined. And in some cases, as I was explaining to my wife last night at dinner, margin is required to to maintain those positions. So, ATVI, Activision, to my way of thinking, it's 7 days away from approval by the UK Regulatory Commission. That means the price goes from 94 to 95. That's a point. That's 1.1%. Is that a big deal? It is over 7 days. And so, there are other examples such as Capri, which owns Jimmy Choo's, and other lines that are being acquired by a private investor, and that's selling at a discount of 10, 11, 12%. So there are situations, not a lot of them, but situations in which arbitrage can produce returns, certainly much higher than what we've seen in the equity market over the past few months.
All right, Bill, going to have to leave it there. Great to catch up with you. Bill Gross there, he's the co-founder of PIMCO out there in California with his latest investment outlook. A lot more coming up here on the show as we count you down to the close, including a conversation with Brad Jacobs, the chairman of XPO, the big freight and logistics company. He's coming out with a new book chronicling his career, and more importantly, maybe providing some advice for how to be an entrepreneur.
Plus, we'll speak with Wilbur Ross, former U.S. Secretary of Commerce and the founder of W.L. Ross & Co., for his insight on the state of the economy and the Fed's next move.
And a conversation on AI with Mandy Long, the CEO of the software firm BigBear.ai. Her insights on using the latest technology to help companies solve some of their problems, including supply chain and cybersecurity issues. That conversation and so much more coming up in a bit. This is Bloomberg.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
All right, welcome back to The Close. Romaine Bostic here alongside Katie Greifeld. And Katie, I guess the good news here is that yields, at least for today, have stopped rising. Unfortunately, the equity market doesn't really seem to be responding to it too well. They were pretty much higher across the board earlier in the session, but now starting to hit session lows.
Yeah, kind of a pop and a fizzle when you look at the S&P 500. We're still positive, 0.1% higher or so.
You missed your opportunity to use the snap, crackle, pop.
That would have been cute. I didn't want to torture it too much, but here we are. In any case, stocks off their highs.
Yeah, I like a good corny pun from time to time here. Stocks off the highs. Another thing that we haven't had a chance to talk about that I know we're going to get to in just a bit here is there's a lot of volatility going on right now around oil and energy. You're seeing that in stocks, and of course you're actually seeing that as well in WTI prices themselves. As last time I checked, we're down about 5% here on the day here. So that real sort of break above 90, and everyone was basically saying $100 a barrel is basically a matter of if, not when. We're now sliding pretty in the opposite direction.
Yeah, it's pretty amazing. Back at 84 handle on a price of the barrel of oil. Like you said, 100 seemed like a certainty. Not so much right now.
All right, a lot more coming up here on The Close. Stick with us. This is Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global global business authority.
Good morning, good morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power.
This is Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is the countdown to the close. The broader market's on the back foot once again. Let's get a check, though, of what's happening in the commodity space. Abigail Doolittle is standing by right now with our commodities close. Abigail.
Well, commodities are really on the back foot, Romaine. We have the Bloomberg Commodity Index down more than 1.5%. And here's one of the big weights. Crude oil down 5.6%. WTI crude, what goes up must come down. Last week it was at 95. Now we are down more than 10% from those levels, or about 10%. And most of that was into today. But then, of course, we had inventory numbers that were more than expected weighing. Copper also down 1.3%. Dr. Copper, a tell on expectations for the global economy. Wheat down 1.7% in its worst year, down about 30% since 2009. And coffee also down 1.6%. So again, a lot of pain for commodities. Let's look closer at that crude oil move, though, because it really is pretty dramatic. If we go into the Bloomberg terminal, here we can see over the last year there was a bit of a downtrend. Then you have this up move, a big up move, in fact, up about 40%. But this fast 10% slide, now we're back below the 10-day or 50-day moving average, maybe heading to the 200-day moving average. One thing I would point out, Romaine, is we recently had a golden cross. For crude oil, typically that's bullish, so maybe there's just some back and fill going on. If that is the case, the question is how far do we go down before going back higher?
Abigail Doolittle with a look at the commodity space, one of the big stories of the day unfolding. Let's look a little bit more long-term right now. The Greenwich Economic Forum is underway this week, and our next guest stepping away from the forum to join us and give us his perspective on what it takes to build a successful business. Brad Jacobs is the chair of the logistics firm XPO and has a new book titled How to Make a Few $Billion, breaking down the biggest lessons he's learned from his over 44-year career. That book will go on sale in a few months, but I'm told you can pre-order it now, if you would. Brad, great to have you here in Studio 2.
Fantastic to see you,
I was thinking about the title of your book and the expertise that you have, particularly when it comes to M&A activity. And I actually tried to go, one of the great things about the terminal, you could kind of go through and look at all the past acquisitions that you made at XPO, at United Rentals. I lost count after like 502 or something. I mean, it was a lot. You've been very acquisitive, and I'm curious as to what you've learned from that history of M&A activity that can be applied to just regular folks who maybe are, as your title says, trying to make $1 billion.
Well, first of all, great to see you.
Yeah.
I learned a lot because I did about 500 acquisitions, teams I've led, executed, and then
So I got close to
the number.
You got
close. You did a good job.
All right.
And I made pretty much every mistake you can make, particularly in the earlier ones. But what I learned mainly from M&A, and I write about it in the book a lot, is my approach to M&A changed a lot from when I did it in the earlier years to later. In the earlier years, I postured a lot. I played cool. I made the seller wait a few days or over the weekend and sweat it out. And I just realized all I was doing was annoying the sellers. I wasn't accomplishing getting the deal done. So I just became completely transparent. When I liked a deal, I just said, I really like this company. I'd like to buy it. And here's the price and here's the terms that work for me. Does that work for you? So that was a big change in my approach towards developing a relationship and getting a deal done.
When you are trying to get deals done and you're trying to sell the potential company that's being acquired or the executive there, is it always just pretty much a financial proposition, or is it more some of the, I guess, less tangible factors that ends up swaying that deal?
It's much more than, financially it has to work.
Yeah.
I mean, the numbers have to work. It has to be accretive.
Right.
It has to be a financial reason to do the transaction. The price has to be right. But it has to be much more than that. There's got to be a real strategically compelling reason to do it. There has to be a rationale to doing it. What does that bring to the table? Like, why does that change the company? What will our customers think when they read the press release, we bought that company? Will they love that? Will they go, oh, it's just a distraction? What kind of people are we getting into the company? How can we apply our technology to that company in order to grow it? So there's a lot of different things, and it's not just financial.
And how would you say that the environment for M&A is right now? When you think about some of the defining characteristics of today's economy, high interest rates, high inflation, regulatory concerns, how has that affected the M&A appetite out there?
It's very different in different industries. So some industries are already well consolidated. There's not much to buy. private equity has gone in, they've bid up prices, and now private equity owns a lot, so they're kind of selling. There's other industries that are less along the curve, and they're earlier in the stage of consolidation. They're more fragmented. There's plenty of things to buy at different sizes. And I'm going to be spending my time on my next company consolidating an industry that has similar characteristics to what we had before. In other words, it's large, it's fragmented, it's growing, there's synergies, there's advantages to being big, there's economies of scale. That's the kind of things I look for.
Well, let's talk a little bit about the current makeup of industries, because if you think about the strategy that you took with United Waste, United Rentals, and XPO, it was really targeting some of these companies that could be rolled up into a market leader. When you look at the landscape right now, are there any industries that fit that profile?
Yes, but I'm not going to tell you which ones because I don't want competition. when I select the one I want to do, obviously I'll tell you that. And then I'll tell you the other ones that I overlooked and why I overlooked them.
Well, I tried.
You tried, but I am curious about the competition here. I mean, you mentioned private equity. You obviously also have your own private equity firm here. I feel like there's just a lot more competition now for deals, given how much money has flowed into this space. Is that not what you're seeing?
There's always been competition. There's always been billions and billions of dollars.
Is the competition different now in terms of just I guess the types of people that you're up against, and more importantly, I guess what people are really looking for out of these acquisitions? It's one thing if you're saying I'm running a company like XPO and I want to go buy another freight company. It's a whole nother thing for a private equity firm to come in and say, I want to do that same deal.
So there's two categories of buyers in general. There's sponsors, there's private equity guys, and there's strategics, there's corporations. That changes where you are in the cycle, depending on interest rates, depending on what's going on, depending on growth, just depending on how much money is in the private. So it changes, and sometimes it's balanced. I would say it's more or less balanced now. I would say there's more emphasis on strategics in most industries, but not all, because interest rates are up. So for the sponsors who rely on leverage, that's a bad thing.
All right, Brad, we got to leave it there, but really enjoyed this conversation. Hope to see you again soon. That is Brad Jacobs, chairman of XPO and author of the upcoming book, How to Make a Few $Billion. Now, still ahead on the close, 2023 is all about artificial intelligence, and Cloudflare is making moves to expand its global reach. Next, we'll speak to the analyst that says this could be a long-term tailwind for the platform. This is the close on Bloomberg.
On the next episode of
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that, because we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women, like what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like there's a deeper purpose here. Like women deserve better and we shouldn't be an afterthought.
This is Daybreak Europe. I'm Kriti Gupta. Let's get to the stories that set your agenda.
Taking you from the U.S. market's close.
A lot of this was priced into the U.S. session.
To the overnight session in Asia. We'll walk you through what you need to know to kickstart the European trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in every weekday at 6 a.m. London time, only on Bloomberg Television.
Slice through the noise.
Forget the noise, ignore the noise.
Is this just going to be noise?
Just noise.
It's noise versus signal. Now, more to the point.
What is the lesson or the observation?
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we're going to start with On Holding. This is the Swiss footwear company, which actually just laid out a new 3-year outlook. It says it plans to double sales by 2026 and raise its adjusted EBITDA margin. Baird analyst Jonathan Komp reiterating his neutral rating and says the long-term targets should satisfy investors. Nevertheless, the share's down about 4% here on the day. Next up, let's take a look at Olaplex. Upgraded to equal weight over at Barclays, a price target of only $2 a share, but the analyst is optimistic here that the hair care company can stabilize its business regardless of slowing demand and some competition from other beauty brands out there. In the analyst's words, she says, the brand is not dead. Shares looking alive today, up 5%. And finally, Apple, an interesting downgrade today over at KeyBank, going to sector weight on the company, saying that U.S. sales are likely to struggle as consumers hold on to their older iPhone models. The analyst says Apple needs to re-accelerate its sales growth, and he also notes that the valuation on the stock has become a bit stretched. Shares, though, nevertheless, actually higher once again on the day, only fractionally, and those are some of our top calls. We do want to stay in the tech space now and take a look at Cloudflare and AI. Cloudflare is rolling out a number of partnerships with some of the top firms working with artificial intelligence. For more on this AI push, let's bring in Matthew Hedberg. He's RBC Capital Markets equity analyst. He has an outperform rating on Cloudflare. And Matthew, let's start off first here with these new partnerships. Give us a good explanation here of exactly what Cloudflare is trying to do.
Sure. Yeah. Thanks for having me. Really, it's in addition to a lot of the partnerships, as you mentioned, some of the leading vendors out there on the tech side, including Microsoft, NVIDIA, Meta, and others. They're really building out a much broader AI product platform play. A lot of these were announced with what they call their birthday week last week, and we think it's an important step in not only building product but also establishing key relationships with industry titans.
So when we talk about, I guess, how whatever cost is associated with this or effort, whatever you want to call it here, what is the payoff? I mean, going down this road, when do we start to see that actually show up in some material way in the actual fundamentals?
Sure. Yeah, I think candidly, we wrote that we think some of these news from Cloudflare was bullish. From a positioning standpoint, candidly, we think it will take time to flow into the numbers. We think AI itself is a significant trend, similar to the mobile phone, the internet, cloud computing, and we think it's important for companies that can actually monetize it to be seen as potential winners from an AI perspective. And we think a lot of these announcements that Cloudflare announced are important steps in that direction, but like all things with a subscription model, it takes time to show up in actual numbers.
It takes time, and when you think about all the different partnerships that have been announced over this birthday week, if you will, Microsoft, NVIDIA, Meta, Databricks, Hugging Face, et cetera, which do you think will be the most long-term positive for Cloudflare?
I think the two big ones from my perspective are Microsoft and NVIDIA. Microsoft is clearly laying a lot of the groundwork with what they've done in generative AI, and NVIDIA is more of the rails that a lot of AI platforms are being built upon. We think having those two vendors as key strategic partners is an important step, I think, in not only providing a future roadmap for where Cloudflare is taking their own platform, but candidly showing to others with these partnerships that Cloudflare is a significant player in the space and a place where developers can not only build and deploy AI code, but really use it as a place to push the boundaries of where AI can take us in the future.
And I want to talk a little bit about your price target for the stock, $75. If you take a look at Cloudflare's longer-term chart, it hasn't seen that level in well over a year. Obviously, some of these partnerships, as you just discussed, they will take a while to actually show up in the numbers. But what is going to propel Cloudflare back to $75 over the next 12 months or so?
Yeah, I think, there's certainly a macro element to a lot of tech stocks these days. So that is certainly, I think, an important aspect of Cloudflare's stock. I think, too, though, showing that some of these new AI partnerships, some of their advancements in security, all set the stage for what we think is Cloudflare being a disruptive vendor in the future. And so it's giving some anecdotal evidence of traction with some of these new products. The biggest one that they announced last week was something called Workers AI, which is really a platform that's built with a lot of these partnerships in mind and really part of this broader monetization strategy.
All right, Matthew, great to catch up with you. Matthew Hedberg there over at RBC Capital. A look at Cloudflare here and some of the partnerships that it's been making. Katie Greifeld here to expand into AI, or at least to take advantage of it here. And they're not alone here. I mean, you had Google, which is actually set to release a new version of its virtual assistant, the Bard. Which I'm not sure why it chose that name. Meta also rolling out, and then Canva, a design company, kind of helps you design sort of things for websites and stuff. They're also doing the same here. So this is quite a race going on out there right now.
Oh, big time.
Yeah.
A total arms race. And it's hard to keep up with all of the different partnerships being announced, especially when it comes to Cloudflare. 5 different announcements on its birthday week. I do find that endearing. I also celebrate my birthday week, not just a day.
So you're one of those people. Okay. In all seriousness, I am curious, though, as to when we start to see a little bit more consolidation, because when you talk about partnerships and things like that for just to get access to these tools, that's when you start, at least my brain goes into, okay, why don't these two just sort of get a room and just do it formally.
Especially when you think about how long it's going to take for some of these big AI pushes, these R&D spends actually show up in a positive way on the balance sheet. Some of these companies, just to survive, might need to combine.
Do you employ AI in preparing for the show?
I don't. I'm curious if you do, though.
You'll never know.
Okay.
All right, a lot more coming up here on the big program. Tim Massad, the former CFTC chairman, is here to discuss the crypto fraud case against Sam Bankman-Fried and FTX and what it might mean for the future of regulation. This is The Close on Bloomberg.
Today's CFOs are reshaping the C-suite. Bloomberg's chief future officer shines a spotlight on these dynamic leaders.
Today's CFO has to be much, much more than a bookkeeper.
One of the most important things is looking around the corner.
We have to let go of the traditional legacy department store.
Their impact goes far beyond the balance sheet. And on Chief Future Officer, they focus on much more than just revenues and margins.
You also have to be credible business leaders in order to really impact the business and steer the direction.
We are like biologists. We need to deeply understand the financial DNA of a company.
People just come with a playbook and say, okay, we're going to roll that. Don't do that. Think longer term.
It's an amazing time to be in this role. It's a lot more than the profit today. It's building the future of tomorrow.
Get passion, perspective, and more from the chief future officers of some of the world's most influential companies. A new episode every month, only on Bloomberg. Markets countdown in Europe. From the financial centers of the world, Bloomberg Markets European Close with Guy Johnson in London and Alex Steele in New York. Real-time numbers, real-time analysis. Weekdays.
to the close. It's time now for our Wall Street Week daily segment with the host of Wall Street Week, David Weston, who joins us every day at this time. And I teased you yesterday, you were up at the Greenwich Economic Forum. You had a lot of great conversations, and I'm sure one of the big topics had to be what for some people is probably the trial of the century going on right now here in Manhattan.
Yeah, it is time for a Samuel Bankman-Fried fix, don't you think? We're going to be doing this, I think, for several weeks before we're done here. And so we thought we'd ask somebody who actually knows about this area terribly well, exactly what's going on from his perspective in the trial. Tim Massad is a fellow at Harvard's Kennedy School. He's the former chairman of the Commodities Future Trading Commission, and he really has written a lot on this subject. So thanks, Tim, for being with us. Let me start with the most basic question, because I hear it different ways. Is this a standard, ordinary securities fraud case, just involving a lot of money? Or is it a crypto case?
Well, I think the government wants to argue that this is just a simple fraud case. This is about deception by Sam Bankman-Fried, lies, and fraud. And they want to stay away from complications about crypto and finance and regulation and which jurisdiction did things happen in. You know, they want to keep it as simple as possible. Whereas I think the defense will argue, look, Sam may have been sloppy, there was a lack of systems, he made mistakes, he screwed up, but they will hammer the point that there was not criminal intent here. At least that's what they'll try to prove. And obviously this is a criminal trial, you have to prove criminal intent. So I think that's where it starts, and we'll see, depending on how it goes, which side seems to be prevailing in terms of how they want to get the jury to think about the case.
Tim, what were the essential elements of the fraud as you understand it? Because I've heard things like the misuse of customer money, using it for things that they didn't understand they were going to be used for. We also hear conflict of interest, things like that. Does that matter whether it's regulated under crypto or not?
Well, no, you can make an argument that it's fraud even without that regulation. But when you look at it, at the case, there are 5 charges here. And 2 of them actually pertain to Sam's relationships with investors and lenders. And then 2 are arguments about misuse of customer money, essentially. And then one is a money laundering charge. So on the customer money one, that one will be interesting because the defense may argue, look, the money, was either wired to Alameda originally, and maybe even they may argue that the customer agreements allowed FTX to loan the money out. I've heard that argument made, and it was interesting. They actually tried to bring in a witness, an English lawyer, to argue that that's what the contracts allowed. Judge Kaplan decided to rule that witness inadmissible because he said, look, questions of the law, of the applicable law, are up to me. But I think we'll see that argument be made, that there wasn't a fraud here on the customers because some of them agreed to let their money be used. To me, the bottom line here is it shows how weak regulation is. So even though this is not a trial about, the regulations, there's one thing that should be overwhelmingly clear as a result of this trial, which is the lack of regulation in this space and lack of protections for customer money.
Well, I'm curious, Tim, if that comes up in the courtroom, and even if it doesn't, we know it's certainly going to come up in the media and in the court of public appearances. We go back to previous fraud cases here, and we've seen this tactic before, the idea of, well, hey, yeah, maybe I did something wrong, but what about those folks in Washington who are supposed to be looking over my shoulder here? Are there any parallels to this case that we're seeing right now with SBF in court that you can recall?
Well, I don't know that I can recall a parallel that's on this scale. This one's pretty big. But I think you're right, Romaine. I think they will argue that, hey, look, we weren't that different from the rest of the industry. Now, whether that's true or not, we'll see in the evidence. But they'll point to the fact that this is an unregulated industry, and there are arrangements where you might say, well, gee, that isn't really the best protection for investors, but there weren't specific standards that prevented it. Now, again, the government's going to argue this is basic fraud. There didn't need to be specific regulations. You told people, send us your money. You're going to be able to trade on FTX, and instead FTX used it to, make loans to Alameda, and Alameda then, made investments and so forth.
So Tim, given the fact that lack of regulation looks like it'll figure both in the courtroom and outside the courtroom, will this trial likely lead to some regulation? Because you and I have been talking about this for a long time. They don't seem to be getting anywhere in Washington.
Yeah, well, I sure hope so, David. I mean, on the one hand, I would say the U.S. kind of missed the moment, since that when FTX happened, you would have thought that might bring people together in Congress and say, okay, we really have to do something. We really have to strengthen regulation. But it didn't lead to that. And I think instead what happened was it reinforced people's pre-existing views. The people who were skeptical about this whole sector became even more skeptical, even more critical, and decided, boy, it really is worthless. That's what we thought all along. And the people who think there's some innovative potential here said, well, Sam Bankman-Fried was just a bad character, and he may have been guilty of fraud, but that doesn't taint the entire sector, so don't overregulate it. So we're still, at a place in the U.S. at least where we lack a good regulatory framework. The SEC, of course, is bringing important enforcement cases, as is the CFTC, but I don't think that's enough to get us where we need to be. Other jurisdictions are moving forward with improving their regulatory frameworks. So I am hopeful that at the end of the day, this case might encourage our Congress to really come together and decide we really got to do something about this.
Yeah, Congress coming together is a notion in and of itself. Okay, thanks so much, Tim. Great to have you with us as former CFTC chairman. Tomorrow we're going to be joined by Aaron Chatterjee. He's Duke University professor of economics about the state of the manufacturing sector in the auto strike. And on Fridays with Wall Street Week, we'll be joined by Glenn Hubbard, former Council of Economic Advisors chairman, and special contributor Larry Summers of Harvard. That's Friday at 6 p.m. New York time.
All right, and of course you can catch David Weston every day right around this time, right here on The Close as we round out into the final hour of trading here on this Wednesday afternoon. Stocks have been oscillating between gains and losses for a good portion of the day. The yield story, not as much of a factor as it was yesterday here, but still a lot of concerns here about the read on the labor market and the read on the Fed. A big data point today ahead of what could be a big data point on Friday. Romaine Bostic and Katie Greifeld counting you down to the close. This is Bloomberg. Thanks, David.
The world of politics.
We're not going to be relying upon countries whose values we don't share.
To the world of business.
It's all about corporate power at the end.
Balance of Power. Live from Bloomberg's Washington headquarters.
We couldn't be more excited what's in store for you.
How long will it take? How many years?
Why don't we take this one day at a time?
Good luck. Everybody has a perspective.
Every weekday at 5 p.m. Eastern Time. Join hosts Anne-Marie Hordern.
It's the one area, really, of bipartisanship.
I think we're getting more of it.
That's optimistic.
And Joe Matthew.
The debt ceiling is looming. How close are we going to get to the line before you start to worry?
Alongside Kaylee Langs.
The door was open for regulators to do more. And that puts the Fed between a rock and a hard place.
As they deliver news.
This is such an important economic issue. He's no longer trying to run away from
that. Really blew some minds.
Insight.
We can both invest in law enforcement and also make sure that communities feel safe in their own skin.
And analysis.
I think your audience will get this more than most.
This is not the Republican Party that you know.
It allows him to do what he did so successfully in 2020, which is run against crazy.
From and about politics' biggest power players.
This was the zombie case, and it's now more than well alive.
That's for sure, with 2 more potentially to come.
I'm willing to have this battle.
It is vitally important.
This is the intersection of Washington and Wall Street.
Bringing people directly to the decision makers that impact your investments and your life.
Balance of Power, every weekday at 5 p.m. Eastern, only on Bloomberg, your global business authority. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Almost 3 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Katie Greifeld.
An interesting day here in the markets, Katie. We talk about a market that actually did open higher, trying to reclaw, I guess, some of those losses from what was just a really dismal day prior to that here. But it's kind of been oscillating ever since. You're really not getting a lot of traction. There's a big question, and we had this conversation with Bill Gross, like, who wants to buy in a market, in an equity market, when you're not really getting a premium versus if you bought, say, in Treasuries or something with a little bit less risk profile?
I guess if you really think that earnings are going to knock it out of the park, and certainly we've spoken to people who have a pretty optimistic view once those earnings season reports start rolling in. But I mean, it's a great point, especially when you consider how high yields are right now, not just day to day, but also if you go back, extend the chart out 15 years, we're at some pretty lofty levels, and that obviously impacts valuations.
Yeah, even with yields slightly lower here on the day, still well elevated here. And we should point out, overnight, in the overnight session, that 30-year yield actually did trade above 5% here. You can see oil and gas stocks among the worst performers here on the day. As far as the best performers, a big part of the reason why you're seeing the NASDAQ higher is because a lot of those Magnificent Seven stocks are doing their job. But flip up the board here, Katie, because one thing that I was interested in here is this idea of the tightness in financial conditions. We know the Fed pays close attention to this, and we know that a lot of its jawboning has been because they want to keep those financial conditions somewhat anchored. And at least for right now, you can see that. Kind of hard to see on the far end of your screen there, but that's going into tighter territory.
If you squint, you can see a little bit of red, and of course we know a lot of that comes back to what we're seeing in real yields, of course, at their highest levels in quite a while. But let's talk about
negative 0.0. I like that.
There you go.
I love the preciseness of the Bloomberg terminal.
I do too. I crave it in other areas of life. Let's talk about some individual movers. I want to start with Tesla. I don't have a good reason why Tesla is higher right now, but it is. It's up 5%. Of course, maybe some relief from higher interest rates, maybe a macroeconomic story going on right now. That's obviously helping to lift tech as well. But let's also move on, since I don't have a good reason there.
Okay.
Let's move swiftly along to talk about Intel.
Intel, do you have a reason for that? Because there was some news flow. I think I remember seeing some news.
There's some fundamental news out of Intel. It reported plans to separate its Programmable Solutions Group operations into a standalone business, sell shares to the public, or seek an investor for it. And the sell side is psyched.
The sell side is psyched, not so much psyched about Ford. And when I saw those shares were lower by about 1% on the day. What's going on there?
This story I found so interesting. So Ford electric F-150 pickup sales dropped 46% in the third quarter. Pretty amazing. Of course, that's their signature EV.
Was that because Matt Miller pulled his order or something?
Maybe.
What happened?
Basically, deliveries were delayed. It said it held back vehicles over quality checks, and that is translating into a bad day for Ford. So.
Yeah, a bad day for Ford. And we should talk a little bit more about the automakers because we are getting some of those production and delivery numbers not necessarily good here. We are less than 1 hour away from the closing bell here on this Wednesday afternoon. Our cross-platform coverage, counting it down to those bells, it starts right now.
Countdown to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the countdown to the close. Romaine Bostick alongside Katie Greifeld. We're joined right now by our colleagues Carol Masser and Molly Smith. Molly filling in today for Tim Stenovic. Welcome to our audience services across all of our Bloomberg platforms, television, radio, originals, and our partnership here with YouTube. Stocks on the back foot to a certain extent, Carol, though we should point out some of the big cap tech stocks doing the best that they can do. Katie Greifeld and I were just talking on the big program on television about some of the automakers. You saw Tesla higher, you saw Ford lower, GM also lower on the day as well, down about 2% here. And a lot of this seems to be because we're finally starting to get a tally of the costs from this auto workers strike.
I'm so glad you went there. And I know you guys were talking about it a little bit earlier on television. GM setting up, what, a $6 billion line of credit, basically, to shore up their position, shore up their liquidity. I mean, basically, this has to do with the striking workers, the UAW striking workers. And as it goes on, those costs are starting to tally up. Right now, I think, Molly, already those costs to GM, we're talking about $200 million.
Did you not give Molly the memo? I see blue, 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 and then black.
Yeah, no one told me.
It's all kind of lovely, isn't
On Wednesdays, we were blue, so.
I would say the mood is definitely blue at GM today. I mean, you're talking $200 million of sunk costs in 2 weeks already. I mean, that is brutal. So we're looking at, I think, talking to some credit analysts, they do say that this is the prudent thing to do for GM. This is already like a strong investment grade company. They've got a lot of liquidity to tap if they need to, but this could be a prolonged fight here. So it's really just getting ready for however long this may last.
Yeah, and I'm also curious too about how it ends up affecting sales. We were just talking about the Ford F-150 Lightning and how some of those sales have dropped, obviously not necessarily related to the strike.
Even though that's like the coolest looking truck, if we're being honest.
Well,
looks pretty good.
Well, you need to do your part. It's time for you to upgrade.
But they're a little pricey for my taste.
Did you guys see the story, though? You know what's really, really, really hot?
Tell me.
Hybrids. Who knew among this EV craze?
Well, that's the thing. I mean, you want to do well for the environment, but there's range anxiety is real. So it makes sense
I don't want to
that,
spend money on that.
You go halfway, maybe a hybrid makes sense for a lot of people.
Yeah. Well, actually, I'm in that camp. We were looking for cars, and we test drove all those EVs. And then at some point, you look at the cost differential with the hybrids, and you're like, I don't know.
They got to come down. They got to come down. Hey, it does feel like one of the themes of 2023 has been the strength of the unionized workforce.
Yeah, and to that point, let's talk about one of the big stories on the terminal today. Kaiser Permanente. Thank you, guys. They launched their largest ever U.S. healthcare strike. We're talking about more than 75,000 employees. God, it's a hard day.
Wednesdays do that to us. I don't know about it.
I know.
I'm just telling you.
In any case, they began striking on Wednesday morning. It's a 3-day strike, but even still, that could stall services for nearly 13 million people in at least half a dozen states. This is something we've been talking about really for months, that the strikes that we're seeing, it's an economy-wide issue. It's not something that's concentrated in any one industry, it feels like.
Yeah, and we've seen this, of course, as workers, too. They looked at some of the other unions and see what they've gotten, and everyone else sort of wants their piece of the pie. And we talk about this not just so much from the labor market perspective, but how that feeds over into the inflation discussion, right? The idea that if workers feel like they have the leverage to do this, in theory, that would mean, I guess there's some correlation with the idea that the labor market is still strong. And if so, that means wage growth might still be strong. And if that's so, then that means the Fed ain't cutting rates anytime soon.
Exactly, right? Wages tend to be sticky and last around longer. So higher for longer, maybe for the Fed, and inflation higher for longer as well. All right, guys, that's a wrap. We're going to continue this cross-platform coverage. That'll give Molly some time to change into a blue outfit.
We'll see.
All right, our cross-platform radio, TV, YouTube, and of course, Bloomberg Originals. Join us at 4 p.m. Wall Street time as we count you down to the close on this. Yes, it's Wednesday.
Welcome back to The Close here on Bloomberg Television. We continue our coverage with those bells about 50 minutes away. We want to focus not on the markets right now, but on what's going on in Washington and beyond. A historic day in the U.S. Congress yesterday with Kevin McCarthy ousted from the speakership, the first time that's happened in our history. GOP hardliners revolted over the shutdown compromise. Take a listen as to what they had to say.
The yeas are 216. The nays are 210. The office of Speaker of the House of the United States House of Representatives is hereby declared vacant.
And McCarthy's removal fueling a lot of concerns about more turmoil in Washington. The House of Representatives is set to hold speaker elections next week, but keep in mind, we've got a potential government shutdown coming up here in mid-November if they're not able to reach a budget deal by then. Here to discuss this as well as other issues is the former U.S. Secretary of Commerce, Wilbur Ross, who's joining us live right now from the Greenwich Economic Forum. forum. And Mr. Speaker, great to have you here on the program. And I do want to talk a little bit about the economy and more, I guess, the private sector. But I do want to get your reaction to what's going on in Washington. You had a front row seat to, I guess, how Washington operated and, more importantly, how it doesn't operate sometimes. What do you make of sort of the evolution, if you will, since you've left office and what we're seeing today?
Right. Well, I don't think that Speaker McCarthy was really the problem. The problem is there are some groups within the Republican Party, especially in the House, that are very unhappy with Ukrainian spending, very unhappy with some of the welfare spending, and are very insistent that there be major changes. I think the scary part is the very fact that they're waiting till October 11th to pick a new speaker is bad, because we clearly aren't going to get any progress between the House and the Senate until there is a speaker. But then let's say there is one. It will most likely either be one of the fairly small group of very conservative people, in which case there's no reason to think that they'll be quick to compromise, or you might have a more moderate one, a Steve Scalise, someone of that sort. But it's not clear to me how Scalise or anyone like that would be able to solve the structural problem that there aren't enough votes that are willing to come to something similar to what the Senate is likely to pass.
I am curious.
I think you're going to have stalemate for a while, and I think the danger of a shutdown is much higher today than it was the day before yesterday.
What do you think maybe could actually provide some degree of compromise? We know there's an underlying issue here. Let's just set aside all the theatrics and politics that we know drove some of what we saw this week. There is a fundamental question here about our fiscal responsibility as a nation, our debt servicing costs, and what, if at all, we can trim in our budget going forward to address some of those issues. Is there anything that you see in there, in our budget, that could be, ample for some sort of common ground on both sides of the aisle?
Well, yeah, I think there are some things. For example, there's quite a lot of money that had been previously appropriated that hasn't been drawn down. If that would be frozen at the levels where it is, that would go some ways towards solving the problem without taking away from some of the new initiatives that they're wanting to have. There's still money left over from 2020, from the anti-pandemic moves that were made. It seems to me that trimming that, or it's just stopping it, would be a relatively easy fix, albeit it doesn't go the full way to where Representative Gates and some of the others would like this to be. But that's one area that I think would be relatively painless.
Let's talk a little bit more about the possibility of a government shutdown, because as you mentioned, of course, we're not going to get a new House Speaker immediately. And then, of course, we're coming up against that deadline in mid-November, at which point we could see the U.S. government shut down. We've had Moody's come out and warn explicitly about shutdown risk when it comes to the U.S. credit rating. How are you thinking about that? And does necessarily the U.S.'s credit rating really tie into what its creditworthiness actually is?
Well, I don't think the rating matters as much as investor attitude. No government ever really repays its debt. They all roll it over. So as long as the debt can be rolled over, it doesn't matter if you're AAA or AAA minus or AA or whatever. The real key is, will people continue to roll it? And about 1/3 of all the federal debt comes to be rolled over within the next 12 to 15 months. So that's around $11 trillion needs to be rolled over. If that gets rolled over satisfactorily, whatever the rating is, rating may influence the price of it, but personally, I don't think the rating is going to have too much to do with availability at this stage. Remember, they're not talking about making the U.S. Treasury a junk bond. They're talking about small gradations. So while it's a bad symbol, it's bad for morale, has bad longer-term implications, I don't think the immediate implications are particularly severe.
Well, to your point that it's investor perception that matters and maybe a few notches on the rating system don't matter that much. When you think about the symbolism of it, do you worry at all that foreign investors might be less willing to buy our debt, of course, as the U.S. debt supply continues to go higher?
Well, the other problem is that not only will the interest rates be going up by a couple of hundred basis points on some $11 trillion next year, but also the money that the Federal Reserve had been paying over to Treasury. They pay over most of their profits to Treasury. Well, those profits are getting smaller because they're largely in fixed income, long-term bonds, and the shorter rates with which they're funding that are going up pretty rapidly. So there's going to be a lot of pressure, budgetary pressure, in any event at the federal level.
All right, have to leave it there. Really appreciate your time today. Our thanks to Wilbur Ross, former U.S. Secretary of Commerce. Now, coming up on the close, the defense for Sam Bankman-Fried says he didn't intend to defraud anyone, but prosecutors argue he stole billions of dollars from thousands of people. We'll have the latest on the trial.
Plus, we're going to have a sit-down with Mandy Long, the CEO of the software firm BigBear.ai. You know it, and she has some insights on how using AI can actually help solve a lot of problems that a lot of companies are looking to address, including supply chain and cybersecurity issues.
And Swiss shoemaker On spells out ambitious growth plans, but shares fall with investors disappointed by the company's near-term guidance. We'll have the details. All that and more coming up. This is The Close on Bloomberg.
What are we doing to those shoes?
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Time now for our Muni moment, and municipal bond trading volume has absolutely skyrocketed this week after benchmark yields surged to their highest in more than a decade. More than 70,000 trades were executed on Tuesday in the busiest day this year, according to data compiled by Bloomberg. For more insight, let's bring in Stephanie LaRosiliere. She is head of municipal business strategies over at Invesco. And when you think about the type of the volume that we're starting to see, is there something fundamentally happening right now, or just has volume been kind of depressed the past few months?
Volume has certainly been depressed the last few months. We had a couple months there where, we had very slow trading days. September was one of those periods of time. But I really think right now we're looking at investors starting to take note of, as you mentioned, yields that we haven't seen in over a decade. I mean, every part of the curve is at a decade plus highs. And we're talking about a muni market where, in the past, when we have seen these yields, they've usually meant that there was some underlying fundamental questionable, credit issues. And that doesn't exist right now. So it's all about, getting the yield on a long-term basis, being able to either do that on an opportunistic basis or being a long-term investor. And I think that's what we're seeing is just the market taking note of that.
Well, Stephanie, I'm going through your notes and I'm getting excited because you write that the current period through late October may provide an attractive entry point. Why right now? Why is now the time to buy munis?
Yeah, so munis are a seasonal asset class. We had, a pretty strong technical during the summer where we tend to see very low issuance, and it's very simple. Bankers go on vacation and you don't have the deals coming to market, but you have a lot of coupons, a lot of calls, a lot of money getting reinvested into the market. September and October, and September was one of these months, are not months where we tend to have that money coming back into the market, but we do have a good amount of issuance. So it tends to result in a bit of weakness, price declines, and good entry points. Normally, November is a little mixed. Tends to be positive, and January historically has been pretty positive. So we see right now, and I would extend that into November, particularly because the Fed is at play here, could be really good times to take good entry points on a cost basis perspective that I think over the long term investors will be happy that they got in at these levels.
I am curious too about, we talk about some of the longer term economic conditions and how that could affect either new issuance or even to a certain extent in the secondary market. How much do you fret, if you will, for lack of a better word, about economic conditions? We pull our hair out every day over it for one reason or another.
It certainly matters, right? I think what we have seen, munis this year as well as last year, really couldn't withstand the brunt of what's been happening on a macro scale, right? I think the entire, bond market has been dealing with the exact same thing. So these things do matter. And but I would say in moments where, typical market environments, and I kind of do air quotes with typical, normally munis are not an asset class that will behave like everything else. We tend to provide really great diversification benefits. We tend to have very strong, tax-exempt income that we believe, continues to draw individual investors to our market. And so, on a go-forward basis, we do believe that we're going to see munis do a little bit more of that decoupling. Fundamentals at the muni level are strong. I've been listening to the show. We've been hearing a lot about, the dysfunctionality that is in Washington right now. In munis, we don't have that. In munis, we have states that are passing budgets. In munis, we have rainy day funds that are at all-time highs for 37 states. Fundamentals are strong and things are getting done and things are getting better. It's just that we really haven't been able to get out of the fray of the macro noise at this point in time.
And you're confident here. I understand your argument here with regards to states kind of being kind of on their own island to a certain extent, but you don't worry at all about what's going on with the federal government and how that could maybe impact municipal budgets?
So what's going on with the federal government, certainly we kick the can down the road. We've seen that, we now have unprecedented times. There is an interim speaker. So we could see ourselves, I think, again, in another situation where we have a government shutdown. The good thing about munis is, as I mentioned, those rainy day funds, we've been talking a lot about them here at Invesco. And the reason for that is because these funds can be used in any kind of, situation where funds are short. So, if we find ourselves in a position where we have certain types of municipal issuers that do rely on the federal government for appropriations, well, they can use the rainy day funds to supplement those until, the government reopens. So we feel that it's a pretty good, a pretty good perspective in terms of where we are relative to the federal government at this point. We've got about 30 days where we feel pretty strongly that municipalities can continue to do well without having any issue related to the government shutdown, should that happen.
All right, Stephanie, a great conversation. Great to talk to you here. Stephanie LaRosier, their head of municipal business strategies over at Invesco. Stick with us. We'll be back on The Close on Bloomberg.
The EU is one of the largest and wealthiest consumer markets in the world, and there are very few global companies that can afford not to trade in the EU. So as the price for accessing the European market, these companies need to obey European regulations. That's not surprising. But often these companies choose that they will extend the European standards across their global conduct and their global production because they want to avoid the cost of complying with multiple different regulatory regimes. So there are benefits to standardization, benefits to uniform production. So all the EU needs to do is to regulate the single market. It is then the market forces and the business incentives of global companies that transform that EU rule.
In London, in Sydney,
from Washington,
in Tokyo.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside? Well, Swiss shoemaker On is laying out ambitious growth plans, looking to double sales by 2026. But the company isn't upgrading its near-term guidance, which is leaving investors wanting more for at least right now. And Romain, this is an interesting company because like Hoka, like Brooks, it's one of those shoemakers that has managed to sort of eat into some of the territory that has been really ruled by Nike and Adidas.
Yeah, I'm actually fascinated by this. I mean, anytime you kind of have effectively what is kind of a new company come into a space that is dominated by such dominant players like Nike, you know, kind of has echoes of Under Armour, you know, I don't know, was it 20-something years ago when they kind of came out here. We'll see how long it takes. I'm not a runner, so you know these shoes much better than I do.
Yeah, I mean, I know a lot of people.
You're a Hoka person.
Yeah, I'm more of a Hoka gal, but I see them all around the city, so it's been interesting.
When you encounter somebody with different running shoes, is there like a face-off or something?
This is Bloomberg.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It was unimaginable that we would see rates move this fast. That was not in the realm of thinking.
Just the timeline of what they knew and when they knew it. Why didn't they do anything about it?
When do we have to see the kill? It's always for the Fed to respond to it. And this is really the tension.
Be informed.
You cannot be overly data dependent. You've got to have a view of where you're going.
Be prepared.
I
I think the earnings season might actually be the positive surprise that people are not expecting.
Be ahead of the game.
Certainly the beginning of something we need to keep an eye on.
And that, I think, is really going to be an interesting takeaway from this moment.
You go all birds on us and you say, turn, turn, turn. Is that what we're doing right now?
Yeah, big question coming into this year for us was, when is that turn going to be?
What a fantastic conversation.
The news you need.
The president's calling on manufacturers to make more in America. It is working, and it's reflected in these jobs numbers.
The analysis you trust.
How do you take this anecdotal data and say, really, just focus on the now, because that is going to tell you where we're going?
What is the measurement of uncertainty that we have in studying the American economy?
Milton Friedman had said there are long and variable lags in the impact of monetary policy. But man, it's a long slog.
The best way to start your day.
People are tuning into this program on a daily basis.
Oh, come on, it makes for good TV.
Let's move on.
Bloomberg Surveillance, weekdays from 6 to 9 a.m. Eastern. Wall Street is waking up. Europe is already trading. And Manus Cranny and Danny Berger are making sure you have the news, data, and analysis you need to set your agenda. Micro, macro, and everything in between. Manus in New York and Danny in London follow the money around the globe. Take a daily deep dive into risk and help you make informed decisions for your trading day. Watch Bloomberg Brief, weekdays at 5 a.m. Eastern, only on Bloomberg. Context changes everything. In a multi-trillion-dollar industry, there's a lot of ground to cover.
We indeed have a rally.
We're talking a lot of dividends. We're talking income.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
This is the countdown to the close. About 30 minutes left to go here in the trading day. Katie Greifeld.
And we're actually looking at accelerating gains on the S&P 500, currently about 0.7% higher. You take a look at the circle behind me. It's mostly green, more green than red, that's for sure. Consumer discretionary leading the charge. That sector up about 1.9%. Not classified, having a terrible day yesterday, but
we have to find out what's in that not classified
it's our
section.
Mystery sector.
Yeah.
We're going to figure it out. Communication services and tech also up more than 1%. You look at what's not doing too well. Utilities, of course, they had a pretty good day yesterday, but that has been under pressure for a while now. Currently unchanged. Energy off by 3.8%, Romaine.
Well, since you highlighted the 100% of not classified names moving higher, I'll start with 0% of the energy names moving higher here. At the bottom of your screen, Marathon Oil down about 6%. In fact, when you go through the S&P 500 today, most of the biggest percentage losers on the day are in the energy space. Of course, that will happen when you see a 5% drop in one day on WTI crude alone, adding to what has now been a string of losses after it has started to make that run towards $100 a barrel. Meanwhile, the flip side of that is keep an eye on the solar stocks. There was an interesting downgrade today on Sonova as well as Sunrun here, but Solar Edge seems to be bucking that trend. No real news here, but it does appear that there is a little bit of, I guess, arbitrage or pairs trades going on right now, if you will. Those shares up 4%. And Tesla, that's your biggest gainer on a percent basis in the S&P 500. Intel actually not having a bad day as well on the back of them actually saying they're going to separate one of their key units. I do want to talk a little bit here about the broader market here, and more importantly, where the returns are. And quite frankly, they're not anywhere. Not only did you lose money on equities in the month of September, but you also lost money on bonds and you lost money on a lot of other assets. In fact, that classic 60-40 portfolio, which had really started to come back in terms of the returns that it was delivering to investors, well, that's definitely been put on pause right now. Even though you have that negative correlation between yields and equity prices, but nevertheless, that's not enough to sort of deal with what we've been seeing right now as we head, we're still early, obviously, in October here, Katie, but as we head into this next month right now, concerns that those losses on a dual basis might continue.
Well, let's talk about AI, because when it comes to the stock market, obviously AI, one of the hottest topics for investors right now. And shares of the software company BigBear.ai Holdings are up about 100% so far this year. And of course, Big Bear, it focuses on using AI to help customers solve challenges involving supply chains, enterprise operations, cybersecurity, and more. And I'm thrilled to say that joining us now is Mandy Long. She is the CEO of Big Bear AI Holdings. And Mandy, tell us a little bit about the customer base at this point. I know that you have exposure to defense, et cetera, but how are you thinking about some of your commercial exposure as well?
First of all, thank you for having me, and I appreciate the opportunity to be on. Our customer base at Big Bear is diverse. We historically came up as predominantly operating in the defense world, as you said, representing over 20 government agencies, both on the defense and the intelligence side. But the piece that I think is really starting to unlock now, particularly as you think about what's happening in the global supply chain and the disruption that we're seeing there, is the commercial side of our business, which has been focused on manufacturing, logistics, warehouse operations, and how to do large-scale discrete event simulation to help with basically the determination of best next step. And in a world that is seeing the level of change and disruption that we're seeing now, we're seeing more demand than ever for our solutions.
And when you think about the push into the commercial side, do you anticipate that you're going to need to raise capital? You take a look at some of the sell side reception of the stock. It was TD Cowen that anticipated that by late fiscal 2024, you could need more capital.
So I actually do not anticipate that at this point. We've spoken a lot about it, not only with analysts, but more broadly in the market associated with the decisions that we made this year. We raised capital in a market that really wasn't giving it, which I think is a testament to the quality of the fundamentals of the business that exists today. And when we look forward, in the second half of this year, we're getting to a place where we're operating cash flow positive, and we see a very positive outlook as we begin to see accelerated growth.
There's been a lot of talk, of course, about the idea of sort of how you sort of set up guardrails, if you will, around the use of artificial intelligence. Obviously, there's been a lot of extreme predictions, both on the negative and the positive side as to what AI can do. I'm wondering if you can just give us, I guess, a more practical application of it, because we talk to so many companies that aren't AI companies, just regular old companies, and they talk about how they've been using some form of AI. It may not necessarily be called that, but some form or another of that for years now.
Sure. I think AI comes in many forms. I think one of the great things that I spend a lot of time educating not only our customers, but when we talk to the broader community about artificial intelligence and machine learning, is that it's a tool. It's an extraordinarily powerful tool, particularly with what we're seeing in the rapid acceleration and availability of high-powered compute that can be paired with that. But some of the most powerful applications of AI are going to be in what unlocks, as many have spoken about, the fourth industrial revolution, changing the way that people live and work. And if we apply that to even what we started this discussion with in supply chain, there are very important decisions that need to be made that affect many downstream consumers where AI can play a role, whether it's in purchasing, forecasting as it relates to commodity goods, or manufacturing optimization on the floor, all the way down through inventory management and distribution. There are places where practical use of AI, right? So, kind of unpacking that, math on steroids, right? Being able to apply that to use cases where pattern recognition is highly relevant, where human cognition, right, has limits, right, associated with how much information we can take at a time. That's the spot for AI.
And there's also another component of this, and we were having a conversation with Jana Eggers, kind of a real pioneer in this space a couple months ago. This idea, too, of how this data is used, and more importantly, how it's presented. And there's been this discussion about this idea that if you just put the data in front of me, there's a certain task in that that's going to be hard for me to sort of decipher what I should do. If you make that data visual, and let's face it, we all love pictures, it makes it a little bit easier to interpret where, say, the problems are and how to solve those problems.
So what you just touched on is, as a technologist, the thing that I consider the holy grail, right, which is vision AI. It's the ultimate shortcut to context. And what that really means, right, is that as humans, right, we process visual information 60,000 times faster than text, right? It's easier to remember. And half of our brain, the brain power that we have today, is directly or indirectly devoted to processing visual data. So when we think about the power of applying vision AI, right, the idea of being able to replicate eyeballs, making that a lot easier, that's something where I think you really start to undo some of the challenges that we're faced with as we look at what is ultimately having to mine big data landfills. When I look at where we're investing and where we're spending a lot of time, the application of Vision AI to workflows is really a big unlocker to move the ball forward in dealing with what are incredibly challenging, some say data lakes, I say data landfills, associated with actually building those models effectively.
All right, Mandy, got to leave it there. Really enjoyed this conversation. Our thanks to Mandy Long. She is Chief Executive Officer of BigBear.ai Holdings. Now, coming up on the close, Cal-Maine shares down after the release of their first quarter results. It's our stock of the hour coming up next. This is the close on Bloomberg.
Obviously, we're trying to create shoes for me to wear in the Olympics, and that was happening pretty quickly. And then just understanding a new industry and how shoes are even made. But as we went down that path and started to just learn and research more, we learned that shoes have not been made for women. What that means is a shoe is made off of a last, which is a mold of the foot, and it's the mold of a man's foot used to make women's sneakers. And I think it took time for us to really grasp that because, you know, we've been in shoe stores and we've gone to the women's section and it's like, no, there are shoes for women. Like, what's this over here? And then to really understand, like, all of that is marketing. This is just a man's shoe, like in a different color. And so that kind of eye-opening experience was just like, okay, we got to do this. And even more than making the shoes, like, there's a deeper purpose here. Like, women deserve better and we shouldn't be an afterthought.
Morning. This is Bloomberg Surveillance on TV and radio.
Welcome to Bloomberg Markets. China open.
Good morning, everyone, and welcome to the Pulse.
This is Bloomberg Technology.
And welcome to Balance of Power. This is Bloomberg.
All right, it's time now for our stock of the hour. A look at Cal-Maine Foods. The shares down today after its first quarter report missed estimates. That's even with as egg prices actually return to normal levels. Joining us right now is Michael Hertzer in our Chicago bureau, who covers food and agriculture for us here at Bloomberg. And let's just get out of the way sort of why we're seeing this reaction, because I was going through some of the numbers here, Michael, and it was pretty dramatic here. When you look at the drop in EPS, the fact that it missed, when you look at the drop in sales, when you look at the decline that we've seen in average selling prices here, we should point that this is all coming down from what I think most people thought was a fairly artificial level last year when egg prices went through the roof.
Yeah, for sure. I mean, things are coming down, and I guess what investors are probably keying in on is, you know, when does it get better? Cal-Maine in their earnings release said that conventional egg demand is still strong. They're seeing less demand for specialty eggs like organic, So it's just kind of like, when does things start to improve, and when do these lower egg prices really start to, I guess, get people to start stocking up?
I'm glad you specified that specialty eggs mean organic, because I was wondering what a specialty egg is, what a conventional egg is. And let's talk a little bit about the actual chickens, because my understanding of why we saw egg prices really get out of control over the last year or so is the bird flu outbreak. Where are we on that story?
Cal-Maine mentioned that, they still have not really been impacted themselves as a company with any infections. In the U.S., there has been a dramatic drop in infections. It's still the worst outbreak ever. It's spreading, recently popping up in South Africa, in Brazil, and even in France. They're starting to vaccinate some ducks, which is kind of creating a whole new trade barrier to sort of bring in some like foie gras into the U.S. But for Cal-Maine, they are still doing a lot of biosecurity measures to protect their farms and keep bird flu out. So they have higher costs, but overall, the laying hen population is rebounded in a pretty big way. So there's lots of more chickens hatching eggs.
Interesting here. So we're going to be all set for the holiday season, at least for those of us who like eggs, who eat eggs. We don't really eat eggs in our household. My son hates eggs, but I'm asking for the people, Michael.
Yeah, if you look at like the USDA chart, it's just over $2 a dozen eggs. So it's like less than half of the record from back in January, when millions of birds were being put down to stop the spread of bird flu. So there should be ample eggs as we start to get into baking season.
That's good news, because actually Romaine was asking for me, because I eat eggs. And I want to talk a little bit more about Cal-Maine's results and the egg market overall. So now that we've got the supply side maybe sorted out here or coming back to normal, what does the demand for eggs look like from people who aren't me?
Yeah, Cal-Maine highlighting the main things they're highlighting in the release were bird flu and inflation. So, as people continue to deal with inflation and, trade down on the type of meat or produce or eggs they're buying. So maybe if we start to see people going back to organic eggs and saying, hey, I'm willing to pay that premium, that might sort of put together a bigger rebound in the market.
All right, Michael Hertzer there. A look at Cal-Maine having one of its worst days, the stock having one of its worst days going back to April, on some big misses here in their latest earnings report. And Katie Greifeld, it's not just eggs. We're going to get Lamb Weston results tomorrow. It's potatoes.
Right.
And the big ConAgra is supposed to come out as well here. So we're going to get a read here on a lot of food staples.
You know what goes really well with eggs?
No.
Potatoes.
Wow. It's a nice little segue there,
Anyway.
Katie Greifeld. How long did it take you to come up with that?
Actually, about 2 seconds after you said it.
All right, we're going to say goodbye to Katie Greifeld. In a minute, we're going to say hello to Karen Pei, Fiduciary Trust International Executive Vice President. This is Bloomberg.
How did Jeff Bezos realize you could sell anything on the internet?
The web was growing at something like 2,300% a year. Anything growing that fast is going to be big.
Why did Bill Gates create Control-Alt-Delete?
Kind of become the poster child of, hey, couldn't you have made this stuff a little simpler?
And what inspired Diane von Furstenberg to create the wrap dress?
The wrap dress created me.
On the David Rubenstein Show, I uncover the untold stories of the world's most successful leaders, right here on Bloomberg.
Sports and money. They've always gone together.
But never before have sports been so massively influential and as lucrative as they are today.
NFL, NBA, none of them were what they are today when they were born.
There's leagues that are being thought of and built every day.
New teams, new leagues, new business models, even entirely new sports.
I never in a million years would have thought this is what my life would be like.
Cornhole's one of the only sports in the world in which you can have male and female players playing at the highest level against one another.
I'm Jason Kelly, a business journalist and sports fan with a couple decades covering Wall Street.
Getting involved from a business perspective was something that was very natural and an easy transition for me.
I'm Vanessa Perdomo, a former college athlete and journalist working across media.
Let's do it.
All right, you ready?
We set out to find what's happening and what's about to happen at the nexus of business, sports, and culture.
I got a point!
From the pickleball courts of Arizona,
to the kabaddi tournaments in India,
to the cornhole boards at your local tailgate. This is what's next in sports.
Bloomberg UK, your source for news and analysis covering the biggest challenges facing the UK government, economy, financial services, and markets.
Tax cuts should not be the priority. It's about a credible plan for growth over the next 2-3 years.
In this post-Brexit world, how do you see actually servicing your clients?
It was disruptive, and it's going to have implications to how capital raising works.
Now we're having the perfect storm in the UK.
Watch Francine Lacqua Thursdays at 9:30 a.m. only on Bloomberg, your global business authority.
This is Bloomberg.
This is the countdown to the close. I'm Romaine Bostic. Joining me right now, as she does every day at this time, is Scarlett Fu. And Scarlett, we talk about a market that's kind of been all over the place today. We had a pretty strong open, and I think we kind of lost some of that momentum a couple hours ago. But last time I checked, about 10 minutes ago, we were at session highs.
Yeah, just about. With the NASDAQ up 1.25%, the S&P 500 got close to its 200-day moving average, but that support level ultimately held. And you wonder, yesterday we had good news was interpreted as bad news for the market. Today we had bad news on the economic front interpreted as good news for the market. So I'm not sure which one is more representative of what's to come.
I'm not so sure either, and I do wonder how much today's price action in the equity market is tied to what we're seeing in the rate space. Of course, rates down here on the day. Of course, I don't think anyone thinks that upper client has been arrested, but at least for today, that's put on pause. And also the fact that you had a real big downdraft today in oil. I mean, WTI down 5%.
Yeah, and that's a big question mark there as well. Gasoline inventories rose while demand dropped to 25-year lows, especially for gasoline, but no one's saying that this is the end of the rise in oil prices either.
All right, let's get some insights out of our next guest to help us count us down to these closing bells. Karen Pay joining us, Fiduciary Trust International Executive Vice President and the head of Portfolio Management over there. Great to have you here in the studio.
Thank you so much.
Let's start off with the good news, bad news narrative here, because we did kind of see that, I think, with the jobs data we got yesterday with JOLTS, and then the jobs data we got today when it comes to the ADP private payrolls numbers. The idea that this is a market that does seem to be trying to find some sort of ratification that there is softness in the labor market, and as a result, softness in inflation.
Yes. Yeah. So I think definitely continuing the trend in terms of the market looking to the Fed and looking to the direction of rates as a guide for equities. And certainly we've seen the bond market sort of driving markets of late with the rise in 10-year yields really putting pressure on equities recently. So the markets today, I think, are reflecting the fact that, well, we've got some sort of weaker employment data, and that suggests that maybe the Fed will need to take action. Maybe that, the perception that the market has that we're going to see higher for longer sort of gave people a little bit of hope that maybe we have a little bit of a reprieve there.
I'm curious, everyone is so focused on this idea of when the Fed cuts, right, and that will provide a tailwind for stocks and other risk assets. I'm curious about the conversations that you have internally with your peers as well as with clients as well about this idea of higher for longer. That can you live in that environment? Meaning, can you make money in that environment? Is it, having a 5% baseline on the Fed funds rate, is that really the worst case scenario?
Yeah, so actually we just talked about it this morning in our meeting about how this market environment is actually giving investors sort of a three-legged prong in terms of an investment strategy with equities, fixed income, as well as cash and alternatives. So I think that, for the first time in a long time, we do have some alternative to equities, right, as we've seen over the last several months. There is some yield opportunity in fixed income. And I do think that with valuations on equities where they are, it makes sense for us to be and to remain a little underweight on equities and look for, some opportunities in fixed income. So we remain overweight fixed income at this point. We do see the yield opportunity there. We're actually considering potentially extending some duration, but not quite yet. It just seems as though there's a little bit of pressure on the upward side on rates. So we want to see how that settles out.
Yeah, so is there something specific you're looking for before you make that move and increase your allocation even more to fixed income?
So I think we're looking for some stability in terms of the yield pressure right here. And, I think that certainly when it comes to fixed income, right now we're still underweight duration slightly, but we're looking to extend it to more neutral to try to capture some yield opportunity. If we can get a 4.8% on the 10-year bond, certainly a lot more attractive than where it was 6 months ago.
Well, we're in October. October is notoriously volatile, so anything could happen in the next couple of days or weeks. We know that earnings season is right around the corner next week, and there was no regional banking stresses in the third quarter. Jamie Dimon, the CEO of JP Morgan Chase, has made clear the health of the consumer and of businesses is in good shape. What is your confidence in the banking sector's ability to weather the impact of these surging bond yields and surging yields overall?
Yes, so definitely more recently we started to see a little bit more pressure on bank stocks given the rise in rates. So I think a lot of the bank stocks, it really does come down to kind of the health of the consumer. Consumer lending has been a big driver for growth for the banks. I think we're going to continue to see a relatively weaker loan growth environment. So we're not yet optimistic, or we haven't been positive on the banks. We do think that in this most recent quarter, the consumer spending numbers got a boost from some temporary factors. It was a really, really popular sort of summer for concerts, so that provided a lift.
I hadn't heard. Is there anyone?
In terms of Taylor Swift and Beyonce, helping out the economy.
Yeah.
So, but we think some of those tailwinds will probably fade, and consumer spending probably will start to slow down again. And therefore, with that kind of backdrop, it's hard for us to be positive on the banks. And we do think that some of the pressures around balance sheets and also around mark-to-market losses on the bonds that financial institutions hold probably may come back to bite the banks.
I'm curious on the consumer spending side, if we are seeing that softness, and it does appear that that's there here, the flip side of that everyone is also concerned about is the potential for delinquencies and defaults and things like that. And we know right now the data seems to show that's relatively contained, at least on a historical basis. Does that worry you at all that we could start to see an uptick in those numbers?
It is definitely something that we've got our eyes on and that we're monitoring because, as you mentioned, relatively speaking, historically speaking, they're still at low levels, but they are inching up and delinquencies are rising. I think if you look in the subprime area, or also if you look at the smaller regional banks, the delinquency rates are much worse there. Mm-hmm. So that is an area that I think could potentially be signs of stress in terms of the financial markets and the economy.
All right, Karen, this is great to talk to you and great to have you here in studio. Karen Pay there over at Fiduciary Trust stopping by today to help us count down to these closing bells. And Scarlett, we talk about, I guess, what the setup is going into Friday. Of course, we get a big jobs number. Of course, we know we're going to get it because at least the government's open. And I wonder if that's going to change the narrative at all, no matter what we get.
Is the default scenario still a soft landing or no landing?
I feel like that's the hope, right?
Yeah.
I don't know. I mean,
the Fed seems to have really glommed onto that idea.
Right, and we heard that from Raphael Bostic yesterday. I don't think he used those words, but he was basically describing a soft landing, more or less.
Yeah, but I mean, with what we're seeing in the coming weeks and months coming up, it's going to be a big question mark. I also wonder how much Washington dysfunction may dampen sentiment. Yeah.
Dysfunction in Washington? I hadn't heard. All right, guys, we are moving closer to the closing bell. Stick with us. Romaine Bostic here alongside Scarlett Fu. Our full micro coverage, counting you down to those closing bells right here on Bloomberg as we take you to the bell and beyond.
Beyond the bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting you down to the closing bell, and here to help take us beyond the bell. It's a global simulcast with our friends Carol Massar and Molly Smith. Welcome to our audiences across our Bloomberg platforms. You are always my friend, Carol, no matter how hard I am on you. You know, they told me yesterday I was talking over you and all this. I said, really?
It's like
I went back and looked at the tape, and I said, this is just a normal day for us.
It is a normal day. This is not a normal day, though, in trading, right? I just feel like, again, it's another day where we see almost 2 different days of trends. And here we have the large cap tech names. I'm looking at Microsoft, up about 2%, Amazon, Alphabet, all up about 2%. You know, just when everybody says, forget about big tech, once again, investors coming in and buying on any kind of dip, Molly.
Oh, I was looking at the ones that were dipping today, and this is more in the energy sector. So take a look over at some of the refineries today. I was looking at Phillips 66, at Marathon Petroleum, and Valero Energy. All those dropping today as the EIA data showed that gasoline demand is falling and oil prices also extending their slump on the day.
Yeah, it's really interesting what's been going on with those energy names in particular. You look at the big movers of the day, they were all energy names and those big tech names. It's kind of like an either-or market right now.
Yeah, it is an either or now. And it gets to the question is, are you buying into a fundamental story? Are you buying into a macroeconomic story? Or maybe, I don't know, something that's just completely divorced from all of that. But look at the data that we got this morning, guys. What does that tell you about economic conditions? And what's the setup then as we head into Friday? We got an awful day yesterday, but clawing back some of those losses here on this Wednesday afternoon. So a bit of a reprieve here, to be sure. The Dow Jones Industrial Average looks like it's going to finish out the day higher by more than 100 points, up about 0.4%. The S&P 500, which yesterday was flirting with a break below the 200-day moving average, now trying to create some distance between the two, higher by about 34 points or 0.8%, while the NASDAQ is going to close higher by 1.4%. And let's check in on the Russell 2000 because the cyclical trade had started to gain a little bit of steam. You did not necessarily see that today. The Russell is your relative laggard on the day, only higher by about 0.1%.
All right, so let's dig a little bit deeper, into the S&P 500, and probably looked a lot different certainly earlier today. But right now, Scarlett, you've got almost 377 names to the upside in the S&P 500, 125 to the downside. The S&P 500, which is skimming along that oversold RSI level, as soon as it hits it, it just kicks to the upside. You find buyers coming in.
Yeah, and we close near our highs. It's notable that the last 35 minutes of trading or so, it's pretty much, it feels like it was a straight line up. When you look at the sector breakdown, I mean, just 30 minutes ago, this was pretty mixed. At least at midday, it was definitely flirting with a lot more red. In the end, you have autos and components, software and services, and media entertainment all gaining at least 1.5%. Look at autos, up 5% as a group. And then on the downside, energy stocks lower by more than 3%, telecom stocks, utilities. So you have energy falling with gasoline prices and oil prices, as Molly mentioned earlier, but utilities and telecoms, those are your bond proxies.
It's like everything is awesome, right? Again, I don't know. It's kind of crazy. All right, so let's get to some of the individual gainers in today's session. Check it out, everybody. Tesla, top in the S&P 500 and the NASDAQ 100, up another 6% in today's session. It did trade lower earlier in the week, right? There were some concerns about weak production and delivery numbers. That put some pressure. I really would look for anything kind of specific. The EU is formally launching an anti-subsidies probe into EVs made in China. Does that possibly help or hurt Tesla? I don't know. There's another report noting that Tesla taking its Cybertruck testing to Mexico. Also, it's being seen in Ohio, Florida. So maybe there's some excitement over that. I couldn't find a real catalyst, but nonetheless, investors certainly did, enough so that they were buying into Tesla. And then check out the cruise lines, guys. It wasn't so good yesterday when you had Morgan Stanley cutting price and estimate targets on the big three cruise liners. They were under pressure yesterday. Investors coming back in, Shore Capital stockbrokers, analyst Greg Johnson raising the recommendation on Carnival to hold from sell. Carnival up 2.7%. And don't forget, too, those falling oil prices, which is a big cost line on the balance sheet for the big cruise companies. that coming down, maybe helping them. And so you also had, check it out, Norwegian, it was up in today's session. Royal Caribbean up about 3%. Norwegian up almost 4%, Molly, in today's trade. And you're looking at the energy names, right?
I am. So like you said, maybe those is a good sign for the cruise lines, but not so good if you are in the oil business. So today, oil plunged most in more than a year, as signs that demand is flagging in this high rate environment as we're really gearing up here for this higher for longer stretch in interest rates. So West Texas Intermediate crude settled below $85 a barrel today. It's the biggest one-day drop since last year. So the bigger decliners today is Valero Energy, Marathon Petroleum, and Phillips 66. All of those down more than 3% on the day.
Let's take a look at what happened in the yield space here, because we talk about that relentless climb higher in yields, actually taking most of the Treasury market into oversold conditions here as that sell-off really looked like it was going to extend for a fifth week. So a bit of a reprieve here on the day as the entire curve shifting lower. Most of the activity on the longer end of the curve with the 2-year down about 10%. And on the longer end, you're seeing a drop of about 6 basis points or so on the 30-year. We should point out, though, overnight, there was a lot of volatility, and that 30-year yield did actually trade above 5% for the first time in quite a few years. And I am curious, guys, about your thoughts here about the direction of yields. It's interesting. We're speaking with Bill Gross a little bit earlier, and he really was hammering home this idea of how the Treasury market is in oversold conditions, and that, at least on a technical level, might actually provide somewhat of a reprieve. But, of course, he's still in that camp that yields are destined to move higher from where they are right now.
They can be oversold for a really long time. It's not clear what the